are that the parties are very far apart on these key issues.
Yes, the key issues, namely being the future of Iran's nuclear program. The U.S. has said that the U.S. can't, that Iran can't have a nuclear weapon. They want to take the enriched uranium stocks, whereas Iran has said that they are allowed to have some of these elements for energy. They've previously in the past agreed to no weapon. That was not on the table here. Really, the talks over the weekend fell apart, and that led to a lot of saber rattling ahead of this blockade that went into effect yesterday. The tensions have cooled a little over the past 12 hours or so, as it's clear that there hasn't been any sort of, military confrontations near or in the Strait of Hormuz, and both sides say that they're talking about talking, essentially. So next weekend is sort of the dates that they're eyeing potentially for talks. That's important because that's just 2 or 3 days ahead of when the 14-day ceasefire is set to expire. So that the main goal there out of those talks would be to get some sort of extension of that ceasefire.
So, Wei Lun, what are we seeing in terms of shipping in the Strait of Hormuz right now?
Right, so traffic has really come down to almost nothing again. It spiked about a day before because we saw like a few super tankers actually going through the Strait of Hormuz when all this while during the war, almost no ships have been going through. So it's now back to zero again. I think the ship owners inside the Gulf are still waiting to see what can happen with the US blockade. So in fact, they're actually working with 2 blockades now. One, you have the Iranians trying to control the traffic. And on the other side, you have the US Navy waiting for ships to come through. So how this will be implemented in practice remains to be seen. But for now, the Strait of Hormuz is back to standstill, as we can see this morning, Asia time.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
And Laura, this is really consequential for all countries around the world. So we're seeing the likes of China, the likes of Pakistan, trying to perhaps act as mediators. What are they doing?
Yeah, so Pakistan has played a very formal role in mediating these talks, hosting the talks last weekend, likely a host if there's any future round of talks, and sort of being that formal out in front of the cameras party that has credibility and trust on both sides with Iran and the U.S. China, for example, has played a much more behind-the-scenes role, particularly nudging Iran in both agreeing to the ceasefire. Trump has said he thinks that's one of the reasons that they originally signed on to the ceasefire several days ago, and also kind of as these talks have gone on, encouraging them to keep continuing these talks, ratchet down some of the increased tensions we've seen as there's been a little bit of a sort of military buildup as a showdown has sort of formed, at least rhetorically. So China has played a really crucial role here, and this is actually a role that that Trump is actually very happy for them to play. He would love for countries who have relationships with Iran to sort of push them towards some sort of talks, towards some sort of peace deal. Of course, these countries, particularly China, are also some of the most affected by some of the energy shortages that we're seeing. So there's a lot of both geopolitical and economic factors at play.
Well, Lun, there's a lot of uncertainty, even in the sort of aftermath of this current blockade, as to what the Strait of Hormuz might look like operationally. We've had Iran demanding that tolls be charged for vessels transiting through the waterway. We've had Donald Trump saying that it could be a joint venture. What do we know about the possibilities here?
I think this is something that we've not seen happen before. So there's a lot of possibilities that can happen here. We already know that Iran is implementing a toll booth of sorts. Various countries have various means to talk to Tehran to get their ships out. Some might not necessarily have to pay a toll. But there is that aspect that Tehran can control. And as for Trump's plan for a JV, that's really in very early stages. But what we are talking about here is actually international waters that ships are, by international law, should have the right of passage because it's a strait. It connects two bodies of water. And what Iran is doing and any future plans to control navigation in that area is an uncomfortable question for global trade in general.
Wei-Lun Soon, also Laura Davison, really great to get your insights into the Iran story as we continue to watch the latest headlines and we try to digest what's happening in the Strait of Hormuz as well. And of course, Asia will take cues from the U.S. session. We have seen a little bit more risk-taking, especially with the S&P 500 gaining ground to the highest levels since February. Let's get to Bloomberg MLive Strategies' David Savage. In fact, David, we are back in the green for the S&P 500, but is this a temporary rebound or a more structural, fundamental repricing of the risks around Iran?
Yeah, I mean, it's been a pretty stunning recovery. And I think if you look at the Asia session and in the U.S., volumes have been fairly muted. So I think that suggests there's not, a huge amount of conviction, towards these advances. But obviously, I think this will be a fairly positive day. It's shaping up that way in Asia. Whether it's sustainable, again, I think that'll come back to the fundamentals, right? When do we get the Strait of Hormuz to reopen? In what form? And all the while, you have the economic consequences of the conflict to date continuing to compound. So I think in the medium term, that will weigh on risk assets, that will weigh on equities, but in the immediate term, I think equities are going to continue to move towards what type of rhetoric we get, and certainly the sentiment has improved as we've moved towards pricing de-escalation and a potential agreement of some kind.
Is the entire focus really on the geopolitical story at the moment? Because there's clearly still other distractions, the AI story, the software story. We also had numbers out from Goldman Sachs. It's still concerned about private credit as well. But are investors kind of only able to hold their focus at the moment on these peace talks?
Yeah, I mean, I think it's still the dominant factor, but it's obviously holding less impact, and we are starting to see some dispersion. So again, I think if we look to earnings, I think what might come through in terms of tech names is that tech earnings are likely to be more insulated, and certainly we've seen in Asia and in the U.S. Tech starting to outperform. But again, I think ultimately all equities, all risk assets are going to be vulnerable to the economic reality and the macro backdrop, which has fundamentally changed since the conflict. So I think, in the short term, rhetoric can move markets, particularly on lower volumes. But if we move going forward and we see inflation continuing to accelerate higher, if we see growth concerns really start to pick up, and then on the back of that, financial conditions tightening, which of course is potentially a global story, that will weigh on stocks, and of course earnings can play a part, but that macro backdrop will, I think, be dominant.
Not to mention, of course, Fed rate cut expectations. What are the implications, especially for the dollar, now the Dixie seeing its longest losing streak since 2024?
Yeah, I mean, I think a huge part of that was positioning coming in pre-ceasefire, and then since then, I think as risk sentiment's really picked up, obviously it's been a fairly weak environment for the dollar. I think, again, coming back to the macro backdrop, I think that there's reason to believe the U.S. economy will be more insulated than some in Asia, some in Europe. And so, yes, inflation accelerating in the U.S. and growth coming off is by itself in isolation a challenge for the dollar. But again, we're going to see potentially a more problematic backdrop in Asia and Europe, and in that environment, when you add in the terms of trade shock, when you add in potential for, of course, there could be a further escalation and another haven bid for the dollar, I think that sets up as a fairly positive environment for the dollar going forward.
Bloomberg M Live strategist David Savage there. We'll have more on Iran coming up on the Asia Trade. We'll be speaking to a former US ambassador to Bahrain next. Plus, we're live at the HSBC Global Investment Summit in Hong Kong. Our exclusive interview with the bank's group CEO is coming up, along with conversations with the chiefs of legal and general and Schroders. Much more ahead. This is Bloomberg.
Success means having the right partner, right where it matters most. With 170 years of expertise, we are unlocking opportunities and driving progress across the globe. And now, we're in the heart of Egypt, your gateway to Africa and the Middle East.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Well, he's done a good job. It's Steve and Jared, they've all done a very good job. And I can tell you that we've been called by the other side. They'd like to make a deal very badly. We've been called this morning by the right people, the appropriate people, and they want to work a deal. They would like to work a deal.
President Trump saying Iran has reached out to the U.S. seeking further talks on a peace deal. Joining us now is William Roebuck, Executive Vice President at the Arab Gulf States Institute. He was previously U.S. Ambassador to Bahrain and U.S. Deputy Special Envoy to the Global Coalition to Defeat ISIS. Ambassador, great to have you with us. Bloomberg also learning that the U.S. and Iran are in conversations to have another face-to-face negotiation before the ceasefire expires next week. You've been in high-stakes negotiations. Tell us what needs to happen in this second round. What's happened in the first one? Because J.D. Vance was only in Pakistan for 20-plus hours. Nothing came out of it. What needs to happen in this one, and who needs to be at the table as well?
I think the big thing they're going to have to do is narrow the differences. From what was discussed openly, I mean, that we had access to, it sounds like their positions were extremely far apart. It's good, in an initial round of negotiations like this, the two sides put out their maximalist positions. But I think, going forward, they're going to need to sort of narrow those positions and find some elements of common ground that they can begin to either agree to or at least get closer on. And we'll see how that develops. As far as the composition of the two sides, I think that's up to the White House and on the Iranian side. I think that my sense is that their side is going to remain as it is. But President Trump will have to decide what the composition is. I don't know if the Vice President will stay with the lead on this negotiation, or if he'll back away a little bit and let Steve Witkoff and Jared Kushner take the lead in negotiations as they move forward.
You mentioned the need to find common ground. Where do you see that potential?
Well, I think if they can come to some sort of arrangement over the strait, that's going to be incredibly important. There are a lot of stakeholders looking at that issue. Our Gulf partners in particular are very concerned about the arrangements that the Iranians have been able to impose. They want all of those arrangements removed, and they want the situation to return to essentially the status quo ante before the war. So that's a key issue. And the other cluster of issues have to do with Iran's nuclear program, what they perceive as their right to enrich uranium at low levels, and also at the importance of what is going to happen with the. I'm sorry, I've got. Also, what's going to happen with that 900 pounds of uranium that is highly enriched, and that they're going to have to find something to do with it. The Trump administration wants the Iranians to give it all up, and the Iranians want to keep it and work it to diluted quantities inside Iran.
Ambassador, that was going to be my next question, because I think, in a sense, you can see how an agreement over the Strait of Hormuz could be made on more commercial grounds, right? A deal being made there, whether it includes tolls being charged by Iran or the US, or, this joint venture that President Trump has even alluded to. But the nuclear issue, is that a more existential one for Iran? Do you see the leaders in Tehran giving that up, particularly in light of, having just been through the last 6 weeks of war?
I do. I think for the regime, it's an existential issue. They have survived this war so far, I think, under very difficult circumstances. It's not a pleasant regime. It's a ruthless, violent regime against its own people. I don't make apologies for it. But just in terms of a regime that controls a state, they have survived a lot. I don't believe that they are going to concede in absolute terms some degree of a right to enriched uranium. I think it's a bedrock. That's what they have conveyed, that it's a bedrock principle for them. It was negotiated in clever, careful ways under the previous nuclear agreement with JCPOA and President Obama. I don't know if the Trump administration has the desire to find a clever solution that would be symbolic in allowing them some degree of symbolic but very, very low level of enrichment, so that they could at least say they have a nuclear program, civilian nuclear program. It remains to be seen how far, if at all, the Trump administration is willing to move on this.
10 years ago, Illuma Capital set out with one goal: to help people like you build a legacy for tomorrow. Through personalized strategies and unwavering dedication, we've been instrumental in helping our clients achieve their financial dreams, whether it's securing retirement, growing wealth, or planning for the unexpected. For a decade, we've been trusted to guide your financial journey. Expertise and care. Visit illuma.co.za today. Illuma Capital is a licensed FSP. T's and C's apply.
There's also the pressure for Gulf states as well, right? How much buy-in do you think they have when it comes to how these talks go? Because so much of the sort of collateral damage we saw was really for a lot of America's allies. And do you think any kind of compromise being reached there as well? Because reportedly one of Iran's demands in these peace talks was to have US military bases removed from these countries.
Right. I think that particular aspect is a non-starter. I think it was put in there just as a maximal demand. The Gulf states are extremely concerned about the negotiations, and they're concerned about all of the damage and instability that Iran has inflicted on them unjustly and in very destructive ways in the course of this war. Now that they're in it, and now that all of this destruction has been borne by them, they want to see that the war ends on terms that are not unduly leaning towards Iran. They want, as I mentioned, they want the strait to go back to the position it was in before. I think they also want to make sure that Iran doesn't come out of it strengthened with its use of ballistic missiles and it's the support for proxies and drones, things like that. Those are going to be the important aspects that the Gulf states are going to be looking at. And they need stability to export their oil and to support these ambitious development programs that they have, where they're trying to diversify their economies away from oil over several decades. And they need to have stability. They need to have foreign investment. And it's going to take a very clever set of negotiations to allow for that, I believe.
Ambassador, we appreciate your time with us today. William Roebuck, who's a former US ambassador to Bahrain, on just some of the really difficult sticking points if the US and Iran do indeed head to a second round of in-person negotiations on this ceasefire. More ahead on the Asia trade. This is Bloomberg.
And the latest from the corporate front, American Airlines shares climbed in late trading after Bloomberg revealed that United Airlines CEO Scott Kirby is said to have floated a possible combination. Our sources say Kirby has pitched the idea to senior government officials, though it's unclear if an actual process is underway to explore a deal. A merger would create the largest airline in the world and will face intense scrutiny, even under the business-friendly Trump administration. Sources say CATL is considering a share sale to raise up to $5 billion in Hong Kong following a stock rally. We're told the world's largest maker of EV batteries has held preliminary talks with banks about the placement and is also considering selling convertible bonds to meet some of its funding needs. Shares of the Chinese battery giant have surged since they began trading in Hong Kong last year.
Coming up, we're live in Hong Kong. HSBC's Global Investment Summit getting underway. This is Bloomberg. Let's take a look at how we're setting up. We are expecting some optimism as markets are choosing to really focus on this narrative that we are hearing, that talks are underway to potentially set up a second round of in-person negotiations, even as President Trump begins his naval blockade of the Strait of Hormuz. We are seeing those gains that we saw overnight with the erasing of those losses for US stocks and Asian stocks looking to replicate some of that optimism there. Wall Street gains really being the leadership that we see when it comes to the start of trading in Japan, in Hong Kong, Australia, all of those markets seeing futures climbing on the hope that a deal will help ease those oil prices, boost economic growth and stave off these concerns about inflation and stagflation there. We're also seeing that decline of WTI, of crude overall, helping sentiment as well, pairing those gains during the US session. We also saw treasuries advancing as well, the dollar index pretty much erasing those gains to a slight decline. At the moment, we're seeing quite a bit of upside for both the Nikkei 225 and Sydney futures, up by 1.3% there. It will be very interesting to see if those gains hold, particularly for the energy sector that has been the biggest beneficiary over the past few weeks. Well, the HSBC Global Investment Summit is getting underway in Hong Kong, bringing together global financial executives and policy experts to discuss issues reshaping the global economy. Our China Show co-anchors David Ingles and Yvonne Mann are right there at the event, standing by with our first guest.
Equity indices built on opinions. That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Dave.
Yep, good morning, guys, and thank you for carving out some time on your shows for us. Yep, we have a lot coming through, of course, here from the HSBC conference, and we're joined here exclusively here on set. Legal and General Group CEO Antonio Simões is here with us. Good morning, and very nice to see you. Dark and early.
Yeah, well, thank you for having me.
First one of the day for us.
Oh, no, great. So we're going to shake off the cobwebs early, hopefully quite quickly. Iran and obviously Middle East is a very big theme that we've been tracking, and we're wondering, from your specific perch in your business. Are you seeing any specific implications and flow-wise or on the business itself? How are you looking at what's going on?
So, good morning. So first, of course, the situation is very concerning and distressful, particularly for people in the Middle East. And what we all want to see is a quick resolution to the conflict. In terms of what we're seeing in the markets more generally, and you saw it this morning again, although oil prices have gone up, actually markets have been stable. So in many ways, I think markets are seeing through the conflict and are also hoping for a resolution. We as LNG, we have very little exposure to the Middle East. So what we're really helping is helping our clients navigate the uncertainty. We've been around for 190 years as a company, and so we've seen a lot of uncertainty in this type of situations. So we're not seeing any different flows from what we normally see, and we're helping our clients navigate, and we're keeping a watch ourselves, obviously, like everybody else.
Why do you think flows have stayed pretty consistent amidst all this volatility? What do you think is driving that right now?
So I think from our perspective, we are a really long-term investor. So when I think about how we invest as an insurance company, as I say, we have this sort of 190-year view. So we tend not to react in terms of our own balance sheet. In terms of our clients, I think there's a bit of a wait and see, sort of to see how the situation evolves. But a lot of our own clients are big insurance companies, big institutional investors. So they're taking a similar approach. It's probably a bit different with more retail shareholders. But and more retail investors, but particularly from our client base, we have 1.6 trillion AUM. Most of what we do is institutional, so I think people are taking that longer term perspective.
Just in terms of the business itself, and I think you've been at the helm just a little bit over 2 years, correct me if I'm wrong?
Yes.
Have most things gone to plan? What's gone well? What hasn't quite gone up to par up until this point?
So, yes, it's been over 2 years. Time flies. So what I feel really good about is that we have set out the strategy for growth. Actually, it's great to be here in Asia, a region that's growing. I've reshaped my team, which is also great as a sort of as a CEO. What's been complex is what we were just talking about. So the environment is uncertainty, and there's been both in the UK and globally, there is some uncertainty, but that's, again, as I said, what we're here to do, to have our clients navigate that uncertainty. So I feel pretty good about, this is our moment as LNG. We've set out our strategy, we have our team in place, and the business is growing.
If you take a look at LNG's stock price, I think it's kind of remained the same level since you took the helm back in 2024. What do you think is the main issue that investors might have on your strategy and the execution of it?
So the main issue is this point, Yvonne, about growth. Kind of, is the company growing, right? We're a super stable company, but we're sort of a bit of a difficult. It's difficult to change such a big institution, and therefore what you see recently in terms of key client wins, it's that coming through. So we have 3 big businesses: pension risk transfer. We are the global leader in institutional retirement, so we feel very good about that business. Asset management, which is primarily the business that we do here in Asia, we've seen an inflection point, but that, to be honest, is the area that is taking longer to turn around in terms of performance. And then we have 13 million customers in the UK as far as the retail business. It's really the asset management business where we now need to see more of that traction, and I think this is what investors, I look at the long term, and it's where investors now need to see that traction coming through.
Any drastic changes? Drastic might be an aggressive word, but investors, the curse of being a public company, right? Yeah. Stable is not good enough. They look for growth. What changes are you looking to put in place in the asset management side?
So the biggest part of asset management, the biggest changes have been in asset management. So I've cleaned up a lot of historical issues that we had in terms of businesses that we sold. So we had businesses that actually were good businesses, to be honest, David, but businesses that didn't make sense strategically for us. So I sold those. That bit is now done.
You're done with that?
Yeah, that bit is done. Nothing more to report there. We had 2 divisions that I merged into one big asset management business, the 1.6 trillion that I was talking about. And now it's really, so the cleanup is done, and now it's really about growing.
Last year you had a few departures. Your CFO and your CIO have left the company. Does that make it harder for you to execute on your strategy, or is it the opposite, where you can actually get things done on a management level?
Look, you set up your strategy and you define your team, and actually both of those departures were actually planned in many ways. And so I feel very good that I now have my team around me and that we can now grow. We have a period of stability in terms of management team, and so that's why I'm saying this is our moment. You set your strategy, you put your team in place, and now it's about growing the business.
Fresh out of the oven is the Manulife deal. few weeks old, if I'm not mistaken, 2-3 weeks since the announcement. So what initial milestones are you looking at for in terms of success rate?
Yeah, it's a great question. So we, in this part of sort of growth, a lot of what I've been doing is big strategic partnerships. Actually, if I step back, because 2 weeks ago I was in Japan, we also did a big strategic partnership with Xauusd, so one of the largest insurance companies in Japan. And the Manulife strategic partnership is similar. We have a very complementary strengths, so their footprint and our footprint fit really nicely together. And so it's about us being able to distribute products through Manulife. When I arrived here in Hong Kong last night, I could see there sort of the big logos, and the presence in Asia is great.
Yeah.
Presence in Canada is also great, a key strategic market for us. And conversely, they're looking at reinsuring part of our business. We're looking at similarly doing that with them. So insurance and asset management, two big businesses for both companies, and we're quite complementary. So I'm looking at much more kind of success coming from that partnership.
We've seen a lot of consolidation in the asset management space, whether, given the competition that you see with the passive investments, like investment firms like Vanguard, BlackRock. On the other side, you have, the alternative investment firms like Blackstone and Apollo. I mean, we just saw when it came to Nuveen, really, merging with Schroders.
Yeah.
What does it mean for LNG? Do you think, are you the next UK firm to be swallowed up?
Look, scale is the name of the game here. We have $1.6 trillion US dollars, so I feel very comfortable with our size. We ourselves, we announced a partnership with Blackstone, and so we are bringing the best of LNG and the best of Blackstone together. So there, we're using some of their US private credit, and then we're developing hybrid public and private products. So I think it's a question of continue to grow organically because we have the scale, but also partner, where we've talked about several of our partnerships. And so I feel good, and it's also it's flattering in a way. This is it's a space where a lot of money is coming into the insurance asset management space. And we like competition.
Can I just ask a final? Is that a key growth area for you, alternatives? Just based on that last comment you just made.
Definitely. So we have roughly $100 billion of alternatives. So if you think about it, actually compared to our size, probably we're underweight from a private perspective, but we've been growing a lot. And so that's one of the things I'll be talking about it in the conference today here.
Antonio, we're going to leave it there, but thank you so much for kicking off.
Thank you.
The GIS for us here, Antonio Samoa is Group CEO of Legal and General. Sherry, we'll send it back to you.
Yeah, great conversation, guys. Our China show co-anchors Yvonne Man and David Ingles there at the HSBC Global Investment Summit in Hong Kong with the first conversation of the day, but plenty more to come from the event. We'll be speaking exclusively with Group CEO Jorjad El-Hadary and getting his thoughts about the impact of the Iran war as well. And of course, you can also explore live streaming news, interviews, as well as all Bloomberg TV shows, documentaries, analysis in one place, bloomberg.com/videos. This is Bloomberg.
Success means having the right partner, right where it matters most. With 170 years of expertise, we are unlocking opportunities and driving progress across the globe. And now, we're in the heart of Egypt, your gateway to Africa and the Middle East.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
"2026 began with a degree of optimism. Markets hit record highs, confidence continued to build, with most clients focused on growth, strategic activity, and capital deployment. As we've said, things rarely move in a straight line, and as the quarter progressed, the macro environment started to weigh on sentiment. Volatility increased meaningfully amid concerns around AI-driven disruption in sectors like software, heightened uncertainty in parts of private credit, and the conflict in the Middle East."
Goldman Sachs CEO David Solomon there speaking on the bank's earnings call after a surprise drop in bond and rates trading revenue casting a shadow over what was otherwise a record quarter for the bank's equities team. Well, Goldman's results give one of the first glimpses into how Wall Street fared in a volatile period, while equities traders there rode the wave to beat their own quarterly revenue record by more than $1 billion. Earnings for fixed income, currency, commodities, those businesses fell 10% from a year earlier. Let's bring in our Bloomberg Intelligence senior analyst Herman Chan. And Herman, is this, as David Solomon says, an indication that expectations have been set too high, or is it really broadly that we're seeing a less even uplift in these numbers?
Well, I think we'll have more answers tomorrow morning in New York trading with JP Morgan, Citigroup, and Wells Fargo reporting. But at least to kick off earnings, it was great to see the strong equity performance, but fixed income trading that David Solomon and Goldman had mentioned earlier was really affected by rates trading and mortgage trading. So is that really specific to JP Morgan, or is that something that's broader, that will broadly affect the group? I think we'll have more answers tomorrow morning.
What are we expecting from JP Morgan, given that we have seen some consistent results coming from Jamie Dimon? Are these concerns that we saw in Goldman's results going to be reflected there too?
Right. So I would point out that JP Morgan has offered some really constructive guidance for the first quarter in terms of trading. They're talking about mid-teens growth year over year. And that just points to that strong trading results. The volatility that we saw in the first quarter, particularly in March, was expected to really lift the results in areas like rates and in equities. So the base case that we're expecting is that the other names within the U.S. investment bank should drive really strong trading results, but we'll see how that shakes out over the next few days.
Herman Chan, good to have you with us. Bloomberg Intelligence, U.S. banking and financial sector analyst. And we also have earnings from Chinese companies. They sort of disappointed with more negative surprises, challenging the outlook for the country's stocks, despite their sort of haven-like status, especially during the ongoing war in Iran. Let's bring in our China correspondent, Mingming Lo. So what have we seen in terms of these results that give us a little bit of pause when it comes to the future and outlook of the Chinese equity markets?
Yes, Sherry, we're just heading into the first quarter reporting season, and I was just diving into the fourth quarter reports and taking a look at how the companies have been performing. And you take a look at this chart that we pulled out from the terminal, and you take a look at the earnings performance for all the companies that have been reported. And on the terminal, they only show about 200 or so companies because of the data being cut off in mid-February. And here you can see about 60% of the companies had reported a negative surprise, and just 35% had seen a positive surprise. And of those that reported a negative surprise, they missed the earnings estimates by an average of 25% or so. So we have analysts now all sort of revising their forward earnings estimates for the MSCI China companies by about 2% for the next earnings quarter. And this really reflects the rather mixed results we have seen so far, because since the start of the war, we have seen how Chinese firms have been very resilient amid the Iran war. But you pull out, you look at start of the year, that orange line over there is the CSI 300. The white line is the Asia Pacific benchmark. Since the start of the year, actually the CSI 300 has been underperforming the Asian benchmark. So, and that's why as the volatility from the war starts to fade, investors are going to start paying attention to the macro overlay and the earnings outlook. And key to watch will be how strong is the recovery when it comes to domestic consumption. We have seen some structural improvement with the PPI turning positive for the first time in a few years in March. We had the credit data, though, coming out overnight that shows very sluggish demand for new loans. So again, very mixed results there, and some analysts are not convinced that we are seeing a meaningful improvement in domestic consumption sentiment.
We are also looking ahead to, it's a big week for data, right? With domestic activity, of course, GDP, but also trade in particular. What are we expecting here, especially in the context of some of these pressures coming from now the blockaded Strait of Hormuz and the impact potentially on crude flows?
Yeah, so the impact of the war is likely to weigh on the trade data. We did have this one-off bounce, a big increase in exports and imports in the first 2 months of the year. But in March, we expect that to normalize, particularly when it comes to export, because we have the early high-frequency data showing that outbound shipments have been slowing down amid the Iran war. That likely reflects the slowdown in global demand and logistical issues as well. Its shipments to the U.S. continue to see a steeper decline as well, and that shows that China's exports continues to be offset by its exports to other regions amid this tariff war with the United States. Imports expected to hold up at about 13.9%. I think it's interesting to see, right, when you look at that, and here you can see the export numbers, a big bounce in February, and we expect that to come down sharply in March. But if we go back to that trade expectations, you can see that import is now expected to come in higher than exports. And this is quite significant because we had seen this two-track economy with exports very high and imports lagging behind. This is starting to flip right now. Does that mean that we are seeing more stronger domestic demand, or how much of it is going to be contributed by higher energy prices and energy imports? So that's something to dig deeper into when we have the breakdown of those data.
Bloomberg's China correspondent Min Min Lo there. Let's get you caught up to date with some of the other global headlines that we're following this hour. And inflation in India picked up last month as the Iran war lifted crude prices and squeezed gas supplies for key industries. The consumer price index rose 3.4% in March from a year earlier, matching estimates. India is among the economies most exposed to energy shocks from the conflict, as it imports about 90% of its crude oil and more than half of its liquefied petroleum gas. Canadian Prime Minister Mark Carney is on the cusp of securing a majority government as voters head to the polls for a special election. The referendum seeks to fill 3 vacant seats in Parliament, with Carney's Liberal Party favoured to win at least 2 of them. A majority would allow the Liberals to pass bills without opposition, while also lowering the risk of losing a confidence vote. More ahead here on the Asia Trade. This is Bloomberg.
Take a look at how we're setting up for the market opens in Japan in just 9 minutes' time. You're seeing Nikkei futures pointing to some upside after losses in the previous session, all to do with the latest headlines around Iran. President Trump has said that Iran has reached out to have another round of negotiations, or wants a deal, and Bloomberg has learned that we may be headed to another face-to-face negotiations. Do watch out the JGB's sell-off that we continue to see, especially as markets pricing in of rate hike bets for this month plummeted with the recent comments from the Bank of Japan Governor Ueda. Let's get more with Bloomberg Japan economy and government editor Paul Jackson. And these are comments coming from a speech read by his deputy. What exactly was in that speech?
Well, I'll tell you what wasn't in that speech, and that was a clear signal that they're going to go ahead with a rate hike this month. Markets have been kind of expecting, given all the signalling from the BOJ, the release of these new inflation measures, release of updated figures on the output gap in the economy, all seem to be pointing towards an April rate hike. Nothing was in the bag, though, and we were waiting for that signal with this speech. Now, if you remember, the last 2 rate hikes that the Bank of Japan has done, they've given very clear signals saying they will discuss whether to raise rates or not, a kind of clear hint of what's on the agenda. We did not get that yesterday, and instead we had Ueda, via his deputy, saying that inflated oil prices could have an impact on inflation, but could also weaken the economy. That sounded like a classic central banker's hedge to give them wiggle room to either hold or raise rates.
How serious is the economic health situation in Japan? Like, what are we seeing on the ground right now that might point to the BOJ being a little bit more concerned about growth?
Well, I mean, I think if you look at the overall pattern of what's going on, the uncertainty in the Middle East, I think the BOJ has come to the realization that even though it might want to raise interest rates in April, it's going to be a very bad look when you've got so much uncertainty, these dark clouds hovering over the economic outlook. Is this a time you want to be putting more pressure on the economy? Probably not.
Paul Jackson, really good to get your insights, joining us with the latest on, of course, the Japanese economy and what the BOJ is doing next as well. Take a look at some of the stocks that we'll be watching when trading resumes in just 6 minutes' time. SoftBank said to be sounding out investors for a potential 6-part bond sale in dollars and euros, a source saying that the fundraising would help support its growing push into artificial intelligence, including plans to back OpenAI.
Equity indices built on opinions. That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Overcome operational constraints to focus on future growth? And unlock economic and social prosperity through environmental responsibility? With EY Parthenon and EY's full spectrum of services, we're reimagining the enterprise to shape the future with confidence.
This is Asia Trade. We're counting down to Asia's major market opens. After gains on Wall Street, we could see a potentially risk-on session if that continues here in Asia. Heidi, of course, we have seen President Trump repeating those claims that Iran wants a deal. Will we see another face-to-face round of negotiations before the ceasefire expires next week, April 22nd?
All this while the naval blockade has started, right? And we hear reports that the two sides are very much far apart when it comes to key issues, not just to do with the Strait of Hormuz, but the really fundamental existential issue of what Iran does with its nuclear ambitions.
Yeah, traffic through the Strait of Hormuz slumping again after that slight spike over the weekend. As Heidi mentioned, the naval blockade now ongoing, but still we are seeing early in the Asian session a little bit of downside pressure for oil prices, and you can see Brent coming online down 2% at that $97 a barrel level. Nikkei stocks upside of about 1% after a session of losses. Of course, we will be watching closely the JGB space. We saw a massive sell-off on that repricing when it comes to expectations of that rate hike in April, with BOJ Governor Ueda's recent comments that he might see through past the impact on the Japanese economy from the war in Iran. Kospi now coming online, upside of more than 2.5%, and we're seeing the ASX 200 also gaining ground, Heidi.
Yeah, we do have some breaking news when it comes to Singapore's central bank. We are seeing the Monetary Authority of Singapore raising the slope of the Singapore dollar band, keeping the width and the centre positioned to respond to that medium-term price stability risk. We're also seeing the inclination when it comes to excessive volatility to be curbed in the Singapore dollar effective exchange rate there as well. GDP numbers also coming through. First quarter GDP falling 0.3% quarter on quarter. So we are getting a lot of lines through. Bloomberg's April Hong is in Singapore for more on the decision and on the data, including inflation forecasts. Such a difficult time for central banks at the moment. What are we seeing from MAS?
Yeah, essentially this is pretty much in line with expectations. I think 15 of the 18 economists polled by Bloomberg had seen this tightening move coming through. So essentially they are raising the slope of the Sing dollar band. They're keeping the width, the center unchanged, and essentially becoming one of the first Asian central banks to adjust monetary policy settings in the wake of the war in Iran at a time when these import costs coming in higher threaten to help or lift the inflation beyond projections. And indeed, we're seeing today as well how the core inflation, which of course in Singapore includes the fuel aspect, that is being raised to 1.5 to 2.5% in terms of the projection for this year. And of course, this is a country that imports most of its energy needs. And we have already been seeing on the island these price hikes for fuel, for airfares, taxi fares. The government has also, raised how the electricity prices, or they've warned how that will actually go up. Sharper increases in the months ahead. And the inflation outlook is going to be very dependent on the extent and the duration, of course, as our colleagues have been highlighting, on the energy shock. And this is, of course, coming at a time where this is a country that not only imports a lot of its energy needs, majority of its food needs are also imported. So you can see in terms of the magnitude, that could be exacerbated by higher transport costs along with fertilizer costs. And think about as well how we could just be in the early stages of the transmission as businesses pass on these costs to consumers. These cost pressures could really broaden out. So that's a sense of why we're seeing the move from the central bank today.
Yeah, the Monetary Authority right now coming out and saying that they're seeing significant uncertainty around the outlook for shipping flows with, of course, the ongoing war in Iran. They're seeing higher inflation will erode real income, crimp final demand. Not surprising, we have actually seen a weakening of the Singaporean economy with those GDP numbers as well.
Yeah, so we are expecting to see, we've already been seeing the first quarter GDP numbers. They're coming in at 0.3%, but it's not as bad as the estimate. This is, of course, the on-quarter number. And you do get the sense that the risk for growth is likely to come in from the higher inflation or electricity costs. The government has already flagged manufacturing as a sector that particular bits could be a bit more vulnerable, especially the ones that have exposure or are heavily reliant on natural gas and crude. Those are particularly vulnerable. We could see maybe Singapore benefiting a little bit from activity being diverted away from the Middle East. But it's also worth noting how you're seeing a pretty resilient picture in this print being not as bad as expected.
Success means having the right partner, right where it matters most. With 170 years of expertise, we are unlocking opportunities and driving progress across the globe. And now, we're in the heart of Egypt, your gateway to Africa and the Middle East.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
April there with the latest on MAS and watching the Singapore dollar there as well. We have seen the trade-weighted Sing dollar strengthening pretty close to the top of the policy band. So we'll be seeing if there's much reaction given that we did have the move to a steeper slope by MAS as part of that announcement. In the meantime, let's take a look at broader markets because, of course, we had that strong uplift leading from Wall Street. US stocks ending higher. The S&P 500 erasing all of its Iran war-related losses. Sentiment improved as President Trump dangled hopes of an agreement, even as the US also moved to start its naval blockade to the Strait of Hormuz. Let's get more from our Bloomberg MLive executive editor, Mark Cudmore. So, Mark, we're seeing quite a bit of sort of hope that a second round of in-person talks will take place, despite, of course, knowing that the two parties are reportedly very far apart on key issues.
Absolutely, and I think the kind of positive interpretation we're seeing from markets at the moment probably makes sense. I'm struggling to get excited by the top side from here, but I think it's also hard to sustain a kind of bearish view because it does seem like I'm sure there'll be more hiccups, there'll be more noise. We're closer to the end of resolving this conflict than we are to the beginning. That doesn't necessarily mean, though, that the Strait of Hormuz returns to the level of traffic it was of 2 months ago. And therefore, the lingering impact of the war will still be stagflationary. And that's why I struggle to get excited on the bullish upside. A few weeks ago, my kind of, mid-March, my narrative was the war will get worse before it gets better, but ultimately it'll be a big buy the dip moment because the underlying macro fundamentals are so supportive. I think my view has evolved a little bit to being, well, now that we've got that relief rally, we did get the big dip, we got the relief rally. I'm struggling to get excited because I think the stagflationary impulse will sustain, which means we're in a little bit of no man's land for stocks. There's probably a slight upward bias, but there remains kind of convexity in both directions, which means we really could get a shock move in either way, which means it's not a great risk-reward environment for short-term traders.
And these sovereign bonds right now, whether it's treasuries or JGBs, they seem to be pricing in those inflationary risks very heavily.
Yeah, actually, I think that's the much more exciting asset class right now. I think that steepening move in bond yields will continue. I continue to be worried about the long end. I think that the war is increasing fiscal pressures that we already saw fiscal expansion around the world. And it sends another inflationary wave. So I think that long end bond yields are going to continue to kind of have an upward impulse. At the same time, as we start considering the growth impact of the war, even if it gets resolved, I worry that that the front end yields might kind of come down a little bit. We've obviously priced in a lot in the front end, but now that we've got war of resolution, people are going to go, okay, there's a growth impact here as well. So I think that the steepening of the yield curves will be a dynamic that will continue globally, and there is a chance that at some point long end yields drift high enough that becomes a negative catalyst for risk assets themselves.
Right, Bloomberg MLive Executive Editor Mark Cutmore, really good to see you. And coming up next, we're live from the HSBC Global Investment Summit in Hong Kong, speaking exclusively with Group CEO Giorgio El-Hadary for his views on the Iran war, the bank's AI plans, and much more. This is Bloomberg. A broad risk-on session across markets in Asia, with the Nikkei rebounding from losses yesterday and the Kospi very, very close to that 6,000 level, gains of more than 40% over the past year. Let's discuss all of this and, of course, the risks around the markets. The third edition of the HSBC Global Investment Summit underway in Hong Kong, bringing together global business leaders, policymakers, and investors. So let's head back with the China Show co-anchors Yvonne Man and David Inglis.
Hi, Sherry. Yeah, it is getting loud, as you can tell from behind us here. So things are just kicking off here on day one of the HSBC Global Investment Summit. Of course, and we're kicking off day one exclusively with the group CEO here at the bank, Giorgio El-Hadary. George, thank you so much for joining us and having us here, of course, at your Hong Kong event. I have to start, we'll talk about Hong Kong in a bit, but I have to kind of start off with your take on what's going on in the Middle East right now, given that you were born in Lebanon, you lived there for some time, you were once the head of the Middle East office there as well. From your perspective, what do you think that this impact that this war could have on the business?
Yvonne, of course we're saddened and concerned with what's happening in the Middle East, and we're concerned not just with what's happened, but also with how long this will take. Our immediate priority really is to support our colleagues. We have more than 10,000 people working in the Middle East as a region, support their safety, security, and their well-being. And we've been doing that very actively over the last few weeks. But the important thing to say is we're open for business. We're here to support our customers. We've been, operationally resilient throughout that period, of course, following government guidance and requests, but we are open for business. We've been in this region for more than 130 years. This region has faced challenges in the past. After every challenge, this region has come out of it more resilient, stronger, and with bigger promise for the future. And this time is no different. We continue to believe in the long-term prospects and the promise that this region has. And we are here to support our clients through rough times, when there are rough times, be it those customers in the Middle East or those international customers operating in the Middle East, and we will see it through together.
As Yvonne was pointing out, I'll speak up a little bit because of the background here, where I think all your clients are in town, which speaks volumes about the volume behind it. As someone who's very familiar with the region, and you've just reiterated your commitment to the Middle East, a lot of people are wondering, as a source of capital, as a wealth hub, these big cities like Dubai, for example, what the future holds for these cities as financial centers. Do people need to rethink that, or is there nothing to rethink?
There has been a global trend of diversification of booking centers that's been taking place for a number of years now, specifically by our wealth management customers.
Right.
So they've been using booking hubs such as Hong Kong, of course, such as Singapore, such as the UAE, both in Dubai and Abu Dhabi, such as Switzerland, the UK, the US. And they have naturally been diversifying their wealth to be managed across multiple of these hubs, partly to be able to benefit from the expertise that each market brings, and partly as a matter of risk management. That trend continues. Insofar that this is, this concerning the Middle East today, frankly, we have seen very benign movement. I think the resilience of the Middle East as a long-term hub for wealth management and capital has not changed. But of course, everybody's hoping to see the end of the current conflict and praying to see the end of the current conflict soon.
You're also a global trade bank, so what do you see in terms of change, if any, of trade flows? Do you see any of that since this war erupted? And how does it differ from maybe last year when we were talking about tariffs?
So trade has certainly been disrupted. Now, it's been tariffs of 2025 have disrupted trade with the US. This time we're seeing a major disruption in trade far beyond the Middle East, but in particular towards Asia because of the Strait of Hormuz closing. We believe there are multiple hundred, probably up to 800 ships that are still locked up in the Gulf. And, of course, the passage daily, 150 ships, has dropped to maybe 5 to 10 ships at best. So that is hugely disruptive. The impact of such will be felt way beyond the Middle East, and that is one worrying factor for us, not just in price of goods, oil, refined products, LNG, LPG, but also fertilizers, metals, etc. But it's also going to be felt in the availability of such goods. And we worry that a continuation of this conflict will have that impact globally, way beyond the Middle East. Now, this being said, COVID was a bigger impact on trade flows and trade patterns, and we learned, businesses have learned how to recover from COVID. So, frankly, the moment the conflict ends, we can push on a button, and in a matter of months, we can go back to normal. But we just need to have this opportunity to push on that button.
That's a very good point to bring up, that we're coming off not just one, but two dislocations in global trade. We had COVID and we had tariffs to almost get us used to and train us for something like this. And I wonder, have you observed anything from your clients in how they've built their supply chains and trade flows to be more resilient in this sense, especially in the Asia Pacific, where we are extremely exposed to literally the Strait of Hormuz and everything that flows through there?
So, notwithstanding the challenges we're going to see with Strait of Hormuz disruption, we have been seeing a fast-growing trend of Asia buys Asia. we have been seeing exponential growth in trade within Asia and Asia and the Middle East as a big region. We believe that this intra-regional trade will add 1.8% to the GDP of the region on top of its natural growth rate because of this this intra-regional trade is not just about trade. It's driving FDI, is driving therefore investment, is driving employment, and is driving growth in various markets. It started with the China plus one trend where supply chain were meant to be more resilient, and the diversification of suppliers was meant to bring more jurisdictions where things get manufactured. And this is where India, Vietnam, Indonesia, Thailand, Malaysia, a number of ASEAN countries have benefited from these FDI flows for manufacturing build. But it's very quickly evolved into an intra-regional pattern of trade. And in 2025, Asian shipments were at a record historic high. So that is definitely a reconfiguration of trade flows that is less trans-Pacific and more intra-regional.
You've been talking to clients. What are the topics and questions that they're asking you about the situation now in the Middle East? Are they concerned about inflation? Are they concerned about stagflation? I mean, what's the sentiment like now?
So it's very timely for this GIS where we have more than 5,000 clients attending, from 40% of whom are from outside Hong Kong, and that's from 50 different jurisdictions. And apart from the main sessions, we have more than 7,800 meetings booked over those 3 days. That's one meeting starting every 14 seconds.
Okay. You're not attending each one, are you?
No, I'm not attending each one of them.
It's impossible.
I will try to get all the information at the end because that's a very rich level of information. But importantly, we've surveyed about 3,000 of our customers just before GIS during March, during the disruption in the Middle East, to assess their views. What the survey is telling us is 95% of customers now look at volatility as a feature, as a permanent feature of their operating model. But more than 90% will put more capital at risk, will put more than 90% of them will put more investments in cross-border and international opportunities, more intra-regional as opposed to international, but definitely cross-border. And more than 90% of them are still looking at growth opportunities outside their home market. And when you look at the structural growth opportunity that Asia offers, many of these customers are going to look at Asia. The vast majority of them are going to look at Asia as a growth opportunity, despite the realization that volatility is a permanent feature. And that's because our customers have built resilience. With our support, are able to predict and prepare, and therefore are here to capture these opportunities.
And I guess us being in Hong Kong as a super connector allows all of this to take place as a network. And I wonder what your assessment is of Hong Kong. You spent a lot of time here, of course, very recently. I want to get a sense of where you think Hong Kong, how far the recovery has been here in Hong Kong.
I've been in Asia for 3 months, based myself in Hong Kong and traveled across Asia. You can see it by the day, the level of vibrancy, the level of energy in Hong Kong carries on growing. I mean, case in point, what's happening this conference, it's followed by the Rugby Sevens, which is another moment of Hong Kong at its best as a global city, attracting people from around the world. But Hong Kong's role as the super connector between China, mainland China, and the world is stronger than ever. Hong Kong's role as a global cross-border wealth hub and on track to become the largest cross-border wealth hub before the end of the decade.
Success means having the right partner, right where it matters most. With 170 years of expertise, we are unlocking opportunities and driving progress across the globe. And now we're in the heart of Egypt, your gateway to Africa and the Middle East.
Equity indices built on opinions. That's the old way. The new way is Bloomberg Equity Indices. built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Is very strong, and Hong Kong's role as a major capital market, I've seen it from the number of IPOs and the performance of the equity indices, remains very, very strong. And, you know, it's a thriving economy. So we are highly convinced with the opportunity that Hong Kong offers us. And no later than October 2025, we announced a privatization of Hang Seng Bank, which we completed in January, reflecting the largest FDI in Hong Kong in its history with our $14 billion investment. But that's a testament to our belief and our conviction about the opportunity that Hong Kong brings for the group, but certainly for our customers.
And I mean, even the stock itself of HSBC here has doubled since you took the helm, Xauusd. And a lot of it has to do with kind of the restructuring that you've done in the past few years. Where are we in this whole restructuring process? Do you think you're close to being done? Or do you still see a lot of complexities that need to be reduced?
Of course, we're very pleased with the share price performance, but we don't target share price. We target revenue, profit, and return performance. And we announced in February 2025 that we're targeting now 17% plus or better return on tangible equity for 26, 27, 28 within a range of plausible scenarios. Most of the heavy lifting of our reorganization and simplification has been done. But the simplification journey carries on in a number of areas. We're blessed that we're doing this with the advent of generative AI, which is going to accelerate materially some of our plans to simplify the wiring of this bank, like the processes and procedures, the policies. So we're putting huge efforts in this space. We've set up an AI strategy. We've set
Chief
up teams.
Officer, yeah.
We've set up the Chief Officer team, which is going to accelerate all these simplification journeys. The idea for us is, if the world is complex, then we have to be agile. We have to be flexible. We have to be nimble to be able to move, prepare, and adjust as the world is moving. But I'm very pleased that some of this heavy lifting, we're at the back end of it. And the rest is going to be making the life of our colleagues much easier, and certainly ultimately the life of our customers much easier, because will be simple to deal with, will be fast, will be easier, and will certainly always be safe.
On the AI strategy, what can your employees expect, and what can your customers expect? How does that affect their lives?
Our moonshot for the utilization of AI, and specifically Gen AI, is to empower our employees, putting tools in their hands so that they are able to be a stronger version of themselves, a more productive version of them, more augmented version of themselves, and future ready. And by doing so, to ultimately be able to deliver hyper-personalized services to our customers in real time or near real time, at scale and safely. That is the moonshot. Of course, we will keep human judgment, human decisioning, and human accountability at the core, because the trust of our clients is our strongest asset, and we will protect it by all means, and this is where human accountability will sit. But it's going to be major transformation that is a journey we're all on, and our employees will be equipped and empowered with all the development and tools so that they are able to act on it and be on the journey to be future ready and help us, become that bank of the future.
We talked about the opportunities. In terms of the risks, Xauusd, what do you see as the biggest risk to your business, or at least on the horizon for you now in the next 3 to 6 months?
So, unfortunately, some of these uncertainties have initially started to weigh on general confidence. I am reassured that the resilience of our customers and our resilience are allowing us to look through some of these challenges, consider this as a feature of the new operating environment. This is a structural shift, and adapted all our strategies to be able to deal with them. So this is the reassuring and promising factor when we look forward. When you look at what is this strategic shift in our strategy, first one is build resilience, preparedness, experience and expertise play a lot. And if you put all of that, and of course, financial strength, which is what we've always cherished and protected about HSBC. But if you combine this with our expertise and experience, having operated in challenging times for more than 160 years in all the markets, or most of the markets we operate here in Asia, tells you that we're here to support our customers through the good times, of course, but more importantly through the rough times, so that they can build their future businesses and capture the opportunities.
George, we got to leave it there, but thank you so much for the time. George O'Hallery there, Group CEO at HSBC, joining us here at their Global Investment Summit in Hong Kong. Heidi, we'll send it back to you.
Yvonne and David there in Hong Kong with us, and there's much more coming up from the HSBC Global Investment Summit in Hong Kong. Stay tuned, our exclusive conversation with Schroders Group Chief Executive Richard Oldfield about the risks in private markets and client sentiment amid the Iran war. That's coming up. This is Bloomberg.
We need to understand from the data of the International Energy Agency not only what is the size of the disequilibrium between supply and demand, but also what is happening in terms of infrastructure damage. That even if the war is to stop today and the strait to open, would still have long-lasting impact.
IMF Managing Director Kristalina Georgieva on the lingering effects of the energy shock triggered by the Iran war. And of course, we continue to see the impact on the markets as well. In today's session, we're seeing a little bit more risk on sentiment permeating. The Nikkei now gaining more than 2%, along with the Kospi, which is nearing that 6,000 level. When it comes to specific sectors, we're actually seeing chips leading the gains, the likes of Kioxia, Advantes, Renesas Electronics here in Japan gaining in this session today. We, of course, had the lead-in from Wall Street with the S&P 500 touching the highest level since February. But all of these market conversations, plenty at the HSBC Global Investment Summit in Hong Kong. Our China show co-anchors Yvonne Mann and David Ingles are there with our next guest.
Yes, here we remain, Sherry. Thank you again for carving out more time from your shows. Joining us exclusively here on set, Richard Oldfield, Group Chief Executive at Schroders. Good morning and very nice to see you, sir. It's been a few months, I think.
Yeah, it has. It's great to be back with you again.
Things have changed, which I think we'll get to in a moment. But I need to ask your thoughts on what's going on in the Middle East and certainly disruptions to, I mean, markets is the surface of everything that's going on. You have the economics, you have geopolitics, and obviously the tragedy that is the war. But what are you seeing in as far as, from your perspective, is concerned, whether that's flows or disruptions to the business, indirect or direct exposure?
Sure. Look, David, I think if we park to one side the tragedy that we see going on, from an investment perspective, I'd say there are two things. Firstly, businesses, people invest when they have certainty about the future and confidence. And what we've seen is that confidence eroded in the last month. So we've definitely seen, from our business, people holding back investing outside of cash. People aren't putting money into risk assets quite as they were doing in January and February. The market was very buoyant in January and February, so we saw a sharp rebalancing in March. Markets, look, we wake up every day to a new headline. Markets find it very difficult to respond to that. We think priced into assets at the moment is the inflationary risk. But the longer this conflict goes on, the more that inflation risk turns into a GDP and growth risk. We don't see the straits opening quickly. And of course, bringing oil and LNG back online will take some time even after it does open. So markets are going to continue to be disrupted. Remaining diversified, remaining in the market, we think is important. Look, now is the time, we think, where our business really comes to the fore in active management, thinking through where you should have your assets, how you rebalance on a regular basis. But we expect to see the market disruption continuing, and the longer this goes on, I think we'll see a GDP, broader GDP impact.
So how do you position, or what's the message to clients on where to position in this market if the advice is still to stay invested?
Well, actually, it's not to panic, right? So ultimately, the fundamentals that we saw in January and February in the long run are valid, right? So we saw very much in January and February a lot of positivity around emerging markets. In this part of the world, lots of positivity about Asia. In the medium to long run, that's absolutely the right thing to be doing. In the short term, we've seen a little bit of rebalancing of assets away from that. We've actually seen a pairing of a US devolution trade, which we think, again, in the long run is actually likely to continue. But in the short term, we've seen renewed strength in the dollar because of the uncertainty. So actually stay invested, stay working with your asset managers around how you rebalance the portfolios a little bit in the short term, but stay invested with those long-term fundamentals in mind.
I was speaking with Nouriel Roubini, the economist, in a different conference yesterday, and he said we need to get used to oil having baked in a heftier premium that we're used to because of what's going on, whether that's infrastructure that's been damaged or just investors having that scar tissue of what's going on there in their mindsets. And I wonder how that changes the investment landscape if the bottom in the oil price, and if you agree to that bottom, is at about the $80 level.
Yeah. So I think we will see a while for the dollar, so the oil price to get back to a stable level. It's interesting when you look at the futures ladder for oil at the moment. My point of, if you go out 12 months, we haven't seen a long-term disruption in the oil market really priced in. Yeah. But I think it's undoubtedly true that we're likely to see a level that is higher than 80. But I think as long as we can retain it below $100 a barrel, we're likely to see continued growth. It's clearly damaging for us if oil is over US $100 a barrel for the long term.
Just overall in the industry, what we're seeing in Europe and in Britain is just a lot of consolidation among the asset management space. Why do you think this is happening? And are you expected to see more some of these big deals happening in the region?
Yeah. Well, there are. Look, I think consolidation for consolidation's sake isn't actually a smart thing. Actually, there are lots of asset managers who hold very bespoke positions, specialists in a certain area, who will continue to thrive as we go forward. Certainly, we saw since we last spoke our announced transaction with Nuveen. That consolidation is actually driven by the client. Right? Actually, we thought we needed to bring more variety of product to the client in a way that neither Schroders nor Nuveen had together. So we've created what we think is one of the best public to private platforms globally. And we are at scale in more than 40 countries around the world. Now, again, I think if you're trying to be a global asset manager and you don't have scale, that's quite difficult. And one of the things we thought quite carefully about is whether we retrenched into this part of the world, for example. But we felt being a global player was really important with that broad platform. So I think what you're seeing, particularly in Europe, is people thinking about the economics going forward and what they really want to be. And do they want to play on a global platform, a regional platform? And for us, our decision was we've always been a global player. We want to remain a global player. And we want to bring a full range of products to the client.
And you're here in the Asia Pacific, where a lot of that wealth is there's a scramble to tap all that wealth. And I wonder, when the concept of scale today is very different from this concept of scale 10 years back, 20 years back, when you have literally trillion-dollar houses managing almost everything under their house. How do you look at the future after this transaction in terms of that longer runway? And do you think you might need to rethink these strategies on a more periodic basis than what we're used to in previous?
So the combined Schroders and Nuveen will be at a $2.5 trillion asset manager. So we think we've got great scale today. About a third of Schroders' business is based here in the region. Actually, that will remain about the same as we go forward. We see it as a big growth opportunity for us. Actually, wealth, we're in a city that's actually really benefited from a flow back in on cross-border wealth in the last 2 years. You saw I think in 24, it was 231 billion of cross-border wealth came into Hong Kong. It's a really important market. We've been here on the ground for 55 years. So that growth in wealth, we want to make sure we're present. The needs are changing. Clients want more access to income. Clients want more access to private assets and private markets. So actually, we're thinking quite hard about the products we bring into the region, we create in the region with our investment teams based here and in countries up and down Asia, to make sure we are relevant tomorrow as well as we've been relevant today.
Last time we spoke, you talked about a little bit your exposure to the property challenges in Hong Kong. Can you give us an update on how things stand right now? And do you see, there seems to be signs of a nascent recovery that's going on in property now in Hong Kong?
So we've been managing our real estate exposure here in Hong Kong, as has the industry. I think we're in a much better place. We feel pretty good that we protected investors over the last few months to make sure we maximise value. And Yvonne, you're absolutely right. We can definitely see a recovery in real estate. We can see new asset classes in real estate looking quite appealing, particularly here in Hong Kong when we think about student housing as a good example. So overall, I feel better than I did, I think, in the fall last year when I spoke to you.
I want to ask you about private credit.
Yeah.
Have you noticed a change in appetite for private credit since some of these weak spots and headlines started to come out in the last few months? Or is that almost like looking for snakes on a plane? The harder you look, you will find snakes on a plane.
Look, I think the narrative on private credit has got a little bit out of hand. And actually, we haven't seen a slowdown in demand from institutional clients. I think what we have got is a misunderstanding in some places about the wrappers that people have got private credit in. Now, by definition, private credit is paying an illiquidity premium. So when we've seen funds gate recently, that's them doing exactly what they were designed to do, to protect all investors. Now, I think the question really comes about, have we put them in the wrappers for retail consumption, and is that the right thing to do for retail customers? And that's where we've seen some pullback from appetite. But in the main, institutional investors understand that illiquidity premium much better and remain focused on that asset class as a diversifying feature.
So do you think it's mostly just retail withdrawals, right? Like in terms of institutional, you haven't seen much change?
We haven't seen much change. And look, the narrative is clearly broader. And what we can definitely see, because I definitely don't want to come across as someone who's complacent, when we see volume in a market and pricing become quite tight, it has happened in history many times that underwriting standards start to slip. I think this is the time when we start to see asset managers in private credit really demonstrate their worth and whether they can create alpha from what they're doing as opposed to just holding assets. So I think now is the time for investors to be really quite careful about who they give their money to. But also ask the question, as private markets have become more and more efficient, actually you get returns where markets are inefficient. So where are the asset classes where there's more inefficiency, where you can get returns? So asset-backed finance, insurance-linked securities are all good examples of still under the private credit umbrella where you can get a broader diversifying benefit.
And as things, just very quickly on that, as things get more efficient, becomes more broadly available, do you think returns come down broadly over time?
I think they do. I think they do. And that's really the challenge for all managers of the bank. Can we really create alpha as opposed to just follow the volume trade?
Finding alpha is sometimes more difficult than... Go ahead, sorry.
Real quick one, Richard, though, before you go. Schroders announced a partnership with Apollo back in February. I mean, this was days before the Nuveen deal. Does that sort of partnership still hold, or do you have to wait for the Nuveen deal to complete?
No, it still holds. Okay. Going back to the Nuveen transaction was a transaction born out of clients, so was Apollo, right? What we're trying to do here is create two brand names to see if we can put private markets products into the UK market in a different way using both of our brands, to create products we can do on our own for the retirement channel in the UK, and actually broaden our private equity offering into the US. So again, I think partnerships born out of client need are going to continue in the future.
Richard, it's great to have you back again. Richard Oldfield there, Group Chief Executive at Schroders. Heidi.
Yvonne Mann and David Inglis there in Hong Kong. Let's get you caught up with some of the corporate stories that we're tracking this hour. Goldman Sachs posting that surprise drop in first quarter trading revenue in its fixed income unit, offering the first glimpse into how Wall Street fared during a volatile period. That result was about $800 million below the consensus estimate, prompting CEO David Solomon to accuse analysts of setting the bar too high. The bank's equity business, though, had a record quarter, revenue of more than $5 billion, beating its own all-time high by over $1 billion. That was driven by a surge in equities financing, which tends to benefit from high volatility. But Solomon says the same factors driving volatility could weigh on the outlook for the rest of the year.
2026 began with a degree of optimism. Markets hit record highs, confidence continued to build, with most clients focused on growth, strategic activity, and capital deployment. As we've said, things rarely move in a straight line. And as the quarter progressed, the macro environment started to weigh on sentiment. Volatility increased meaningfully amid concerns around AI-driven disruption in sectors like software, heightened uncertainty in parts of private credit, and the conflict in the Middle East.
American Airlines shares climbed in late trading after Bloomberg revealed that United Airlines CEO Scott Kirby is said to have floated a possible combination. Our sources say Kirby has pitched the idea to senior government officials, though it's unclear if an actual process is underway to explore a deal. A merger would create the largest airline in the world and would face intense scrutiny even under the business-friendly Trump administration. Qantas trading lower in Sydney after reporting that its fuel costs have surged, forcing it to reduce domestic capacity to cope with the fallout from the war in Iran. Just to clarify an incorrect figure we reported earlier, the airline says its fuel bill for the second half will rise by as much as $2.3 billion, not $1.6 billion as we mentioned. However, Qantas says it remains confident about fuel supplies well into next month. More ahead on the Asia trade, this is Bloomberg. Australian Prime Minister Anthony Albanese will make his second visit to Southeast Asia in less than a week as he tries to shore up fuel supplies. The Prime Minister says he'll travel to Malaysia and Brunei following last week's visit to Singapore. That's with the US naval blockade of the Strait of Hormuz threatening fresh disruptions to energy supply chains. Our next guest says regional partners need to work together on longer-term issues. Joining us now is Beck Strating, who's the director of the La Trobe Centre for Global Security. So we are seeing this scrambling to try and reinforce some of these regional alliances. Is this preparedness that perhaps should have taken place in the wake of the pandemic? And is it sort of a sense of an emergency sentiment doing that now?
Yeah, I think that is a fair assessment. There were lessons from the pandemic that may have not been learnt as quickly as they may have, particularly when it comes to issues of fuel stockpiles. So what we're dealing with now is a sense of crisis, but certainly before what's going on in the Middle East, experts have been talking about maritime dependencies and vulnerabilities, including in issues like fuel and energy and food security. Australia, as a maritime trading nation, depends significantly on open sea lines of communication and open trading routes. So some of this was foreseeable. And sometimes when it comes to these complex and interconnected security issues, there's a tendency to kind of kick the can down the road. But hopefully this crisis at the moment will allow the Australian government and other experts and leaders to think more carefully about the future and about just how complex and uncertain our future is.
And so much of that uncertainty, of course, comes down to the Trump administration and President Trump himself being notoriously volatile, right, and unpredictable. To that end, how does Australia continue to balance that traditional alliance with the US whilst having to protect its own national interests? Just looking at what could happen to the Strait of Hormuz, one of the sort of outcomes could potentially be tolls, either from the Iranian side or the US side or both. The president's floated a joint venture concept there as well. So how much power is Australia and its regional allies going to have in terms of that freedom of navigation in maritime trade?
These are absolutely crucial questions. And I think there's another question here about whether the second Trump administration is really going to compel security thinkers and leaders in Australia to reassess its security settings. So at the moment, what we're seeing is Australia take a kind of alliance plus diversification approach to foreign policy. So we continue to rely on the US alliance, particularly when it comes to our defence capabilities. And that means that Australia is not in a position to simply toss out the US alliance. But certainly the Trump administration is making some of the choices more difficult for Australia, and it can't just rely on the assumptions that it has held about the United States and the state of the United States as an international actor. And so we see the current Albanese government really looking to diversify relationships, focusing a lot on Asia and the Pacific. This is, one of the striking elements of these trips to Asia is the importance of Australia's trading relationships with the region for its security. But there are also these longer-term issues of how Australia really relates with other non-great powers, whether they're in Asia or outside of Asia, in order to shore up some of the most critical laws, international laws for Australian security. And the United Nations Convention on the Law of the Sea is of critical importance for economics and for security. And so just overnight, we saw that ASEAN leaders released a statement around just exactly this issue, the importance of maintaining open and safe transit passage.
We actually had Defense Minister Marles here in Tokyo recently promising to deepen cooperation with Tokyo. What country or countries are the best hedge for Australia when it comes to ideological and trade principles?
Yeah, that's another really important question for Australia, because as a middle-sized country, we can't do everything and we do have to prioritise and hard decisions have to be made. So I would say that Australia, even before this crisis and before the second Trump administration, had been looking to strengthen and deepen relationships with countries in the region, and Japan is a really good example of that. Through the Reciprocal Access Agreement of 2023, as an example, Australia and Japan have been getting closer, and these two countries are both allies of the United States and share a common interest in having a stable rules-based order, as leaders like to call it, that can, help with security and prosperity. So Japan has been very important. We also see an uplift in engagement with ASEAN, the Association of Southeast Asian Nations, again, of significant importance for Australia. We just need to look at Australia's geography to understand the importance of having positive relationships with our Southeast Asian nations. We also see increased interest in deepening and developing relations with Korea and also India in the region. But now I think we are also seeing an increased interest in increasing relationships with countries outside of Asia, so Canada and Europe. So the Canadian Prime Minister was recently in Australia talking about this rupture to the global rules-based order and imploring non-great powers to work together more closely. And I think it's an important message in the sense that middle powers have agency and they should use it for their own interests.
Beck, great to have you with us. Beck's Rating, who's the Director of the La Trobe Centre for Global Security. We do have more on Australia ahead every Tuesday at 10:40 a.m. if you're watching in Sydney, 8:40 a.m. in Hong Kong. More ahead on the Asia Trade. This is Bloomberg.
No, but we have a very good relationship with China. He would like to see this ended also. He certainly wants it ended. Everyone, I want to see it ended too, but we can't give a nuclear weapon to a group of people that have caused nothing but havoc for 47 years.
Yeah, President Trump speaking there as China's Foreign Minister Wang Yi also has urged the international community to step up efforts to promote peace talks between Iran and the U.S., warning that the current truce remains fragile and must be preserved. According to a readout from China's Foreign Ministry, the remarks were made during a call with Wang's Pakistani counterpart, Ishaq Dar. The China market opens are next. Do keep an eye on those semiconductors as they rally in the Japanese session as well. The China Show is next. This is Bloomberg.
Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with the top stories. Oil and gas surge while global stocks fall as US President Donald Trump threatens a full naval blockade of the Strait of Hormuz. That blockade set to begin at 3 p.m. UK time after the breakdown of talks in Pakistan. President Trump says he doesn't care whether Iran returns to the negotiating table. Plus, end of the Orbán era. Hungary's currency surges to a 4-year high after a landslide election victory for Peter Magyar sweeps Viktor Orbán from power after 16 years. Well, welcome to a new week. Happy Monday, everybody. This is the picture in markets this morning. Negativity across the board after those escalating tensions between the US and Iran over the weekend. The collapse of those talks in Pakistan already weighing on Asian stocks, down more than 1%, and on futures on both sides of the Atlantic. But the question is this just a bump in the road when it comes to the talks, or is it a full breakdown of the ceasefire framework? In fact, the negativity is somewhat pairing. So it seems like traders are perhaps choosing to see this as more of the former. More on the geopolitics in a moment, but flip the board over to the cross-asset picture, and you can also see the impact here. Brent above $100 a barrel, 102 at the moment, up 7.4%. because of this naval blockade. As I say, set to start at 10 a.m. New York time. We also have the Bloomberg Dollar Spot Index higher this morning, and we are refocusing in the bond market on inflation. The expectation that rates will be higher for longer, pushing up Treasury yields. 434 is where we are on the 10-year. Now, in terms of the risk events on the docket for today, we have the OPEC monthly oil report coming later on. That should give us some fresh insight into the damage to this energy market. We also have earnings coming stateside from Goldman Sachs, a raft of bank earnings coming this week. And aftermarket, we'll get sales and revenue numbers from LVMH. A difficult start to the year for this luxury name. They're going to have to do a lot to give a positive sense of the outlook ahead this year. Let's set you up for the day ahead. We begin with oil and gas surging after the US president vowed to begin a full naval blockade of the Strait of Hormuz and threatened to retaliate in the event of Iranian resistance. Brent at one stage rallied as much as 9.1% to near $104 a barrel. European gas futures, meanwhile, spiking at one point almost 18% after expanding trading to 21 hours a day amid the rising volatility. Well, that blockade will begin at 3 p.m. London time. The move set to halt nearly 2 million barrels a day of Iranian oil flowing through that critical waterway. And the announcement comes hours after Washington and Tehran failed to reach a deal during talks in Pakistan.
I don't care if they come back or not. If they don't come back, I'm fine. Their military is gone. Their missiles are largely depleted. The manufacturing capability for missiles and drones is largely defeated.
Let's get more now with Bloomberg Horizons anchor Jumana Basetchi. Jumana, how's this blockade going to work? Should we see parallels with Venezuela? And crucially, who's going to be part of it and who won't be part of it?
Lots of valid questions, Lizzie. What we do know from President Trump and what he has said over the course of the weekend or Sunday is that the blockade will go into effect from 10 a.m. Eastern time. That's 6 p.m. over here in Dubai, so later this afternoon. And of course, the objective here is to wrest back from Iran one of their key points of leverage. One of the points that emerged as a key sticking point of discussion throughout the course of those Islamabad negotiations over the weekend. Iran effectively wanted to maintain control over the Strait of Hormuz, and the U.S. saying that is not acceptable. And therefore, Trump coming out with this announcement yesterday suggesting that the U.S. now will start imposing a naval blockade. So what does that actually mean in practice? What they have said is that they will start limiting the vessels going in and out of the Strait. And if you look at the numbers, something that our colleagues have been tracking very closely, before the war, you had something like 100 to 120 vessels passing through the Strait of Hormuz on a day-to-day basis. Throughout the course of the war, this has trickled down to less than even 6 a day, a handful, between 2 and 6, depending on the day. Most of them are Iranian-linked. Most of them would be vessels carrying Iranian oil or countries that have cut a deal with Iran or even turned off their signals in some cases. And so what they're doing here is they're going directly to the heart of the matter and cutting off a key lifeline for Iran, especially as it pertains to Iranian oil. Our colleagues in oil estimate that it will take another 2 million barrels per day off the market, hence the reaction that we're seeing in oil today. But insofar as how it's going to be executed, President Trump has said that they will send a bunch of Navy ships to and around the Strait, both the front, the entrance, and the exit of the Strait. He's talked about interdicting any countries that actually go up and pay or accept to pay a transit fee, so therefore removing that precedent that had been set by Iran over the last couple of weeks, and then also look to start removing some of the mines that have reportedly been planted by Iran throughout the longevity of the strait as well. So, you know, there are a couple of angles that this could be administered, and then the other big question is whether other countries, and especially those countries in the region, will also partake in those efforts as well. Questions that we will get answered to in the coming days, and then of course the key one here is how Iran will respond to it, and whether this war will move to a new front, which is a maritime war, and whether these naval ships will be exposed to a possible retaliation from Iran as well.
Well, on the diplomatic side, Jumana, should markets see the weekend's events in Pakistan as a temporary breakdown in negotiations rather than a total collapse of the ceasefire framework?
I think that is probably how the market is viewing it this morning, and not least because even President Trump, in those many Truth Social posts that he put up yesterday, actually described the talks as having gone well. He said there were many points of agreement, a couple of points where they did not agree. This was also echoed by the Iranian Foreign Ministry spokesperson, who said that there were 2 to 3 points that the two sides were not able to overcome. And so we understand from the various reporting that has come through over the last 24 hours that those points pertain to, number one, the Strait of Hormuz, as we were just talking about, but then also the subject of the nuclear file and Iran's ultimate ambitions. And what J.D. Vance said before he departed Islamabad is that they did not receive sufficient assurances from the Iranian side that they would, number one, abandon their ambitions to eventually develop a nuclear weapon, and two, abandon the tools to help them get there, i.e. the centrifuges or even that highly enriched uranium stockpile that they're sitting on. So those are key subjects that still need to be navigated, in addition to the bunch of other topics that were, again, a very tall order to be capable of being resolved over the course of 24 hours or 21 hours, including Iran's stockpile of ballistic weapons, their funding of proxies around the region, and of course, one key element that Iran had been pushing for, which is the lifting of sanctions and economic relief. So putting it all together would suggest that there had been some progress made. The question from here is how the blockade is going to play out and whether the ceasefire can hold, given the new steps taken by the U.S. naval forces. Of course, that ceasefire is expected to end on April 21st or 22nd over here in the region.
Yeah, perhaps not a huge surprise that the talks failed at the first round when the two sides were so far apart to begin with. Jumana, thank you so much. That's our Bloomberg Horizons anchor, Jumana Basetji. Well, let's see how markets are reacting with Winnie Su in Hong Kong. Winnie, what are you seeing where you are? Stocks already lower, it seems.
Yeah, morning, Lizzie. Well, as you just mentioned, we're really seeing risk sentiment weakening in Asia after President Trump threatened to blockade the Strait of Hormuz. And here, MSCI Asia down about 1% after having, in fact, its best week since 2022, just last week. And overall major benchmarks all in the red. But worth highlighting that this time around, the magnitude of the decline is actually not as significant as what we saw in the past few weeks. And this is showing you how traders are getting used to these headline volatilities and also some optimism that so long as the ceasefire holds, there is still hopes for resolution somewhere down the road. Now, you flip the board and take a look at how the rebound in the US dollar also continued to pressure Asia's currencies, with the Japanese yen slightly below that 160 level against the dollar, which is the level that we closely watch for intervention risks. And when it comes to the JGB space, we are looking at the 10-year yield, in fact, fact, hitting the highest level since 1997 just earlier today. And worth noting that, interestingly, with the whole uncertainty around the Middle East, it's making the Bank of Japan's decision meeting later this month more difficult, and now it's making them more difficult to act on a specific decision. And the probability that we are looking at right now is down about 44% from 64% earlier last week. Back to you, Lizzie.
Winnie, thank you very much. That's Winnie Su in Hong Kong. We're going back to the geopolitics now. Hungary's forint has surged after Prime Minister Viktor Orban conceded defeat in Sunday's election. Incoming Prime Minister Peter Magyar has outlined sweeping changes that he intends to make after ending Orban's 16-year rule.
We won not small, but big, very, very big. Together, we changed the Orban regime. Together, we liberated Hungary. We took our homeland back.
For more, I'm joined by Bloomberg's chief Europe correspondent Oliver Crook on the ground for us, as he has been throughout this election. Ollie, a lot of superlatives here. It's the end of an era for Orban. Just give us a sense of the significance, the scale of Peter Magyar's victory.
Lizzie, I think everyone was really stunned, even the people that were the most optimistic about the potential ousting of Viktor Orban within the Magyar camp, where I was last night on the banks of the Danube, a little bit further out, when we saw just how much of a landslide, a blowout this was from the opposition leader, who staged an absolutely incredible election campaign over the last 2 years. And Lizzie, it's hard to overstate how difficult what he did is. I mean, in Hungary, Viktor Orban controls much of the media, has huge sort of structural advantages, and he still managed to win this 2/3 majority within parliament, which gives him really a free hand to legislate very freely across Hungary. But not only that, Lizzie, that 2/3 majority gives him powers to even change the constitution. So this is a position for this opposition leader coming into power here, really emboldened with a really strong mandate from the Hungarian people. And again, he's going to be inheriting some of the issues that brought down Viktor Orban, whether it's sort of the economic stagnation that we've been talking about. There's, of course, the energy shock, which has no end in sight after what we saw over the weekend in Iran. And so this is going to be a very sort of challenging, a bit of an uphill battle. That being said, Lizzie, he has called on a number of the government officials that are loyal to Orban to resign, saying that they've basically betrayed the nation. They've been loyal just to Viktor Orban. So this is really a very key moment. And I got to say, on a personal note, Lizzie, you know, you watch a lot of elections, you cover a lot of these things. This crowd last night, very, very emotional, really feeling the sort of change that we've seen after 16 years of Viktor Orban.
So what does this victory mean for the Hungarian economy? What does it mean for the EU? And crucially, Ollie, what does it mean for the war in Ukraine?
Yeah, I think, Lizzie, what's really interesting is that some of the domestic issues and trying to turn the economy around, having to legislate, trying to break the grip of Viktor Orban, as Peter Magyar claimed that he would do last night, that is going to take a lot of time. What can happen very, very quickly is a change in posture in terms of the geopolitics, in terms of the foreign policy, and that is the expectation that we're getting from Peter Magyar at the highest level. We're expecting a prime minister of Hungary that, yes, is nationalistic, that, yes, still skews to the right, but is going to be much more constructive when it comes to working with the European Union. And as a consequence, as you know, Lizzie, as we've covered very, very extensively, the only person that's been standing between 90 billion euros and Ukraine, that loan from the EU, has been Viktor Orban. The expectation now is that you're going to have a regime here in Hungary that is going to be much more constructive in dealing not just with Ukraine, but a number of different issues at the European level. That gives the Europeans a much more consolidative sort of footprint going forward in their sort of political ambitions on the global stage, to say nothing of the fact, Lizzie, that J.D. Vance came here to Hungary to campaign alongside Viktor Orban. That failed. He then went to Pakistan for those negotiations. That failed. Some real questions about the potency of Trump foreign policy.
I can hear the cheers from Brussels. Bloomberg's Oliver Crook in Budapest. Thank you so much for your coverage. Well, let's turn back to the market reaction now with Bloomberg Executive Editor Paul Dobson. Paul, a stunning election outcome in Hungary, as Ollie was setting out for us there. Could this have longer-term benefits for the euro?
Morning, Lizzie.
You might be able to hear the cheers from Brussels, but they're not looking on their Forex screens, unfortunately, because the euro is wobbling a little bit this morning, along with everything else. Because we have a stronger dollar, and that's down to those geopolitical risks tied to Iran, which we can talk to a little bit more later on. But yes, the euro overall longer term should benefit from this, not so much as the Hungarian forint, which has been flying higher at a 3-year high relative to the common currency in Europe, but outright against other currencies, euro has scope for outperformance. So, for example, it's up against the British pound today. And the reason for that is that it will, as Ollie was talking to, it will give the opportunity for more solidarity, more kind of unanimity in terms of decision-making across the euro region and across Europe as a whole, remove some of those obstacles that Orban had been throwing up in terms of that decision-making, pave the way for more unified economic structures, and therefore, re-enhance confidence in the euro as a currency. And we're hungry to join it one day, then even more so, potentially. So yes, on the short-term basis, unfortunately, looking at today's currency moves, you might not feel it, but longer term, there's definitely some relief for euro currency out of these Hungarian elections as well.
And Paul, when you step back and look at the market reaction to the breakdown in Middle East peace talks, the threats of a US naval blockade, we were just hearing from Winnie Xu. Would you agree that it's fair to say markets aren't as panicked by the bad news as perhaps they might have been earlier in this war?
I definitely would agree with that statement, Lizzie. Based on the moves that we've seen, although they've gotten a little bit worse through the Asian morning session, still that knee jerk is far less than we've seen in some of the other Monday morning moves that the markets have experienced as this war sort of takes its various twists and turns. And I think that there are a few different reasons for that. One, it's kind of, the market is used to this sort of classic negotiating tactic from the Trump administration where they escalate, make it worse, sort of, walk away from the table in order to come back to it again with a more favorable perspective a little bit later. So negotiations, I'm not sure that anybody expected the first 2 days of the talks to yield necessarily everything right at once. So got to be a little bit patient in terms of those negotiations. Yes, also there's this talk of potentially clearing the mines out of the Strait of Hormuz at some point, and that would obviously be a much bigger positive if it were to allow those tankers to flow. But we've got to keep in mind, at the moment, they're not flowing. So every day, the crude oil situation and the energy situation is getting tighter across global markets. And there will be shortages if it runs on too late. And, for all of that, it still needs some sort of diplomatic breakthrough at some point. And the idea of this new blockade from the US doesn't really help with that oil supply or those negotiations in the short term, at least.
OK, a pessimistic start for these war-weary markets this week. Bloomberg's executive editor, Paul Dobson, thank you very much. Well, it's still ahead on Daybreak Europe. Bloomberg's Francine Lacroix spoke with Wael Sawan, the chief executive of oil giant Shell. And we'll get more from that interview later on in the programme. But first, fighting continues in Lebanon ahead of planned talks with Israel tomorrow. More on that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:20 a.m. here in London. Well, Lebanese and Israeli officials are expected to hold their first talks tomorrow, mediated by the US State Department in Washington. But fighting has continued on the ground, where the IDF is maintaining its campaign against Iran-backed Hezbollah. Bloomberg's Dan Williams joins us now from Jerusalem. And Dan, just bring us up to speed on the Israeli attacks on Hezbollah in Lebanon over the weekend and how that really sets up the talks this week.
Well, those attacks have continued, as have Hezbollah cross-border rocket and drone launches. However, there appears to be a degree of restraint, at least on the Israeli side. It appears Hezbollah is firing what it can. Keep in mind that last Wednesday, just hours after the Iran truce was announced, there was a major set of Israeli airstrikes across Lebanon against what the Israelis said were hideouts, Hezbollah hideouts in various neighborhoods where they hadn't hidden out in the past. a large casualty toll, over 300 killed, apparently around a third of them civilians, perhaps more. That set off a good deal of recrimination about worry about the prospects of the Iran truce, even though the US and Israel said Lebanon is not part of that truce. So when you have a backdrop like that, the first face-to-face public peace talks between Israel and Lebanon after being decades at war, at least technically, should have been headline news worldwide. It's fairly muted, as you can tell, given that backdrop, a backdrop which has also been filled increasingly by sheer fear and a sense of bad blood in Lebanon, given Hezbollah's continued control there, politically, certainly militarily, in terms of its arsenal compared to the arsenal of the conventional Lebanese military. There is some concern within Lebanon that just holding these talks with Israel could upset the very, very delicate internal fabric. Indeed, the Lebanese prime minister, who was due separately, he said, to visit Washington yesterday, keep in mind Washington is where these talks will be taking place tomorrow, canceled that trip in short order, citing the upheaval at home. Some Lebanese even worried about a new civil war. So yes, while peace talks are generally welcome, certainly in the Middle East, certainly by this Trump administration that wants to expand the Abraham Accords, this is a pretty fraught time, and these talks in themselves are very fraught, certainly for the Lebanese.
Dan Williams in Jerusalem, thank you for the update. Well, thinking of geopolitics, we have oil in mind, of course. Brent now trading at $102 a barrel, higher 7.3%. And coming up, we will turn to these energy markets. Shell CEO Wael Sawan discussing the oil major's controversial strategy around the energy transition with Francine Lacroix. More on that interview next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:25 a.m. here in London. The chief executive of Shell says he believes his company has a big role to play in the energy transition, despite controversy over the oil major's strategy. While Sawan joined Bloomberg for the latest episode of the Leaders with Francine Lacroix podcast.
I think it's absolutely fair that we, along with the multiple other stakeholders, have a role to play in the energy transition. So customers have a big role to play, governments have a big role to play, energy producers like ourselves have a big role to play. And what we have found as a company is we have to play to our competitive strengths. So yes, we're very strong in oil, we're very strong in gas, we're very strong in trading, we're very strong in marketing. So how do we take that nexus of strengths that we have and actually contribute to an energy transition that we know is not going to be linear, that we know is going to be complex? And how do we become a stabilizing factor for our customers as they try to navigate it?
You were speaking very plainly 3 years ago, right, when you became chief executive, when some of your rivals or competitors were trying to say, like, look, we're going to be quite good. Actually, we're almost a renewables company. Like, were you just more honest than some of your competitors?
I think for quite some time, what we had been trying to do is maybe speak to multiple stakeholders. And unfortunately, that can come across as almost being all things to all people. I felt it was really important to, one, build our own beliefs around the energy system, really get clear what our role was going to be, and then just say it for what it was, recognizing that not everyone was going to agree with it, that we're always going to have also a small group of avid supporters, and that what was important was for those 80%, 70% in the middle to hear our convictions, and then most importantly, to see us follow through on those convictions. And so what we wanted to do was to position ourselves as a player that is supporting the energy of today while looking forward. And it wasn't about choosing sides. It was about finding the role that we can uniquely play to be able to address energy security, energy affordability, and energy sustainability. And people, I think some would prefer it's either this or that. And we felt, no, we are building a company that we want to be the best performing, best returning company, not just today, but for decades to come.
Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Oil and gas surge while global stocks fall as US President Donald Trump threatens a full naval blockade of the Strait of Hormuz. That blockade set to begin at 3 p.m. UK time after the breakdown of talks in Pakistan. President Trump says he doesn't care whether Iran returns to the negotiating table. Plus, end of the Orban era. Hungary's currency surges to a 4-year high after a landslide election win for Peter Magyar sweeps Viktor Orban from power after 16 years. Well, welcome to the programme if you're just joining us, 6:30 a.m. here in London. And this is a snapshot of your markets this morning. We are risk off after the geopolitical events of the weekend. The US and Iran escalating tensions after the collapse of talks in Islamabad. You're already seeing that weighing on stocks in the Asian session and on futures on both sides of the Atlantic. But mind you, the negativity is pairing because traders are digesting this question of whether this is just a bump in the road for the talks, whether it was somewhat inevitable that at the first round, with the two sides so far apart, actually it was likely that this was going to break down. So really the big question is this a complete breakdown of the ceasefire framework? And it appears that traders are judging it is not. Now flip the board over to the cross-asset picture. Of course, we also have to consider the real-world impact of that US naval blockade that's set to begin at 10 a.m. New York time. We are seeing Brent trading higher, above $100 a barrel at 102 right now, up 7.4%. You're seeing the Bloomberg dollar spot index higher as well, and you're seeing the bond market refocusing on inflation as traders see rates staying higher for longer. So the 10-year Treasury yield up nearly 3 basis points at 4.34%. Let's turn to your front pages now, and the Financial Times begins with Hungary's Orban conceding defeat as the opposition secures a landslide win. The TISA party is projected to claim a 2/3 majority in this crushing defeat to the EU's longest-serving premier. So that's on the front page of the FT. You also have Les Echos leading with that same story. In France, they have the headline translating to, "We have liberated Hungary. Peter Magyar victorious, ending Viktor Orban's 16-year rule." And the French paper writing that the historic result will have consequences for the function of the European Union. Now, let's also look at the front of the Wall Street Journal. This morning, they are focusing on the Middle East. They open with the US threat to blockade Hormuz, setting up a risky new showdown between the US and Iran. It says that the move sets off a high-stakes war of attrition that could draw American forces into prolonged struggle to control this vital waterway. We can get a roundup of all these stories and everything you need to know to get your day going in today's edition of the Daybreak newsletter, which, as ever, terminal subscribers can find by going to DAYB Go. Well, turning now to the market impact of the geopolitics. We've seen oil and gas surging as US President Donald Trump orders that military blockade on Iranian shipments through the Strait of Hormuz. The action comes after negotiations between the US and Iran in Pakistan failed to reach a mutual agreement. The escalation threatening to rattle global energy markets already upended by this conflict. Let's get analysis now with Bloomberg Middle East energy markets reporter Anthony De Paula. Anthony, good morning. Tell us what the US hopes to achieve with this planned blockade and really walk us through how energy markets are reacting.
Good morning, Lizzie. Yeah, I think the short answer is that by closing the Strait of Hormuz, the U.S. hopes to open the Strait of Hormuz. So in the sense that Iran has already got that strait effectively blocked, keeping most of the regional oil and gas inside the Persian Gulf, not allowing it to get out and get to markets. Because the talks didn't result in a deal that would allow the opening of the strait, which also didn't allow for pledges around not pursuing a nuclear weapon, which is what Trump wanted. Because those talks didn't reach that, the strait is staying closed to a select few ships only coming through. And then what Trump is saying is that he wants to blockade any Iranian vessels going in or out, stopping those ships, stopping even on the high seas. He mentioned any ships that had paid Iran to pass through, because we have reported that Iran is trying to coordinate the passage through there, in some cases accepting tolls from ships demanding tolls, but that is unacceptable to the U.S., to the U.S.'s Gulf allies here, who want that waterway free and open. So that raises lots of questions around the potential military engagement in terms of blocking any Iranian vessels going in and out, plus what vessels would the U.S. try to capture or arrest on the high seas if they've paid those Iranian tolls. We did see some Chinese tankers go through over the weekend, carrying some Iraqi crude even. There had been some vessels, even with Saudi crude, that were looking at potentially going through. So that raises questions as well. What if the U.S. captures a Chinese vessel, for example, with Iraqi or Saudi crude on it? Does that create other issues? So we'll see how that goes in about 8.5 hours from now, when U.S. Central Command has said that is going to start. And we will also be looking for what the issue is in terms of any kind of retaliation from Iran. Risk is back into the market, so we've seen oil jump up close to 10%, so we're back over $100 a barrel, but still, it doesn't seem like we're pricing in major risk into crude oil yet. So there's still some potential ways to go there as we see this unfold, Lizzie.
And Anthony, just walk us through the impact on European natural gas, which, as we know, now trades overnight, 21 hours a day from 10 hours previously.
Yeah, I think that's an aim to give gas kind of a more global trading window to allow that contract, that European contract to trade across different time zones and different markets. So European gas has gotten hammered because of this issue with the Strait of Hormuz. Europe relies on some liquefied natural gas coming out of the Middle East, and nothing is flowing through the Strait of Hormuz. As I mentioned, while we've seen a couple oil tankers, some cargo vessels go through, we haven't seen anything in terms of a laden gas tanker yet. So that's a big issue, and that is cutting off supplies to Europe and some of the damage to facilities inside the Gulf. Qatar was hit very hard in some Iranian attacks, so that's gonna impact supplies for years to come now. So that's a real issue for Europe. We've seen prices rising in terms of the European gas prices really shooting up, even more so than oil did in relative terms at the start of this war. We've seen those costs increasing for Europe, for Asia. Of course, there's a lot of gas coming out of the U.S., so U.S. prices have stayed low domestically, and the U.S. is able to ship lots of gas out to Europe. In some cases, that's been more expensive than gas that Europe has traditionally bought, be it pipeline gas or other closer in LNG. So these consuming markets are really struggling to get to grips with simply a lack of energy supply and those rising prices that are then feeding into the broader economy in terms of inflation. So it's a real challenge. More trading will help as there's more buyers and sellers that can get in that market. It's going to be potentially more transparent. Some traders saying potentially more volatile. But really the risk here is that there's less crude, less LNG, less refined products to trade, and that's bringing up prices. And that's the risk that we're seeing across markets, Lizzie.
Anthony, great to hear from you. That's Anthony DePaola. Thank you very much. Well, the US and Iran's failure to strike a peace deal over the weekend is weighing on sentiment broadly this morning. The dollar rising against major peers as demand for haven assets increases. I'm joined now by Ruth Carson, Bloomberg's chief FX and rates correspondent. Ruth, you've seen the dollar bid as soon as the opening bell rang in Asia. We're continuing to see demand for the greenback as London trading gets underway. What's driving this big dollar bid? Is it simply what we've seen throughout this war, a flocking to a haven asset?
Yeah, as soon as the trading bell started in Sydney, in Auckland, we saw the dollar catching a bid and every major currency falling against the greenback. It comes back down to that safe haven bid, and there is nothing out there that rivals the dollar when it comes to its haven attributes. At least that's what macro traders are signaling to us. It's quite interesting to see how much, a week makes in terms of difference. Last week, we saw the dollar getting a bit of pressure, selling pressure, because investors thought, there is hope of a ceasefire. But all that was U-turn this morning, and we can see investors just saying, nah, this is it. We're back to buying the dollar. It doesn't matter if currencies like the euro or the Aussie or the Kiwi look cheap. There is nothing that rivals the dollar, which is on 90% of all foreign exchange trades when it comes to liquidity, when it comes to safety. And we are seeing that bid continue into the London trading morning.
And perhaps unsurprisingly then, Ruth, we've got the euro down against the dollar. Is that just a reflection of worries about our heavy energy imports, or is there something else that traders are signalling about the shared currency?
Yeah, the euro is a very interesting one because it is the second most traded currency in the world. And as you pointed out, yes, absolutely. Europe is a huge energy importer, and that's automatically a negative for a lot of macro investors out there already. So what's interesting since the war started as well is to see how euro, which usually doesn't move by a huge amount in Asian trading, actually catch, investors selling the common currency as soon as they get in. So what does that tell you? Especially today, yes, absolutely. The euro is an easy asset to sell on the Iran war risks. And one really good function, though, to look at on the terminal is FXFM Go, and it shows you what option traders are signaling. While the euro has been under selling pressure, it's around 116, 117 on a given day against the dollar. If you input $1.20, 120 as a signal, about 40% of traders signal that, you know what, the euro dollar trading at 120, there's a 40% chance of that happening by the end of June. So people are saying that, look, it is cheap at current levels, but the question is, do you actually dare to buy it on a day like today?
And Ruth, big question, is the conflict threatening the dollar's status as the global reserve currency?
Great question. And to be honest, it is a question that is being asked about in, not just your trading desks at hedge funds, but also the long-only managers, the big thinkers out there going, look, we know that the US is upending the world order. It started with trade, and now we're talking wars here since January. So where does this leave the dollar? But the consensus view, particularly in the short to medium term, is that nothing will usurp the dollar's status as the world's reserve currency. And we're seeing it in trading action. When there is pressure, when there are risks and geopolitical uncertainty, people flock to the dollar against everything. Investors can debate about the yen, which is cheap. They can debate about the euro, which is backed by the Eurozone. They can even talk about gold. But as we have seen since the start of the conflict in the Middle East since February, nothing rivals the dollar in its supremacy as a haven, and as a result of that, its reserve currency status of the world.
Well, MLive's Skylar Montgomery Coden called it right at the start of this conflict. Bloomberg's Ruth Carson, thank you very much for all that analysis. Well, let's turn back to the geopolitics now, a bit closer to home here in Europe, and hope for Ukraine as Hungary's new leader calls for sweeping changes after ending Viktor Orban's 16-year rule. The nation, which had previously been an opponent of further EU aid for Ukraine, has vowed to ease relations with the bloc. I'm joined now by Bloomberg's Russia EcoGov editor Greg Sullivan for more. Greg, good morning. What does Ukraine actually stand to gain after the Hungarian election results? How is this likely to pan out?
Well, the biggest thing right now is that there's 90 billion euros in aid that's been held up by Viktor Orban when he was in power. And now that Petr Magyar seems to be poised to become the next prime minister, it's likely he could ease the provision of that aid that Kyiv desperately needs. Now, in the long term, you're potentially going to see a more friendly, or at least a less hostile, Hungary towards Ukraine. So Ukrainian President Volodymyr Zelensky was quick to take to X over the weekend to congratulate Petr Magyar on his win, but also to say that he looked forward to both countries working together for security in Europe. Remember, Orban actually campaigned in a very hostile manner towards Ukraine, casting Magyar as a lackey and saying that only he could keep Hungary out of the war. But with Magyar poised to take the country back towards the EU, you may see a little bit more of an accommodating Hungary than we've seen in the last few years.
OK, so optimism from Kyiv, but we had Russia and Ukraine's Easter ceasefire ending yesterday. Is there any optimism that further actions of de-escalation will follow?
Well, we did have this short Easter truce, which Zelensky said that he would mirror after previously calling for it. Both sides alleged violations of the ceasefire over the weekend, though it doesn't appear that there were any major missile or bomb attacks. Nonetheless, Russia has said that they plan to continue their attacks until a final peace is reached. So it doesn't look like there's going to be a ceasefire, even as we heard from one of Zelensky's top aides previously telling Bloomberg that he thinks the deal could be sooner. We haven't seen that optimism reflected on the Russian side. So it does appear that we're still very far apart on the key sticking points.
Okay, Greg, thank you for the update. That's Bloomberg's Greg Sullivan. Well, coming up on Daybreak Europe, Wall Street's biggest banks are set to unveil a stock trading record as first quarter earnings season kicks off amidst uncertainty over the war in Iran. We'll get you the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to some of the top stories we're following for you this morning. Ireland's government has announced a support package to ease the burden of rising fuel costs after public anger sparked a wave of protests and blockades across the country in the past week. Measures include a 10 € per litre reduction in excise duty on petrol and diesel. The relief is in addition to a €250 million package already approved, which includes increased rebates for hauliers and transport operators. In Spain, the Prime Minister, Pedro Sánchez, has begun his trip to China by calling on Beijing to leverage its influence internationally and help bring the wars in Iran and Ukraine to an end. Speaking at the start of his official visit, Sánchez also used stronger language than in the past on trade, calling the EU-China deficit unsustainable and saying that trade relations must be balanced and reciprocal. And Peru's Keiko Fujimori is poised to advance to her fourth consecutive presidential runoff, this according to initial exit polls from Sunday's election. An exit polls suggests Fujimori took 17% of the vote. But the election was marred by such disarray that voting has been extended in the capital and in 2 US cities until Monday. So those are some of our top stories this morning. Now, turning back to the week ahead in earnings, Wall Street's largest lenders kick off this first quarter earnings season today with recent market volatility boosting trading desks, but geopolitical uncertainty looming over results. Our Charlie Wells is here with a breakdown. So, Charlie, how have financial stocks been performing this quarter?
Well, Lizzie, it's been a bumpy start to the year for the largest banks in the United States. If you take a look at the KBW Bank Index, which tracks these large lenders, it's actually been the worst first quarter of the year since 2023. Now, that was the year of the regional banking crisis. So let me just kind of show you what's been happening here. Earlier in the year, we had a lot of kind of questions about the SaaS apocalypse, how that would affect banks going forward. And then you see this really big dip here. That is, of course, the beginning of the Iran war crisis. A lot of concerns about what the oil price, what inflation, what uncertainty could do for the banking sector because they had a great 2025. A lot of this is kind of coming off the back of a really strong 2025, but uncertainty about this conflict really spilling through. Let's flip and take a look at some commentary from veteran banking analyst at Wells Fargo, Mike Mayo, really breaking it down here. As goes the conflict, so go bank stocks.
And what are investors expecting to hear from lenders this week then, Charlie?
Well, look, we're kicking off with Goldman Sachs later today, and then we've got the other big lenders throughout the week. And really, look, we're expecting to see some solid numbers. It's looking especially coming from the trading side of these businesses. Equities trading in particular expected to pose an $18 billion record for the quarter. There's been all that volatility. There's been a lot of trading on the uncertainty given the conflict. But again, don't forget some of these other big issues that we really need to pay attention to. There's that geopolitical question as well, right? Because M&A, that's been such a driver for banks over the past couple quarters. But does that strength continue given the uncertainty? Deal makers don't like uncertainty. So what happens? We're going to want to listen for comments on that. Also pay attention to questions about private credit. Again, that has been in the ether. There's been a push for redemptions. How do banks take this as an opportunity to talk about this being either a fundamental risk or more of a headline risk? Analysts think it's more of a headline risk, but let's see. And again, don't forget AI. That is going to be huge on a lot of these analyst calls when they start to ask, what is the risk to banks, right? And you're seeing a little bit of a divergence here, right? You see the likes of Goldman Sachs and Morgan Stanley up year to date. They've got those strong trading desks. Their businesses are really geared toward the environment right now. You see some weakness from JP Morgan and Bank of America. they have that larger consumer unit. Consumers, again, the potential for them to be under pressure given uncertainty. So watching to see how these banks, do they diverge or do they start to coalesce? That's what we really want to focus on.
So, Charlie, we have Goldman Sachs up first in just a few hours. How might Goldman set the tone for the rest of the week?
Really good point, Lizzie, because usually it's JP Morgan who reports first, but it's Goldman this time. When you look at their revenue breakdown, you see a lot of strength coming from equities, a lot coming from FICC trading and investment banking. In this environment, that bodes well for them. But what you want to listen for, especially in that investment banking segment, what trends are we seeing in the current quarter? Not the past, in the current quarter. How is uncertainty playing into that? That is something to focus on today.
Okay, Charlie, thank you very much for the preview. That's Bloomberg's Charlie Wells. We're checking in on futures, and we have Eurostoxx 50 futures down 1.5% now, as we see US futures down as well. But in the European session, it looks like we're going to see some of the similar moves that we have seen whenever we get bad news out of the Middle East. The likes of TUI set to fall, as indicated by TradeGate, but then some of the energy names, the likes of Equinor, set to gain as we see Brent higher 7% at $102 a barrel. Plenty more coming up. This is Bloomberg.
I think that maybe, I haven't seen these tweets, but I think that may be what he's doing. And a blockade makes sense. You don't have to attack Karg Island. I don't think that was ever realistic. The point is, if no Gulf Arab oil gets out, no Iranian oil gets out. Let's see how they feel about that in Tehran.
Former US National Security Advisor John Bolton speaking on Bloomberg this weekend. Well, as you can see, the polymarket odds of an end to the war this month or by June have fallen over the weekend. June is the blue line. This month is the white line. This, of course, after the breakdown of talks in Islamabad and the US threatening this naval blockade over the Strait of Hormuz. Also on the agenda for this week, of course, we were just hearing from Charlie Wells, bank earnings front and centre, and you can see the group of banks stateside trading near historical averages right here. Now flip the board one more time, and we have the EPS growth rates for financials at 15%. So really quite impressive. If we flip the board over, you can see it's near the top of the leaderboard for financials, just behind, well, not quite just, but behind tech. Tech is 39%. Now let's take a look at the other events on the docket for the week ahead. We have the OPEC monthly oil report coming out today, and then we have ASML's earnings later in the week, and then we also have UK GDP coming out as well. But coming up, we'll discuss the prospects for a Middle East deal with Nicholas Hopton, the former UK ambassador to Iran. That's at 7:30 a.m. London time on the opening trade, which is up next. This is Bloomberg.
The moves that we're seeing in the front end of the curve, absolutely nothing shy of spectacular.
The central banks aren't taking any chances.
It is now leaning towards hikes more than cuts.
We still think the next move is a cut.
What's going to happen? And the answer is, we don't know.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Monday, facing an ultimatum. The US threatening to strike power plants unless Iran reopens the Strait of Hormuz, keeping oil at multi-year highs and gas elevated as the war enters week 4. The energy shock morphing into a bond market rupture, sending yields even higher. We begin this hour with the president's ultimatum, posting Saturday evening. President Trump writing, if Iran doesn't fully reopen without threat the Strait of Hormuz within 48 hours, the U.S. will hit and obliterate their various power plants. That deadline just hours away.
13 hours, 44 minutes, according to the president, when potentially we have this deadline, according to him, that there will be a serious escalation if the Strait of Hormuz is not opened. What is so interesting is it came over the same course of the weekend when Friday evening after 5 p.m., the president actually said they were looking at winding down, which is why you have Tehran, Gulf countries, and financial markets, Jonathan, on edge.
In this market right now, in crude, we're pricing higher for longer. This is a change. Let's check it out. Check out the front month of the futures curve and compare it to where December is trading right now. And you'll see the bigger move is taking place at the longer end of the curve. The December contract coming into this war, trading in the 60s. It's now trading close to 90 so far this morning. And the larger move at the very back end of the curve, which tells you at the moment, for this year at least, we're pricing higher for longer.
Yep, higher for longer when it comes to energy prices. That potentially means higher for longer when you look at the gasoline pump. I checked AAA this morning. We are just a hair, a smidge away from $4 a gallon across the national average. And all of this, Jonathan, is for the fact that people are starting to wake up and realize even if the Strait of Hormuz does become open, the damage is done. IEA's Fatih Birol said more than 40 energy sites across 9 countries in the Middle East have been severely or very severely damaged. It is going to take months to get them back to operation.
We've been tracking this as follows with the following framework. Take the energy shock, push it through the bond market. Energy shock, bond market rupture. Check it out, 2s, 10s and 30s. Yields at the front end of the curve rising for 5 consecutive days. In 16 trading days, we've had a 60 basis point move and we're just short of 4% on 2s this morning. Higher for longer in the energy market, higher for longer in the bond market.
You have to think, is this where potentially the president starts to wake up and feel yippee? Remember, it was Liberation Day. It was around these levels when he started to get concerned about his policy. He didn't like this idea of the question of the Trump put, would you reverse policy? The problem he has now is he is only one party to this conflict. And if he wanted to reverse it, he is going to need the Gulf Arab countries to get on board, the Israelis, and of course, another party, and that's the Iranian regime.
We've got a lot to work through this morning. We're kicking off Monday morning with futures, negative 0.75% on the S&P. Coming up this hour, Jeff Yu of BNY with stocks under pressure. Norman Rule of CSIS as President Trump gives Iran an ultimatum. And Michael Hay of SocGen on how crude could hit 150. We begin this hour with our top story. President Trump threatening Iran with an ultimatum to reopen the Strait of Hormuz by later this evening. Bloomberg's Jemana Basenji joins us now for more from Dubai. Jemana, that deadline just around the corner.
Yep, and the entire region is on edge. I will say it was interesting that we heard from the U.S. Treasury Secretary Scott Bessent over the weekend, and he said sometimes it's necessary to escalate in order to de-escalate. But what we're seeing right now is who has escalation dominance. So essentially what we know is President Trump put up that Truth Social post on Saturday evening, 7:45 p.m. Eastern Time, threatening Iran to reopen the Strait with no threats. And if they did not follow through on that, then the U.S. would not hold back at striking Iranian plants. Now, Iran was quick to respond the next day, and they said in turn that if the U.S. followed through on that threat, they would then strike back once again at key energy infrastructure in the region, alongside information technology and desalination infrastructure as well. And let me just spend a moment on that, because to what Anne-Marie was saying, if you look back, and the war has been going on for 24 days now, the IEA are saying there are 40 sites, 40 energy sites in the region up until now that have been damaged or severely damaged by the Iranian attacks. They're also saying that desalination plants could be a target here. That would be a game changer for the region, because depending on which country that you're looking at, about 70 to 90% of the water is derived from these desalination plants. So there is a lot of nervousness about whether President Trump is actually going to follow through on that ultimatum. It translates to around middle of the night over here in the region. So we'll see what happens over the next 24 hours. But irrespective of that, I think what's become clear from all of this is Iran have realized the leverage that they have over the Strait. And it is not what they say shut, it's effectively under their control. President Trump is trying to reduce the chokehold that they have over it, but with limited appetite from allies to get involved. You know, we've heard from the NATO Secretary General of the weekend, Mark Rutte. They said that they're working on a plan to help assist the U.S. with the maritime mission. But ultimately, the situation we're in now is it is still effectively shut. And as long as it's shut, you're going to continue to see this upward push on global energy markets. Plus, you have to factor in the ongoing damage that is being sustained at many of these energy sites. And even just this morning, ADNOC, which is the main energy operator here in the UAE, they too are saying that they're going to have to start limiting LNG production. So the knock-on effects are continuing. As we head into another key ultimatum, the next 24 hours will be crucial once again.
The pressure is building. Jemana, stay safe. It's good to catch up as always. Bloomberg's Jemana Basenji there, leading our coverage out of the FT over the weekend. Check out this out. Volume of gas cut off is double what Europe lost from Russia in 2022. More oil lost now than the twin shocks of the 1970s. Fatty B-roll calling this, quote, the greatest global energy security threat in history.
It's basically this two-pronged approach what we have right now in terms of LNG being taken offline as well as actual crude barrels, which is why he's saying it's these two massive energy shocks of the past, 1970s most recently, 2022, confounded in one crisis right now.
Here's the view on Wall Street so far this morning. Jeff Yu of BNY writing investors are increasingly fatigued by the lack of resolution. The risk of further market adjustments is rising, not fading. Jeff is welcome for more. Jeff, welcome to the programme. We've seen a major adjustment in energy. We've seen a major adjustment now in the bond market. How far along are we in the adjustment process for equities?
I think no one really knows at this point, and we're looking at EM this morning pretty much given up all its gains for the year. I think the first phase is pretty much done, and what I mean by that is the overheld positions, the high-performing positions, you know, your careers of this world, they have basically given up this year's gains. But that's the first phase. The next phase is now we look at the impact on balance of payments, the impact on margins. Do we move into an outright correction mode where you've not only given up your gains for the year, but you move into an outright loss and a severe loss? I think that's the next phase where markets are looking at, and we just don't know what resolution even looks like at this point, and I think that's where the focus needs to be.
Jeff, many are shaken by memories of 2022, stocks down, bonds down. What are the risks of a repeat of 22 for the year ahead?
So here's where I'm pushing back against market pricing right now. I look at this morning, 4 hikes from the Bank of England this year. Seriously? Right. So I'll just give you one figure here. The UK savings rate right now is approaching 10%. In 2022, it was barely 2.5%, 3%. So households have been retrenching for several quarters now, not just in the UK, but in Europe. The place in the cycle for Europe is very different compared to 2022, where we still had this post-COVID demand expansion. So that's where I think markets are really pushing the envelope a bit in terms of what they think central banks can do. They've learnt their lessons from 2022, 2020. They're saying the right things. So I think central banks are going to be as hawkish as possible without hiking. That, at least, is the impression I got from last week. So I think that's where some correction is needed as well. It's not all doom and gloom, same as 2022.
Yeah, Jeff, I'm with you, because 22 was a shock for the market, not a shock for GDP. This feels different coming into 2026. This could be a real growth shock. At some point, the outlook gets so bad it's bullish for bonds. Are we close to that point?
I don't think we're there yet, because, as you said at the top of the programme, they're looking for resolution, but also, you know, what does resolution look like and what does the supply chain look like up ahead? I'm actually, in terms of prices, I'm looking at food prices right now, less so perhaps in developed markets, but in emerging markets. Again, what has been a high-performing element. Australia has announced that so one of the ammonia plants, which is key for fertilizer, supplies 5% of the world's fertilizer. That's going to shut down for about 2 months. That's going to have a knock-on impact. India, Bangladesh, these countries, large fertilizer producers, they need it as well. India's asking for fertilizer from China. So this is where I think the knock-on effects could drive inflation higher, not just in EM, but globally, and that will feed through down the supply chain into CPI as well, something we need to keep an eye on. So does that actually introduce capacity to cuts rather than not hiking is something that will be uncertain as well.
Jeff, I'm glad you brought that up, because it's not just LNG and it's not just crude oil, it's helium, it's fertilizers, and you're looking at the immediate inflationary shock of that. But long term, isn't that also a growth shock?
It absolutely is a growth shock, and as you stated, helium, that's crucial. Japan, I think, announced last week they had about, 2 to 3 months worth of helium supplies left. I think markets want to look at how much helium is in South Korea, in Taiwan. Why? Because crucial to manufacturing chips. And if we think about the AI theme, you know, that's really been driving US growth, you know, global tech-based growth. If that starts to constrain this theme, which until now has been like one of the positives for the global economy, if that starts to unwind, then the growth shock, you know, could be larger than expected as well. So again, right now we're in the phase of understanding, you know, what the secondary, tertiary implications are from all of this.
Makes it really difficult to understand the risk reward in equities right now, Jeff. So let's talk about the price of the story. 5%, 6% away from all-time highs. Is that attractive yet to you?
So again, we don't know, where this and how this ends, and we have to define that. So if it's going to be, so put it this way, in terms of scenarios, starting to look attractive, absolutely yes. But if the knock-on supply effects drives up costs over, let's say, a sustained 12 to 18-month period, let's leave the demand side from the household out of the equation for a second. That will impact margins, right? If helium's going to be more costly, if other input prices are going to be more costly, then we have to factor in that discount into equity markets as well. If it's going to be short-term production issues, 2 to 3 months, as has been stated, then I think it's manageable. Anything more prolonged, if we're talking 6 to 12 months, then a discount is needed.
Hey, Jeff, it's going to catch up. As always, Jeff Yu there, FBNY, out of London this morning. We've had the energy shock, the bond market rupture in play, and now we're trying to calculate the growth scare. That's where the market kind of is coming into this week.
And when it comes to the growth scare, you need to think of crude oil and how long potentially these high inflated prices will last. And then at some point, does that trickle down to other parts of the economy, to goods and services? You look where diesel is, it is very elevated right now, and that is going to have an effect on a number of issues. And then you take into account helium for semiconductors and fertilizer for plants. This is why this is going to be incredibly difficult for politicians as well as for policymakers.
Speaking of politicians, gasoline basically at $4 a gallon now on average in this country. That's a big change in the last 3 weeks or so. Equity futures on the S&P negative here by 0.7% on the S&P 500. With an update on news worldwide with your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Iran is carrying out a fresh wave of attacks across the Persian Gulf ahead of President Donald Trump's deadline to reopen the Straits of Hormuz. Trump delivering an ultimatum to fully reopen by 7:44 p.m. Eastern tonight, after which he's threatened strikes on Iran's power plants. Iran is threatening to mine the entire Persian Gulf, not just the Straits, if the U.S. or Israel attacks its islands or coastline. Here, New York's LaGuardia Airport is closed until at least 2 p.m. Eastern following a deadly accident. An Air Canada Express plane with 76 people on board collided with a fire truck shortly after landing last night. The pilot and co-pilot died in the crash, and 13 people were hospitalized with injuries. And the U.S. is deploying immigration agents to airports to help ease delays caused by a budget impasse. Border Chief Tom Homan says the agents will perform non-significant tasks and won't be using X-ray machines or scanning luggage. TSA employees have gone unpaid for 5 weeks due to the partial government shutdown, leading to lengthy delays at U.S. airports. That's your Bloomberg brief. John.
Yahara, thank you. Thank you very much. More from Yahara later this hour. Up next on the program, escalate to de-escalate.
We have demolished the Iranian capabilities, and every day we are taking out their missiles, their missile systems, and the factories that build those missiles. Sometimes you have to escalate to de-escalate.
A conversation up next with Norman Rule of CSIS, live from New York City this morning. Good morning. Three-day slide on the S&P becomes day 4. Equity futures negative by 0.8% following a 4th consecutive weekly loss on the S&P 500, the longest in more than 12 months. The epicenter for the pain, you know it well, crude, WTI and Brent. WTI overnight trading in triple digits, 99 so far this morning, up by 0.9%, up on the month by 40 to 50%. And this stock down on the month by something like 15. United Airlines, the corporate reality check going into the weekend. United put out a statement. Got lots of cash compared to COVID. Balance sheet's good, demand is tremendous. But take a listen to this from them. Jet fuel prices have more than doubled in the last 3 weeks. If prices stayed at this level, it would mean an extra $11 billion in annual expense just for jet fuel. For perspective, in United's best year ever, we made less than $5 billion. The warning from the airlines.
It's getting very expensive, and this is a warning from United Airlines here in the United States of America. These warnings already came almost immediately in Asia from some of their airlines because they feel the energy shock first. They are front lines of energy shock, and now for the airlines, it has gone global in terms of how much more expensive they realize the jet fuel is going to be. You know what that means, Jonathan? Higher ticket prices.
They're planning for the worst and hoping for the best. Bramo will have more on United Airlines when she's back with us tomorrow morning. Look out for that. Under surveillance so far this morning, escalate to de-escalate.
We have demolished the Iranian capabilities, and every day we are taking out their missiles, their missile systems, and the factories that build those missiles. And now General Kane, Secretary Hegseth are leading a campaign to destroy all the fortifications along the Straits of Hormuz. Sometimes you have to escalate to de-escalate.
So here's the latest this morning. President Donald Trump giving Iran an ultimatum to reopen the Strait of Hormuz or have its power plants bombed. Anne-Marie, Iran launching fresh attacks across the Persian Gulf just hours ahead of that deadline later this evening.
So they're launching French attacks, and they're remaining very defiant in terms of some of the rhetoric we are hearing out of the country. So they are saying that all energy, information technology, and desalination infrastructure belonging to the U.S. and Israel are targets. They are saying that also they will completely continue to close the strait if this continues. And then this one, Jonathan, caught my attention. The head of Iran's parliament says that any U.S.-linked financial institution holding American government bonds, U.S. treasuries, would be targets alongside military bases. So potentially what they are saying is that if this were to come to fruition, they would start attacking banks in the Middle East and to American partners and Arab partners and Israel if the president comes through with this ultimatum he has.
This has been a feature of the past 3 weeks and change. When we say Iran, who are we talking about? Who actually has a voice? Who is leading this effort right now, this response to retaliation we see across the Gulf? That one person? Someone else? When we say Iran, who are we talking about?
That's a great question, because when the president is asked about this, he says he doesn't even know who is running the country. Obviously, we have the new supreme leader. He is injured, according to reports, and we have not seen him, even though we have had Persian New Year. Normally, traditionally, you would have this video statement or speech from the supreme leader. We only got a written statement. So that is very curious. But when you look at when it comes to the regime, head of parliament, the foreign minister, the president, all of them are out front.
Here's the take from Norman Rule, the former senior U.S. intelligence official and senior advisor at CSIS. He writes the following: if the U.S. executive executes strikes on Iranian power plants, civilian infrastructure would become a primary battlefield and oil would reprice sharply for an extended disruption scenario. Norm joins us now for more. Norm, welcome to the program. Can you help set the stage? What are we set up for later this evening?
Good morning. So 3 weeks into the conflict, a new battle space dynamic has been created. Despite the extraordinary campaign results of the United States and Israel, the Iranian government has survived. So the war has evolved from a Gulf shipping and gas infrastructure crisis into a deadline-driven strategic depth and civilian critical infrastructure contest that openly involves control of the Strait of Hormuz with all energy systems, regional power infrastructure, desalination systems within a potential escalation envelope. Once these systems become explicit targets or even threat objects, you in essence have a situation where the market will now need to price in not only the crude and liquefied threat to natural gas, but also the reliability of electrical systems, water security, repair times, and the higher probability of allied burden sharing of all of the Gulf Cooperation Council partners.
Norm, when the president puts out a statement and has this ultimatum about opening up the Strait of Hormuz, or he's going to go after power plants, do you think that statement would come from the President of the United States if he was unwilling to do so?
No, I believe the President of the United States has a serious intent of taking a greater action against Iran. I also believe that U.S. Forces in the region are more than capable of executing the President's wishes, but they would prefer to undertake these actions when the conditions are most appropriate. Now, they can do whatever the President requires. Fully opening the strait would require a reduction of Iran's UAVs, its drone threats, and probably undertaking more action against the Strait of Hormuz's Iranian infrastructure, and waiting until we have the full contingent of additional Marines and perhaps some additional air assets.
Norm, you've been in the room. The president will have a number of options in front of him. There's reporting over the weekend that he mulls Karg Island, a takeover of that island that's just some miles off the Iranian coast. Can you go through all the options right now you think are being presented to the president?
Well, I prefer to avoid all of the options in that perhaps the Iranians are watching and giving them a school answer may not be the best of ideas, but it's likely that the president's overall approach is to convey to the Iranian government that they're about to lose control and the revenue from their most strategic asset, and that idea is going to ripple through the strategic leadership of Iran's government and compel them to push for negotiations and to make concessions on several points, which is in essence to give up the idea of nuclear weaponization, the enhancement of their ballistic missile program, the Quds Force activities within the region, and to return the Strait of Hormuz to international control vice their control.
Nom, there is some speculation that a ground operation could be imminent. Can we go into the realm of speculation together and talk about the geography, a geography that you know well? How difficult would a ground operation be in a place like Iran?
Well, I'm not sure the issue is of difficulty. U.S. forces are extremely capable. All ground operations have a lethal component, and no one should diminish the threat to U.S. forces. I think you want to ask instead what the ultimate goal might be. What is the purpose? Are we trying to retain territory? Are we trying to send a message to Iran that we can take territory? Are we trying to destroy key facilities? The question is, what message are you trying to send to the Iranian leadership? We've already sent the message that we can destroy anything in Iran. We can control any physical space in Iran. We control the skies, which means we control the ground.
Norman Rowe with CSIS. Norm, thank you, sir. Appreciate it. Of course, the objective at the moment of the conversation, taking Karg Island.
Absolutely. That was the reporting over the weekend, that this is what the president is weighing, potentially going after Karg Island. We've already hit, the U.S. military has already hit military installations on Karg Island. Potentially what would be next was taking control of it and then having complete control of the Iranian economy lifeblood. 90% of their crude gets processed on that island.
We often have this conversation. The president backs out when things get tough. Backs away, changes course. Saw it last year. According to so many people in this market, gasoline prices getting closer to $4. No sign of him backing down. Massive moves in rates over the past week. No sign of him backing down. Conflicting statements, yes. A conflicting statement going into the weekend on Friday after the closing bout. Then he said something else on Saturday evening. But ultimately, no real sign that the U.S. military is backing down and backing out.
So Friday after 5 p.m. when I saw the markets closed, and then I also, of course, saw the president's truth, I thought maybe this was the moment he wanted to back down. And then that was completely reversed with his next statement saying that there was going to be this ultimatum to the regime. You need to open up the Strait of Hormuz, relax your control. You know, you have to let every vessel in, not just the ones that you deem friendly, or there is going to be serious consequences. So right now, that is why everyone is on edge.
Right now, futures negative by 0.9% on the S&P 500. Up next, Michael Haig of SocGen on why time is working against oil markets. Plus, Yahara has your morning movers. Mining stocks sinking as the war in Iran weighs on metals. For the last 3 weeks, every Monday has started Sunday evening, and it started with this. What's the price of crude? This is the price of crude. WTI and Brent. WTI briefly, triple digits, 99 this morning. Brent crude, let's call it 114, a 50% move in 16 trading days through the month of March. Amazing. That's the energy shock. Here's the bond market rupture. Huge moves at the front end of the curve as we price out easing and begin to price in hikes in certain countries. Stateside, just short of 4% on a 2-year yield, up by 60 basis points in just a few short weeks. And in the UK, up more than 100. That's a major, major bond market move. That's the bond market rupture. Now let's talk about the potential growth scare. On the S&P 500, down every single week so far this month. We're down 5% from all-time highs. Within the S&P 500, refiners up by 17%. Consumer discretionary down by 7%. To what extent have we repriced growth sufficiently for the shock in energy and the shock in bonds?
And you know what, Jonathan? It's not just the shock in energy. It's not just potentially that gasoline prices are going up. We are just there when it comes to $4 a gallon of gasoline, just a hair away, and I imagine it's going to hit that tomorrow. What happens when all this starts to creep through the supply chains? Your food costs, other goods, potentially even services becoming more expensive. And you have to think, central bankers around the world, remember, just what happened in 2022 when they said this inflation was transitory. Is it, or is this going to be more engrossed in the supply chain?
Big question for Governor Myron of the Federal Reserve later on this morning. The biggest dove on the committee is going to join this programme at about 8:45 Eastern Time. His first conversation following that dissent, that push for a 25 basis point interest rate reduction at the Fed's last meeting. What's the argument now for lower interest rates with the market pricing in higher rates?
I imagine the argument he will make is actually that this is, and it's not a good one. No one wants to hear that this maybe potentially in the short term is inflationary, but you are that concerned that it is going to be an economic shock to the supply chains, and it's going to be lower growth and maybe at some point for some of these companies, layoffs.
Governor Myron, 8:45 Eastern Time. Don't miss that conversation as we count you down to the opening bell 3 hours away. With your morning movers, Yahira has more. Hey, Yahira.
Hi, John. We are seeing mining stocks under pressure this morning as they track gold's decline, down for a 9th straight session and coming off of its biggest weekly drop since 1983. And in silver, we are seeing an even sharper move as you're seeing how rising yields are pulling money out of the precious metals trade. And no surprise, as you gave that market check on oil, that we are seeing oil stocks surging this morning as we continue to see oil push higher. Brent up for a 5th straight session with no de-escalation in sight when it comes to this war. As we've been talking about all morning, Iran striking sites across the Persian Gulf, even as it faces that ultimatum by President Trump to reopen the strait by tonight. And I will say Cheniere Energy is benefiting from an upgrade by analysts at Morgan Stanley, so that stock outperforming up 4.3%. And another bright spot in this market is Synopsys. Shares are up 1.6%. Honor reporting that activist investor Elliott Management has built a multi-billion-dollar stake and is now pushing the company to better monetize its chip-making software, because this is a business that is at the center of the AI build-out, yet has not kept pace with some of the broader chip names. John?
Yahira with the latest. Yahira, thank you. More from Yahira later this hour. On our radar this morning, Iran threatening to lay mines across all routes if the Persian Gulf is attacked by the US or Israel. Iranian officials saying, quote, the entire Persian Gulf will be practically blocked. Elsewhere, Iran carrying out fresh strikes across the Middle East in the hours ahead of President Trump's ultimatum to fully reopen the Strait of Hormuz. The UAE reporting new drone and missile attacks overnight. And finally, US allied countries pledging to lead a multinational effort to help secure the Strait of Hormuz.
22 countries, most of them NATO, but also Japan, Korea, Australia, New Zealand, Bahrain, the UAE have come together to answer the president's call to make sure that we secure the free sailing through the Strait of Hormuz.
President Trump previously blasting NATO allies for failing to act, with Rutte saying it's only logical European countries need a few weeks to come together.
So right now they're talking, and he talked about how he is in constant conversation as well with the president. But to that last point you made, Jonathan, this comes after the president blasted NATO allies and saying that NATO is nothing but a paper tiger without the U.S. involvement. Now you see the European allies and some other Asian allies talking about it because they might not have a choice. If energy prices continue to go higher, they might need to do something in terms of this coalition to try to reopen the strait.
It really hasn't been a great start to the relationship between NATO and the US. And I would be more specific, I would say European partners and the United States. Going after Greenland the way the US did at the start of the year, I think upset a lot of people. The comments on the way out of the World Economic Forum questioning how committed their allies were 25 years ago in the war in Iraq and in Afghanistan, and the amount of tours that individuals did, NATO allies, that fought on the front line, shoulder to shoulder with US military officials, and yet the president questioned whether they were on the front lines at all. And here we are. We don't need NATO, we need NATO, we don't need NATO, we need NATO.
It's a little bit confusing, and to that point, this just might be too much for European allies, especially British troops, which did a tremendous amount of work in fighting alongside American troops in Iraq and Afghanistan. You also have to remember, I believe it was the Vice President, J.D. Vance, who told European allies, this is an individual who obviously has been very critical of the Iraq war under Bush, has said maybe it was the European allies should have had more of a stronger backbone and stepped up to the United States. Well, I think some capitals in Europe are actually saying, we have our backbone, we don't agree with this Iran war, and maybe that is why we're not going to send this coalition.
Let's stay on the energy story. Crude hovering around multi-year highs. Michael Haig of SocGen writing, with each passing day, the market grows more strained. With no resolution in sight, prices could climb towards $150 a barrel in April. Michael joins us now for more. Michael, welcome to the programme. Your note was one of the first notes I read to start the week. Scenario B. We're very close to what you call Scenario B. What was Scenario A, and what does Scenario B look like?
Scenario A, first of all, good morning. Thanks for having me. Scenario A was our base case scenario at the start of March. The market was pricing in a very quick resolution to this conflict. So our Scenario A was that we see the straits opening up by the end of March, but prices getting up to $125 a barrel. Looks like we're going to have to adjust that, move to Scenario B, where we have this conflict continuing through April, and that brings oil solidly up to $150 a barrel.
Michael, are you now pricing higher for longer? That's not just a short-term story, that's a long-term problem?
Yeah, unfortunately, that seems to be the case, because every day that goes by, oil taken off the production makes it harder to come back. Obviously, infrastructure gets more and more damaged. So, yes, higher for longer, I'm afraid.
Michael, this was an issue for the equity market, the issue. I think the source of comfort was we had extreme backwardation in the futures curve. Yeah. And for people who aren't in your world, that just meant the front month of the futures curve was really elevated, but the market was pricing a short-term problem, and we had this steep drop-off through the rest of the year. You see this playing out this morning, the opposite. We're starting to lift the back end of the curve, starting to price in the higher for longer scenario. Michael, this raises the question of demand destruction, so-called demand elasticity. What are the realities for the energy market? When does that destruction creep in?
So, well, there's one thing to not being able to afford oil because the price is too high, and the other thing is not being able to get the oil, and that's the bigger concern. So, generally speaking, from a price perspective, and when we talk about demand elasticities, the oil market is fairly inelastic. That means that when prices go up, people really can't change their behavior that much. So, given the fact we've had about a 50% increase in oil prices since the end of February, that would ordinarily mean, from a price perspective, you would lose about 1.2 million barrels a day of oil demand as people can't afford it. If we go to the $150 scenario, then we'd be talking over 3 million barrels a day of oil demand destruction because of the price effect. But as I mentioned, it's not really just about the price, it's about that some countries can't get the oil. So you're already seeing airlines put on surcharges, cutting flights. You see refineries in China cutting their runs. You see ethanol crackers cutting their output because they can't get the feedstock. So there are some countries in Southeast Asia that maybe have 15, 20 days of oil and product in inventories. So we're going to get to a situation potentially where we get demand destruction because these countries can't operate as normal.
Michael, to that point, we have SPRs around the world. Different countries have their own strategic reserves when it comes to crude. Are you basically talking about the fact that we might have the crude, but it's so dislocated in the market right now, there's not going to be enough refining capacity to, say, turn that crude to diesel or jet fuel?
Yeah, I mean, we're talking 17 million barrels a day that has been displaced. I mean, if you look back historically, we've basically had 30 geopolitical conflicts since the early 1970s, and the next biggest disruption to supply was all the way back in 1973 when we had 7% of oil being removed because of the Arab oil embargo. Now we're talking 17% being removed, so it's a massive difference. So, you know, all you need to do is take that 17 million barrels and say how much can be redirected through pipeline, how much can be we offset through demand destruction, how much can come from the relief from Iranian sanctions on floating oil, et cetera, and you add it all up, and you still have a massive deficit of around 8-9 million barrels a day. And that means that can't get to the refiners in Singapore, elsewhere. They can't create the product, and that creates the issue for gasoline, jet, diesel, mainly in Asia.
Michael, the way you talk, I'm thinking this is not going to be months. This sounds like a multi-year recovery. Is that accurate?
I don't think it would be as drastic as that, but you know, as each month goes by, we're talking several more months to recover. You know, the market's very resilient and it will bounce back, and there is plenty of oil out there in terms of spare capacity, generally speaking. So, you know, if by some miracle this was resolved tomorrow, and all the oil came back into the market, we might lose like 1 or 2 million barrels a day because of the shut-ins, because of infrastructure, etc. But generally speaking, going into this, we were in a surplus of, let's call it, about 3 million barrels a day. So fingers crossed this doesn't go on through past April, because I think if we can get through that, by the end of the year we'll be back to kind of normal.
Michael, this is starting to creep into base metals. Let's just turn from energy to things like aluminum, to copper. We've started to see some big moves there as well. How far along do you think we are in the process of trying to understand how cyclical the demand for those metals actually is at a time when a lot of people are getting bulled up on these secular tailwinds coming out of technology?
Well, I think, let's think about copper here. I mean, we said before this conflict that there was some unusual demand situations going on in those metals markets, given the growth of AI, etc., but also because of strategic stockpiling, because of military spending. So I see a very bright future for those metals from that perspective, because coming out of this conflict, I still believe there'll be a push to do more strategic stockpiling for things like copper and aluminium, just like we have for oil. We'll see more military spending. That's very metal intensive. So, despite the fact that they get pulled down because equities get pulled down, I think their future's pretty bright.
Can we finish on gold? Michael, 20% move so far this month. Huge, huge move. What do you think's behind that move? Is it just an interest rate move driving people out of gold? Is there something else at play?
So I think what's going on there is that we don't have any central bank buying right now. I don't think there's any appetite to do that, where countries are squarely focused on getting through this energy crisis. I wouldn't be surprised to hear reports that some central banks have sold gold in order to subsidize some of the energy issues that they have in their countries. So it's been a big pause, I think, in that buying. That's mainly the reason why we've seen it sell off. ETF flows by themselves couldn't explain the dramatic decline in the gold price that we've seen recently. Of course, some of it is fundamentally based on interest rate expectations, etc. But again, a bit like the base metal complex, I think once we get through this oil situation, and with gold prices where they are right now, I would imagine central banks resume their buying.
Michael, good to see you. Thank you, sir. Michael Haig there of SocGen, working through what's happening in energy, what's happening in base metals and precious metals. Gold down by 5% on the session just today.
This is so interesting when it comes to gold. All these central banks that were hoarding it up. Well, why do you do that? For a rainy day. And potentially they are the ones that are right now out there selling, because they need to move funds around in their government to help when it comes to the energy shock that their consumers are facing.
Right now it's pouring with rain, that's for sure. Let's get you an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. Iran has until 7:40 p.m. Eastern tonight to open fully the Strait of Hormuz, according to a threat by President Donald Trump. The president saying if Iran does not comply, the U.S. will bomb its power plants. Iran countering that it will completely close the strait and target all energy, technology, and desalination infrastructure linked to the U.S. and Israel in the region. The U.S. saying it will not reschedule a summit between President Donald Trump and Xi Jinping until the Iran war ends. Politico reporting the U.S. will propose new dates for the meeting after the active part of the conflict is over. Trump had previously said the summit would happen in 5 or 6 weeks. And Cuba says the country is preparing for a possible military assault. The country's deputy foreign minister making the comments as President Donald Trump increases economic pressure on the government in Havana. Trump saying Cuba could be the next U.S. target after what we saw in Venezuela and Iran. That's your Bloomberg Brief. John.
Yahara, thank you. Thank you very much. Up next on the program, upending expectations.
Markets definitely have priced out the Fed easing that was expected just a few months ago. Higher inflation would tell you to raise rates. Lower growth would tell you to cut rates. So maybe you just don't do much.
Up next, Stephanie Roth of Wolf Research, live from New York City. You're watching Bloomberg TV. Another morning of big moves in financial markets worldwide. A big conversation about 2 hours away. We'll catch up with Governor Stephen Murrin of the Federal Reserve, dissenting, pushing for an interest rate cut at last week's meeting when the market is starting to sniff out an interest rate hike. We'll get into that in a moment. Check out the bond market move. Twos at 4%. For the first time since June, up 11 basis points on the session so far this morning. The upper bound of Fed funds, 3.75. and we've got a 2-year yield trading north of 4%. We'll get into why in just a moment. Turn to the equity market with that move. Equities down by close to 1 percentage point in the S&P 500. The Nasdaq down by 1.1. The Russell down by 1.5. Under surveillance this morning, upending expectations.
We've essentially taken out 3 25 basis point rate cuts from market expectations over the next 12 months. Markets definitely have priced out the Fed easing that was expected just a few months ago. Higher inflation would tell you to raise rates, lower growth would tell you to cut rates, so maybe you just don't do much.
So here's the latest this morning. Treasury yield surging to 8-month highs. Traders betting the Fed could hike interest rates to combat energy-fueled inflation. Stephanie Roth of Wolf Research writing, the US rates market is too hawkish. We would put nearly 0% odds of a hike versus the market's 30% odds. Stephanie joins us now for more. Steph, good morning.
Good morning.
Priced out the easing, started pricing in hikes. What's going on?
The market is pricing in a much more hawkish Fed that I just don't think is the reality. And if they end up hiking in the near term, they're going to be cutting pretty significantly following that because they're going to cause a recession.
What do you think's behind this move then?
I think it's a couple things. One, it's a connection back to 2022 because in a similar scenario, we had an oil shock and ultimately the Fed had to hike pretty significantly, but the economy is different. If you look back to then, the unemployment rate was 3.7 falling to 3.5. Payrolls were running at 600,000. Now they're running 0 to 50. And inflation at the time was 5.5%, core inflation, and now it's 3. So the backdrop is incredibly different. There's no way the economy can support this type of energy shock without having some sort of demand destruction.
What is your baseline for inflation for the next 12 months?
We're going to, on core inflation, we'll sit a little above 3%. I don't think we're going to get maybe 10 basis points boost to core. And then that will probably come off because we'll end up seeing a demand destruction. When you see airline prices rising 12, 15%, there's going to be some sort of reduction in demand at that point.
Let's go through the sequencing of things, though. First and foremost, the Fed chair comes out and anchors inflation expectations. Sounds like that's goal number one for him in the news conference. And then people start to speculate whether the Fed shifts to a more symmetrical posture. Basically, the communication is there's more chance, as much chance as a hike as there is a cut. Have we got to that part of the sequencing yet? Because I think that's what we're working through at the moment.
Yeah, I mean, I think towards the end of last week, it was more symmetric around hike versus cut. Now it's nearly pricing in a full hike here.
That's where the market is. That's not where the Fed is yet.
No.
Does the Fed start to entertain the prospect of hiking interest rates to anchor inflation expectations in the next few months? And if they do, from a market perspective, is that something you want to step in front of?
I think they might have to do the opposite because we're getting a real tightening of financial conditions here. So at some point in the near term, they might have to come out and say, we're not really entertaining a hike in this backdrop.
So you think the Fed will squarely look through the inflationary shock of higher energy costs and look at, to your point, demand destruction, which basically means lower growth?
I think they're ultimately going to have to. Maybe for now they don't want to get too much ahead of it, but rates have moved so much, I don't imagine they're feeling very comfortable with the amount of the sell-off that we've seen. So they might want to come out and more clearly say, we're not entertaining hikes at any point in the near term.
So if they're not entertaining hikes, that means you think we're going to see a cut fairly soon?
Yeah, I think in the back part of the year, it's fairly likely we'll get a cut. September, perhaps December.
This is the communication dance, though, that I think is really difficult for the Federal Reserve. Let's say Chairman Powell comes out, he's got a conversation, an interview this morning with whoever, with Bloomberg Surveillance. He doesn't, I wish he did, but he doesn't. And he comes on the program and he says, yes, this is an energy shock, we're going to look through it. What do you think is going to happen to the market then? They're going to price in much higher inflation expectations over the next 12, 18 months out, without a doubt. Which is why, from a communication perspective, I understand why Chairman Powell came out in the news conference. First and foremost, look to anchor inflation expectations and pretend that he's a hawk, even though it's unlikely he's going to hike interest rates. And that's, I think, the communication problem for the market right now. That's what a lot of people have got to wrestle with. That the headlines coming out of the Fed over the next few weeks won't sound like the headlines coming out of the ECB.
Yeah, I mean, you had Waller out on Friday, who's been one of the most dovish voices out there, stating real concern about the inflation backdrop and the closure of the Strait. But I think ultimately the Fed is going to have to become a lot more dovish in the medium term.
So how many cuts do you think the Fed's going to have to deliver? Let's say 2027. What kind of things are you thinking about now off the back of the energy shock, tightens financial conditions, yields go higher? What kind of cuts do you expect in 12, 18 months out?
I think we're talking 2 to 3 cuts. I don't think it's going to be, provided that they don't end up certainly hiking in the near term. I think then we're talking recession-type territory. But provided that this all kind of works out and energy prices eventually stabilize, then we're talking about a couple of cuts. There's a legitimate chance, though, this ends the cycle, provided that the energy prices stay significantly elevated through much of the summer. Then we're talking about a more significant risk of cuts.
So coming into this year, everyone's bullish. There's a few reasons for it. Tax refunds part of it, all this tech spending another. Do you see this move starting to upend some of those bullish tailwinds?
At the margin, but I think we're still looking at an economy that's fairly steady. Provided that the energy shock eventually in the next couple of weeks, there seems to be some sort of off-ramp, but that's very much hinging on oil prices remaining at or below $100 through much of the summer. So I think that's kind of the way that we think about it. If you see oil prices continue to spike, we're talking about $150 through a lot of the summer, that's where the dynamic changes a lot. But provided energy prices stay kind of around the $100 range, then our estimates on 2% GDP can still remain through the rest of the year.
Stephanie, good to see you. It always is. Thank you. Stephanie Roth there of Wolf Research. I think the Fed watchers are scratching their heads, looking at the move at the front end of the yield curve, because they know the bar to actually hiking is really, really high. Market participants have had a different trade on. They're taking that trade off. So the bond market's been totally whipsawed, and they're facing the prospect of Fed communication changing in the next several weeks, and probably don't want to be on the wrong side of that. Because if the Fed headlines start sounding like the ECB headlines, then you've got a problem if you're on the wrong side of that trade.
Absolutely, and you make the point. Even if Powell was to come out and say, well, you know what, we're less concerned, we're going to look through this, what happens to inflation expectations? He almost needs to come out with a little bit more of that tougher talk to keep those expectations in line.
We'll talk to Governor Myron about this. I think if you're not the Fed chair, and if you're not a key member of the Federal Reserve, you have the luxury of saying things that the Fed chair can't. So if you're a governor or a regional Fed president who's thinking, I can look through this shock, we probably need to cut interest rates further down the line, that's a conversation you can have. When you're the Fed chair and your words carry a different weight, first and foremost, as any central bank official, leader, you have to come out and anchor inflation expectations. And that's the sense of what I got from Chairman Powell at the news conference just last week.
And to Stephanie's point, Governor Waller, who we all thought was going to descend, his mind was changed after he realized this strait is essentially closed and not opening up anytime soon.
We'll keep looking at this. Massive move at the front end of the curve. 4% on twos for the first time since last June. Just south of that level right now. A move of 60 basis points on the month so far. Unreal. Up next on the programme, Tracy McMillan of Wells Fargo, Mark Short, the former Chief of Staff to the former VP Pence, Ellen Wald of the Atlantic Council, and Colin Martin of Charles Schwab. The second hour of Bloomberg Surveillance just around the corner.
This is a really uncomfortable time, I think, for investors.
You look at the paper markets, they've entirely disconnected from the physical market.
This war is far from being resolved in any sort of positive manner.
We may see a de-escalation at some point that allows energy prices to come down.
We got to take stock and try to be prepared for any potential outcomes.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Another Monday morning that started on Sunday evening. Wild swings once again. Futures down by 0.75% on the S&P. Over 3 weeks of trading, we're down by about 5% on the S&P 500. We're down again this morning on the Nasdaq by 0.9. In the bond market, a 60 basis point move at the front end of the curve in just 16 trading days. Up 10 this morning, north of 4% for the first time since June of last year. Off the back of this, WTI overnight, triple digits this morning. WTI and Brent look like this, 98.50 and 112.75.
What we're seeing right now, Jonathan, is the market starting to realize that this might not be quickly wrapped up, even if Iran decides they want to reopen or allow more safe passage of other vessels through the Strait of Hormuz. Why? Because you see a number of energy facilities that are hit. IEA's Fatih Birol said more than 40 energy sites across 9 countries in the Middle East have been severely or very severely damaged. Potentially this means longer disruptions, which means higher oil prices for a lot longer throughout the rest of this year.
Higher for longer in the energy market, higher for longer in the bond market, a tightening of financial conditions, and the conversation shifts. I think in the last week it started to turn. Growth scare. Consensus view of this market, short-term disruption, wouldn't take long. Coming out the other side, you'd see crude prices start to fall off. You saw that in the futures curve. Deep backwardation, i.e. at the front end of the curve, crude's really high, Physical market even higher. Further out, the further you look, the lower prices go. That curve's starting to lift at the back end of the curve now, closer to 90 from 60 only a few weeks ago.
Because it will be months until things get back to quote-unquote normal. And amidst all of this, we've really had a roller coaster when it comes to the president's truth account. Friday night, just after 5 p.m., Jonathan, the markets closed. It wasn't a great night for the markets. We're getting very close to meeting our objectives as we consider winding down the operation from the President of the United States Friday, just after 5 p.m. Saturday, 7:44 p.m. If Iran doesn't fully open without threat the Strait of Hormuz within 48 hours from this exact point in time, the U.S. will hit and obliterate their power plants. So now we have an ultimatum in the market, and that ends this evening.
That's 13 hours away. And if you're in this market right now, do you want to be long stocks? Do you want to be short crude, knowing that in 13 hours' time, this could go aggressively one way or the other, depending on what the president has to say?
And I think if you're the president of the United States, you do not send out that truth if you are not willing to do that. And there was a lot of speculation and reports over the weekend from the Wall Street Journal, from Axios, that the president is weighing whether or not to fully take control of Karg Island, basically controlling 90% of Iran's oil facility. That is just off the shores of Iran. Even if he were to do that, though, does that mean that the strait is open? We've been talking about with a lot of analysts on this program, the asymmetric risk of a ship going through that strait, whether it's drones or whether it's mines.
That's the headline risk going to this evening. Equity futures down by 0.8% on the S&P. Coming up this hour, we'll catch up with Tracy McMillan of Wells Fargo with stocks on a 4-week losing streak. Mark Short, the former chief of staff to the former Vice President Mike Pence, discussing President Trump's ultimatum. And Colin Martin of Schwab revising his outlook for Fed rate cuts. We begin this hour with stocks adding to losses as the war in Iran is showing no signs of slowing down. Tracy McMillan of Wells Fargo writing, if the S&P 500 approaches the 6,400 to 6,500 range, risk-reward starts to improve based on expectations that the conflict is measured in weeks, not months. Tracy joins us now for more. Tracy, welcome to the program. We've talked about it a million times on this program. Energy shock, bond market rupture, growth scare. Where are we with the growth scare?
Good morning, John. Yes, so we're at a position now where we think that growth continues in the United States. However, we do see higher energy prices, inflationary pressures starting to diminish that potential growth somewhat through the end of the year. However, we do see this conflict still measured in weeks, most likely. And what that means to us is that there's probably going to be an inflationary bulge that moves through the data around mid-year and then starts to look more comfortable to markets and to the Fed by the end of the year. So we're telling investors to look through a lot of the headlines here and take advantage of opportunities that the market is giving us.
Where do you think value is being created? Where are opportunities opening up at the moment?
Yeah, so we tell our investors that it's important to have a diversified allocation. So that includes equities, it includes fixed income, real assets, and alternatives where that makes sense, because that gives us the opportunity to sell high and buy low. And right now, those opportunities to sell are in commodities, in energy, in the energy sector, and moving some of those assets from commodities into equities, and within the sectors, from the energy sector moving into financials, industrials, and utilities.
Just getting a statement from the president, Tracy. Anne-Marie's going to go through that statement. The headlines across him right now. I can tell you the price action reversing up by more than 1% on the S&P 500. In the bond market, yields were aggressively higher. Yields have pulled off those highs. The 2-year virtually unchanged on the back of this, and crude turning much lower. 94 on WTI, Brent at 108. Anne-Marie, what's the president got to say?
So the president is saying that he's postponing strikes against Iran power plants, that talks with Iran are continuing, and he told the Department of War, what he says, this is the DOD, the Pentagon, to postpone those strikes. He's talking about the fact that they've had talks with Iran regarding how to end these hostilities, and these talks have happened over the past 2 days. He says this postponement, putting a bit of a timeline on it, a different timeline now for the president. He's talking about the postponement will last 5 days and has instructed the entire Department of Defense to postpone all strikes against Iran. Jonathan, this is a major de-escalation coming from the White House.
So let's go through this statement. It's on social media, posted just moments ago, and you could see almost immediately the markets start to turn around. I'll read it in full for you. I'm pleased to report that the United States of America and the country of Iran have had over the last 2 days very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East, based on the tenor and tone of these in-depth, detailed and constructive conversations, which will continue throughout the week. I've instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions. The president in that statement just moments ago. So let's work through the asset classes. A complete turnaround from where we were 5 minutes ago. Start with equity futures. We'll go stocks, bonds, and then commodities. Equity futures on the S&P 500 higher by more than 2 percentage points. A massive move in the equity market. In the bond market, yields were higher at the front end of the curve by more than 10 basis points. Now they're lower by 3 to 387. And in commodities, a huge turnaround there too. We were up. We were trading at triple digits overnight on WTI. Now we're trading at 91. We're down by 7% on the session on WTI. On Brent, we're down by 8.
Remember, Jonathan, coming into this morning, what we had from the president was an ultimatum by 7:44 p.m. this evening that if Iran did not open the Strait of Hormuz, he was going to strike Iranian power plants. And then a ton of rhetoric coming from Iranian officials, especially across X and a number of social media platforms. Now the president is saying, and he's pleased to report, he says, that they've had good and productive conversations. My question is, who exactly is he having these conversations with? But he's saying, based on the tenor and tone of them, they want to take it down, take the rhetoric down, and take the strikes down. He's talking about basically a 5-day period of the détente between Washington and Tehran. A lot of questions about what the Gulf Arab partners have to say about this. A lot of questions if Bibi Netanyahu is on board with this. But at this moment, the president is clearly trying to de-escalate the conflict.
So my response would be, okay, these are the words of the president. Where's Iran on this matter? Who are they speaking with in the Iranian government right now? Is Iran on board? That's the next headline you're waiting for off the back of some of this. Tracy, I'm assuming you're following this conversation right now. Big turnaround in financial markets. Tracy, this is almost impossible to trade. Coming into this morning with this massive ultimatum hanging over this market, and I said before these comments dropped, it's so difficult to be long a market when you know you could get whipsawed in one direction or the other. Tracy, is this sufficient enough for you to take risks this morning?
Yes, we are taking risks. We're actively rebalancing portfolios back into those areas of the market that have sold off. And this is just another illustration of how fluid the situation is and how quickly those opportunities come and go for investors. So it's really important, we think, at this time to have a shopping list ready. And when those opportunities arise, start to invest.
Tracy McMillan of Wells Fargo. Tracy, thank you. Breaking down some of these market moves. Let's go through it again. A few moments ago, the President of the United States posting on social media the following: I'm pleased to report that the United States of America and the country of Iran have had over the last 2 days very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East, based on the tenor and tone of these in-depth, detailed and constructive conversations, which will continue throughout the week. I've instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions. Off the back of this, a big turnaround in financial markets, starting with stocks. Equities higher by 2.8% on the S&P 500 after being lower by almost 1 full percentage point going into that headline. In the bond market, yields 3.4% for the first time since last June, now back to 381 and down by 9 basis points at the front end of the curve. You're seeing wild moves throughout this market. We'll turn to crude, of course, driving absolutely everything worldwide at the moment. Brent and WTI. Brent and WTI look like this. WTI was trading close to triple digits. It's now trading at 86.88 and down by close to 11.6%. Brent back below triple digits at 99.95 briefly, down by more than 10%, around $100 a barrel on Brent after being close to what, 114 going into these headlines?
This is absolutely an insane move in terms of the markets across the commodity sphere, as well as also across rates and what's going on in equities as well. The president clearly wants to de-escalate this situation. But Jonathan, I have a ton of questions regarding this Truth Social post from the president. I want to know who he has been in discussion with in terms of the Iranian regime, given the fact that their top brass has been absolutely decimated. And also, if the president is saying he has instructed the Pentagon for 5 days to not strike Iranian power plants and energy infrastructure, does this also mean Israel is on board? Because we saw Israeli attacks very early this morning in Iran. A lot of questions remain. And the president is also talking about the fact, Jonathan, that these talks need to continue in a good way, an optimistic way for the next 5 days in order for there to be this, I would call, a mini détente. Well, who is talking to who? What sort of timeline? How are they talking to each other? Is there going to be a meeting? Lots of questions.
That's the next headline we're waiting for. What's the Iranian response to the president's declaration just moments ago? This is what we'll do on the programme. We'll go through the market moves for you. We'll get you an update from Washington, D.C., and we'll head over to the Middle East and hopefully touch base with Jumana Basechi in a few moments' time as well to find out what the Iranian response might be to a statement like that from the President of the United States. In the meantime, let's get you an update on this and more. For your news worldwide with your Bloomberg Brief, Yahira joins us now for more. Hey, Yahira.
Hi, John. As we were discussing a de-escalation in the war with Iran, President Donald Trump posting on Truth Social, the United States and Iran have had very good and productive conversations regarding a complete and total resolution of our hostilities. I have instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure over a 5-day period. But ahead of that, EIA Director Fatih Birol saying more than 40 energy assets across 9 countries in the Middle East have been severely or very severely damaged by the war. Birol adding the damage to oil fields, refineries, and pipelines means it will take some time for them to come back online. And another top story here, New York's LaGuardia Airport is closed until at least 2 p.m. Eastern today following a deadly accident. An Air Canada Express plane with 76 people on board collided with a fire truck shortly after landing last night. The pilot and co-pilot died in the crash, and 41 people were hospitalized. The NTSB is launching an investigation into the incident. That is your Bloomberg Brief, John.
Yahira, thank you. Up next on the programme, escalate to de-escalate.
We have demolished the Iranian capabilities, and every day we are taking out their missiles, their missile systems, and the factories that build those missiles. Sometimes you have to escalate to de-escalate.
We're getting that de-escalation this morning. Equities session highs on the S&P 500 higher by 2.7%. Up next, Mark Short, the former Chief of Staff to the former VP Pence from New York City this morning. Good morning. A statement from the President of the United States shaking up financial markets worldwide. Check it out this morning. I'm pleased to report that the United States of America and the country of Iran have had over the last 2 days very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East based on the tenor and tone of these in-depth, detailed and constructive conversations which will continue throughout the week. I've instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions. Coming into this morning, there was an ultimatum hanging over this market. The president looking for an off-ramp.
The president looking for an off-ramp. He chose this off-ramp of de-escalation. He's saying that there have been talks, the first I'm hearing of it, the last 2 days between Washington and Tehran, which is peculiar, of course, because every time you've spoken to the president, you see reporters asking this question. He says he's unsure who's actually running the country. You have made the point, Jonathan, and this is critical. We need to understand from the Iranians, that is the next statement this market's waiting for, about what exactly was discussed. Is this really a 5-day détente potential that the DOD will not go after Iranian power plants and energy? Or potentially is the president just trying to put some optimism back in financial markets.
It's almost impossible to trade this market. Look at these moves. Equity futures up by more than 2% on the S&P. On the Russell, up by more than 4%. The airlines are absolutely flying, forgive the pun, in the pre-market. In the bond market, 2s, 10s, 30s. Two-year yields were through 4%. 20 minutes ago, 381.79. We're down 8 basis points now in the session, and the bigger moves in crude. WTI and Brent, WTI overnight, triple digits. Right now, 88.80 and down by about 10% on WTI. Brent crude down by 9.9. And I have to keep going back to all of this. The statement from the president is one thing. The details matter. Who's he speaking with? Who in the Iranian government right now they're having these in-depth talks that they're so encouraged by? And two, where's the response from the Iranians this morning? They're the headlines I'm looking for, and I imagine most market participants are looking for as well.
I'm scouring Twitter to try to see what the head of the Iranian parliament, the president, Peshkian, or the foreign minister has to say, because these individuals have been the ones that have been responding to the president's truth over the course of the weekend. Just think about how Friday started, Jonathan. Friday evening, markets didn't do well. The president coming out saying maybe we're going to wind down, and then it was back to escalation in terms of this evening. We're supposed to have this ultimatum.
Let's get to the coverage from the Middle East. Joining us now, leading our coverage, Jumana Basechi. Jumana, whipsawed by headlines. The reaction, please, to this one.
Well, I mean, quite the development and perhaps the tackle moment that markets were looking for. But as you and Anne-Marie were saying, we haven't had a response from anyone in Iran yet. So let's just wait and see whether these conversations that he has alluded to have actually been taking place. And also, as we've been flagged in prior reporting, what the Iranians have been asking for in terms of the outcome that they're looking for from negotiations. In past, they've referenced the fact that they want to get security guarantees, or guarantees rather, that the U.S. will not strike Iran again. And they have maintained that they would like to see an outcome in which they can still effectively control the Strait of Hormuz. Of course, that is an outcome that is unacceptable to the U.S. and also to Gulf states. But that being said, I think one thing that is clear here is, and we spoke about this last week, the attack on civilian infrastructure, and specifically the Israeli airstrikes on that gas field in Iran, was deemed to be one step too far, a red line for the U.S. And remember, President Trump tried to distance himself from that. The fact that he went one step further this weekend and implied that the U.S. may hit energy infrastructure and power plants in Iran was also deemed to be a red line for Gulf states because of the potential reprisal and the impact that that could have on the region, not just on their energy infrastructure, but also on desalination plants as well. They're buying time here. He's pushing it back by 5 days. But whether this is going to lead to a big diplomatic breakthrough, still a big question. We have to hear from the Iranians.
Yeah, Jumana, stay close. When we get that reaction, no doubt you'll have it for us first. Jumana Basechi there out of Dubai. Mark Shaw, the former Chief of Staff to the former Vice President Mike Pence, joins us now for more. Mark, welcome to the programme. 20 minutes ago, we were having a different conversation about ultimatums, and now it's something else. How would you characterise that statement from the President?
Well, look, Jonathan, the president likes to hold all the cards, and he certainly likes to negotiate publicly, as you saw through the weekend. But, I kind of feel in some ways, it's not a perfect analogy, but somewhat similar to the aftermath of Liberation Day. I think we know the president watches markets closely, but not just equity markets, also bond markets. And you've seen treasuries continuing to go higher. And as we head to the midterms, the number one issue for American voters remains affordability. And so certainly if energy prices stay escalated, that has an impact. But if you also are seeing treasuries continue to rise, then I think that has an even greater impact on mortgages and a lot of other things. And so I think that the president is clearly de-escalating here. I mean, to y'all's point about it'll be interesting to see how Iran responds, but if we've essentially basically debilitated much of their offensive capability, I'm not so sure that that is as critical. I mean, I think there's a question about the authenticity about the negotiations, but at the same time, I'm not sure it makes as much difference how they respond if the president is taking his foot off the gas.
Mark, that's what I was going to ask you about, the authenticity and how this is so different from Liberation Day, because the president was almost negotiating in the open with himself when it comes to Liberation Day. He was able to control that lever in terms of how high tariffs would go. With this, you have Israel involved, which as of this morning, we're continuing to target Iranian facilities, and the Iranian regime. Is this potentially just an empty statement?
I don't know, Emery. I think it's hard for Israel to get out in front of the United States on this. I think there's no doubt that Netanyahu has looked at this opportunity ever since October 7th to defend Israel and to take offensive measures. But at the same time, from an international perspective and feedback internationally, I think he really can't get too far out in front of the President of the United States on this. And so I think that the President does hold a lot of the cards here. And, you know, we'll see if there actually does generate some sort of movement in the Straits of Hormuz, or if that, I think, is the crux of the issue to watch over the next 5 days.
Mark, what's driving him? Financial markets or the midterms?
I think that he's probably less concerned about the midterms. I think, Henry, that normally I think you'd look at this and say, hey, look, do you really want to go through impeachment again? But I don't think that really concerns him as much. I think he views it as I've overcome that. I don't think he's ever really worried about others on the ballot as much as himself. And so I think this is more about market reaction. I think he's concerned about the economy. He's concerned about affordability. And look, I think that in some ways, I think the president's success in lowering energy prices in the first year of his administration, in some ways, I think masked much of the cost of his trade agenda. And I think that now that energy prices have spiked, I think some of that will come out is a more detrimental to the president. So I think that's what's really his focus here, is addressing the affordability issue.
Mark, it's good to see you. Thanks for jumping on and reacting to that breaking news. Mark Shaw there, the former Chief of Staff to the former VP Mike Pence. The president looking for some form of de-escalation. Signal matters. A concern may be about what's happening in financial markets, but I think we have to draw a comparison and contrast between Liberation Day. It's not Liberation Day. There was no retaliation. There was no war on Liberation Day. It was the president. He could dial the lever up. He could pull the lever back. It was in control almost entirely of the outcome in financial markets. This is different. Iran has already come out and said over the past week or so that they want to make it so painful this never happens ever again. And Iran's response in that way is absolutely critical this morning, and that's the headline we're waiting for now.
And also now Iran for sure knows what the President of the United States pressure points are. Higher yields, Jonathan, and much higher energy prices, especially during an election year.
Well, this morning, following those headlines, we've got lower yields. We're down by 4 basis points on a 2-year, around 385. Equity futures much higher, up by 2% on the S&P 500. Up next, Alan Wold of the Atlantic Council on the prospect for talks in the Middle East. This is the kind of financial market we're all in at the moment. That you can have a market completely turned around and whipsawed by one social media post from the President of the United States. And here is that post from 30 minutes ago. There was a big ultimatum hanging over this market. If Iran didn't reopen the Strait of Hormuz, the US would bomb Iran power plants, decimate them. We've seen these headlines all over the weekend. And we had just 12 hours left before that headline, that ultimatum expired. And then this drops. We're going to postpone the strikes against Iran, postpone them for 5 days, because the talks have been so constructive and so good with our Iranian counterparts.
News to me that there were even talks happening the past 2 days. So a lot of questions immediately. Who exactly is the president talking to, or who are his envoys like Steve Witkoff or his son-in-law Jared Kushner actually talking to? Which is why you were right to point out immediately, Jonathan, we need to understand and wait for a statement from the Iranian side to understand almost the authenticity of these talks. If true, though, the president is saying that there will be 5 days, or maybe he is just buying more time for himself and the DOD. He's saying there will be 5 days of postponement of military strikes against Iranian power plants and energy infrastructure. It also is interesting that he only mentioned those two. Energy infrastructure and power plants are other targets potentially still on the list.
I got this message from a Bloomberg subscriber just moments ago in real time. Everyone's following this. 1, it's news that there are talks. 1. And 2, it's news there are even people to talk to. That seems to be the takeaway from some market participants this morning.
I've gotten a tremendous amount of message. People saying he's tacoing, others saying we can no longer say taco. Stop using that term. This is diplomacy in action. Another person asking me, who is the president talking to if we decimated the top brass of the Iranian regime, and we have not physically seen, we've only seen statements from the new supreme leader. There are individuals potentially. Steve Witkoff's counterpart really was the Iranian foreign minister. He has been very prolific on Twitter, as has the Speaker of Parliament, as has the president. These are politicians. Potentially, these are people, if the president is saying there actually were talks, and we know authentically we find out there were, these are the individuals I imagine the U.S. is negotiating with.
So let's work through the price section off the back of the statement from the President of the United States. Futures higher. They were down by 1%, now higher by more than 2%. On the Russell, small caps outperforming, up by 4%. Airlines flying in the pre-market, banks are too. The energy names that had rallied over the previous few weeks giving up some of those gains. In the bond market, 2s, 10s, 30s shaping up as follows. Yields were higher, particularly at the front end of the yield curve. Briefly this morning, through 4% for the first time since June, now back down to 3.85. And in the commodity market, the main event, of course, WTI was trading in triple digits overnight. It's now at 90, and we're down by 8%. Struggling to keep up with all of this. Let's get you some morning movers, some single names. Danny has more. Hey, Danny.
Hey, John. The whipsaw on these names has been remarkable. All of the travel stocks rallying pretty significantly. To be fair, they're not making up for the losses that we've seen. Carnival, for example, is down nearly more than 17% since the war broke out. United is down more than 12% since the war broke out. But all of these names rallying at least 5% off the back of that Truth social media post from the president. The flip side of this, you mentioned this as well, John, it's the energy stocks that are also up double digits since the war broke out, but they move lower alongside the price of oil. Cheniere Energy down almost 4%, Oxy down 2.8%, Devon Energy down 2.3%. Now, not all the moves are logical, but they are happening fast and furious. I want to show you what memory chip stocks are doing, because they have also erased their losses and are now rallying. These stocks have been selling off at the Kospi. The Kospi today closed down more than 6% as some positioning unwind happened because of the fears over the war in Iran. Again, these aren't necessarily directly exposed to the war, but memory chip stocks were down hard. They too turn around, up as much as 2.8% in the case of SanDisk. John?
Danny, take a breath, get some rest. We'll see you in about 60 minutes' time. Who knows where we'll be an hour from now. On our radar this morning, President Trump posting a major update to the war in Iran, instructing the Pentagon to postpone any and all strikes on Iranian energy sites following 2 days of productive conversations with figures in the country. Who in the country? We still don't know. Elsewhere, crude rolling over after President Trump's post. Brent and WTI falling by double digits before paring some of those losses. And finally, the IEA reporting more than 40 energy assets across the Middle East have sustained severe damage, with refineries and pipelines being choked off. Officials are expecting long-term hits to global supply chains.
So this is where the problem is. Even though you see the energy markets, financially, the paper markets absolutely whipsawing, in the physical market, it is no longer just about the Iranians controlling the Strait of Hormuz and essentially it is closed for most vessels. It's the fact that now actual energy facilities have been disrupted to a point where it is going to take months. And for some of these facilities, like in Qatar, it is going to take years to get them back up to where they were. And that is why you have the IEA coming out with a little bit more of a concerning tone about where the energy space is going, because it's not just what's happening present day. It's 5, 6, 7 months, even 12 months out in terms of potentially the hit to supply chains when it comes to certain commodities.
Can we just sit on this social media post from the president? It's always difficult to get into someone's mind. I don't know what the motivations are. I don't know who they've been speaking to. We're going to have to wait for the Iranian readout of whatever's happened here. But I can tell you that based on the communication I'm having with Bloomberg Terminal subscribers this morning, a number of them who have written to me already, there are severe doubts and a lack of trust with the administration right now as to whether these talks have happened, are happening, or even will happen over the next 5 days.
That's exactly what I'm getting as well. A number of people saying he is tacoing, but is that even real? Also, he has said there's no one to talk to, so who are these talks with? I will tell you, Jonathan, we do not have a statement yet. Iranian officials haven't yet commented. They haven't confirmed that there's been discussions, but there is a headline right now running on Iranian state TV that says, quote, U.S. President retreats after Iran's decisive threats. They're saying they're retreating after Iran's threats. That signals to me potentially there are going to be questions about the authenticity of these talks.
This is the latest from the president posting on Truth Social. The US and Iran have had positive talks, also instructing the military to hold off fresh attacks on key infrastructure. Ellen Wald of the Atlantic Council joins us now for more. Ellen, you've read the post. We've all read the post. You've seen the market moves. What's your reaction to them?
It's incredible how much the market will move based on a post by the president, which has no backing. We've seen no proof. We have limited information from the other side, but it's incredible how much the market is moving, and the market hasn't even opened yet. So I think that we're really seeing in real time just how much this war is impacting not just stock markets, bond markets, and energy markets as well. And I think Anne-Marie's point about how, and we're in a phase now of this conflict where we're seeing long-term damage happen to energy infrastructure across the region. And that's going to be long-term. And I don't think that we're seeing that long-term damage reflected very much in, in the price of Brent. It's really moving based on, a couple words and a tweet, and that's not really reflecting the state of energy.
And signal and substance. The substance, people have questions about the substance. What does it signal? How instructive is the signal?
So the signal is, I think, really important because it signals that there is movement towards de-escalation, and that's generally good. Of course, I think if we look at what's happened in the past, we know that 5 days is a really long time. And it's unlikely that there will be zero military movement in those 5 days. And in fact, Trump was clear. He says, we're going to hold off 5 days on attacking, power plants and the like. He didn't say that they're not going to do anything else. And so I think that this is a little bit of breathing room, but I would not be surprised if in 2 days we see, or even less than 2 days, we see the resumption of military attacks, maybe not exactly on power plants, but definitely attacks. And I would be surprised if we see any serious movement of ships in the Strait of Hormuz.
Ellen, basically, is the president, though, telling the Iranian regime what exactly his pressure points are for the future? How does the U.S. win the war then?
Well, I think that he's actually communicated that he's willing to deal with higher energy prices for some time. I think that the fact that it's gone on this far and that we've seen Brent, hitting in the, up in the past 100 and in the above 110, I do think that he's showing them that he's willing to sustain this for some time, and that a lot of what he'll do to kind of pacify the American public is kind of jawbone the market a little bit. So yes, he does have pressure points, but I think that's really more in terms of like sending ground troops than it is higher energy markets.
For the words to become reality, what do you want to see? What needs to change in the region?
I think we need to see serious efforts by the Iranians to show that ships can have safe passage in the Strait of Hormuz. We need to see a cessation of these drone strikes because that's really what I think is causing a lot of the tension there and a lot of the problems. I don't think we're going to see the secession of all kind of military movements, but certainly fewer drone strikes, definitely no drone strikes at energy infrastructure. That would definitely show markets and also companies that things are moving in a somewhat serious way towards resolution.
Ellen, you wrote a book, Saudi Inc. If you were the CEO of Saudi Arabia or the UAE, one of the leaders of these countries, what would you be doing right now with these types of headlines? Do you think this is purely de-escalation? Or are you preparing potentially to enter this conflict in a more meaningful way?
I'd be prepared both, to get things back to normal, but I'd also at the same time be very, very wary and understand that this could just be a prelude to more escalation, and I would be preparing for that. I'd be on the phone with all of my GCC neighbors, and I'd be on the phone, if I could, with the White House to understand not exactly what they want to happen or what is going to happen, but at least the range of possibilities so that I could prepare my people, my country, and the very important energy companies that exist there for a range of possible scenarios.
Ellen, just before you go, it's hard to call this a market when we're at the mercy of a social media account at the moment. What's your advice to people at the moment? How are you going to go through, navigate the next several days into a new headline?
It's going to be very, very choppy. I think that there's a lot of volatility, and if you're not interested in, kind of the heart attack that comes with volatility, then maybe tap out for a little while.
Ellen Wald, the Atlantic Council. The volatility in energy has been absolutely wild, and the volatility of the last hour equally as wild. The headlines from the president: there was an ultimatum set over the weekend, ultimately a deadline for later on this evening, that if the Strait of Hormuz did not reopen, the power plants in Iran would be struck by the US, and I imagine Israel as well. That ultimatum has been taken away. The new deadline is what, 5 days, because the talks have been so good?
Because there were talks allegedly over the weekend. News to me. We continuously ask this question: who exactly in the U.S. administration is speaking, and to who in Tehran, more importantly, are they talking to? I'm getting a lot of messages, Jonathan, from individuals saying this is probably Trump maybe just buying time. And one individual notes correctly that there are amphibious assault ships that are still making their way to the region. And if the president wanted to do something in a little bit more of an escalatory manner with those individuals, he has to wait for them to get there.
This is a war, and we're waiting for the other side to respond, to see their readout of what's happening right now. The president says there are talks. We were unaware that those talks were going on. The president has changed the deadline, ultimately from this evening to 5 days' time. These are all things we're waiting to see what the other side says. Ultimately, there's a path there to de-escalation if the Iranians want to take it. Whether there are talks or not, their response is going to matter.
And I think it's also important to understand, is the president trying to buy time, or was he moved by pressure points in financial markets? Yields going up like Liberation Day, higher energy prices, and not seeing an off-ramp, and that is why he is real willing right now this morning to de-escalate. It's going to be incredibly important to understand what Iran says, and also for those that are watching, who is actually taking more of a leadership role in this regime right now. Who responds to the President of the United States?
Futures just off session highs, positive by 1.9% on the S&P, with an update on news worldwide. With your Bloomberg brief, Yahara has more. Hi, Yahara.
Hi, John. A de-escalation in the war with Iran. President Donald Trump posting on Truth Social moments ago, the United States and Iran have had very good and productive conversations regarding a complete and total resolution of our hostilities. I have instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure over a 5-day period. Meanwhile, 2 Indian-flagged vessels making their way through the Strait of Hormuz. The ships are following a route taken by others approved by Iran. They are likely heading to India, which is facing shortages of liquefied petroleum gas and has been in talks with Tehran to secure cargoes of the fuel. And the U.S. saying it will not reschedule a summit between President Trump and President Xi Jinping until the Iran war ends. Politico reporting the U.S. will propose new dates for the meeting after the active part of the conflict is over. Trump had previously said the summit would happen in 5 or 6 weeks. That's your Bloomberg Brief. John.
Yahara, thank you. What a start to another trading week. Absolutely whipsawed by 2 headlines. A deadline, an ultimatum that was set for later on this evening, changed to 5 days' time because talks have been constructed between the US and Iran, according to the President of the United States. A massive turnaround in financial markets. Up next, we'll break it down with Colin Martin of Schwab from New York City this morning. Good morning. You're watching Bloomberg TV. I can tell you the Iranian response just dropping across the Bloomberg. Anne-Marie's going to go through that in just a moment. This is what it looks like at the moment coming into this. The president had an ultimatum, a deadline of this evening, that if they didn't reopen Iran, reopen the Strait of Hormuz, they would strike power plants in the country. About 50 minutes ago, the president said this: I am pleased to report that the United States of America and the country of Iran have had, over the last few days, very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East. Based on the tenor and tone of these in-depth, detailed and constructive conversations, which will continue throughout the week, I've instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions. Anne-Marie, what talks?
The Iranians are saying this is fake news. This is coming from FARS, their semi-official news agency, saying there's no direct or indirect contact with President Trump, and they are saying that this has not happened. There are no talks. Also, Jonathan, the regime is really galvanizing the president's truth, saying that this means Trump has retreated to the threats that Iran put forward after the president gave that ultimatum.
Some stunning headlines crossing the Bloomberg terminal. The equity market starts to turn around just a bit. We were higher by about 2% on the S&P 500, now up by 1.6. In the bond market, yields are up by 10 basis points at the front end, then aggressively lower, now trading at about 390 on twos. And in crude's still down on the session by 6 to 7% at the moment. WTI at 91, Brent crude at 104. This is really, really difficult to be a part of this financial market right now in any asset class. When you're going to get whipsawed by a headline from the president, a social media post that's then denied by the Iranian media 50 minutes later.
And now that it's denied, I think potentially there's no longer this 5-day potential détente the president was almost calling for. We're not going to go for power or energy infrastructure for 5 days, given that we had constructive talks, which means the president is likely going to respond again. He's going to be asked about it again. It's not even 8 a.m. this morning, and he's going to be asked and say, the Iranians say there were no talks. Can you please give us some more details?
Colin Martin and Xauusd joins us around the table, wondering what on earth to say about any of this. Colin, good morning.
Good morning.
I'm going to give you the luxury of time and space to respond to this however you like. How difficult it is to be in financial markets right now when the President of the United States says there are talks, and Iran, according to the semi-official news organization that just published these headlines, Iran is saying there's no direct, indirect contact with the President.
Yeah, well, thank you for kind of giving me the open-ended question. You know, the way we're framing it is, I'll respond by saying it is really difficult right now. And that's how we're framing it with our clients. It's really hard to kind of be a hero in investing right now because there's two-sided risks because we don't know. The fundamentals are kind of out the window right now, and it's more at the whims of what we're going to see on social media and decisions by President Trump. So we made a decision a few weeks ago, collectively at Schwab, to kind of dial down the risk a little bit and kind of make a point. Now's not the best time to be adding riskier investments or being too aggressive.
There was a moment I remember several years ago before the pandemic, the trade escalation, the tension with China. And there was a moment when the president came out, and I've talked about this story a few times over the last month. The president said there was a phone call with Xi. There was a phone call with China. And China never confirmed the phone call. And a lot of people in financial markets don't believe the phone call ever happened. But what mattered was the signal. Ultimately, the president was looking for de-escalation, and the signal at that time mattered. Is it different this time? Does the signal matter less or matter just as much?
I think it does matter. I don't want to throw that, well, I'm going to say the taco trade, whether it's right or wrong, but I do think that President Trump, the administration, is seeing what's happening. Obviously, the riskier parts of the market, if you look at stocks, relatively well-behaved given everything that's going on, but I think the bond yields are probably spooking them a little bit. We saw that with the tariff announcement. And, you know, 440 on the 10-year this morning, not great for mortgage rates, obviously. And it's going against really what one of his main plans was, bringing long-term rates down and affordability for Americans. So I think it is probably spooking him a little bit. And I think we do need to take from this signal and maybe hope that there is some sort of de-escalation going forward.
So he's basically priming financial markets that anytime yields go up, I am going to try to de-escalate. But what does that send in terms of, it's different than Liberation Day. This is a time of war. What is the signal he is sending to the regime?
Yeah, no, it's a challenge right now because, as you said, we don't know what the response is going to be right now. And also, if there is a de-escalation right now, a lot of damage has been done. So it's not like we're going to see a big reversal in oil prices back to where we were just a few weeks ago, less than a month ago. Inflation expectations are up. We're expecting it to continue to rise. So it kind of puts a floor somewhat on Treasury yields if we continue to see inflation where it is. So yeah, there's not an easy off-ramp here. We think it can help at the margin, maybe signal that we can bring the temperature down a little bit. But it's not like this is a flip of a switch where everything is going to be great again.
Has this volatility created some value in the bond market? And at what point along the curve is getting interesting? Around 4 on 2s, around 440 on 10s?
Yeah, we're a little bit nervous about taking too much interest rate risk right now. Even coming into the year, we thought yields could rise to this 4.5% area. Not for these reasons, though. It's not like we expected this. But inflation was still too high, budget concerns. This is probably going to add to the budget concerns because wars tend to be inflationary. We need to finance them. But I think there's just so much uncertainty that there's a risk that long-term yields continue to rise. So we're not there just yet. And given the shift we've seen in Fed expectations, the risk of reinvestment risk has come down a little bit. So maybe staying short and earning close to 4% without much duration, maybe that's a little bit more attractive.
It sounds super boring, but I've heard this so many times from Fed watchers who just believe it's impossible the Fed hikes this year. That the bar should be super, super high. They're not going to hike. And now that you've got yields trading above where Fed funds are, there's some value here. And this is a 2-year yield band, Awan. If you think the Fed's going to hike in the next 12 months, there's even bigger arguments they'll cut by even more in the following 12. Is that the point that's interesting to you? It sounds boring, I know, but 2's at 4% is kind of wild compared to what was expected for Fed funds at the start of the year.
Yeah, no, I think the case can be made that that looks pretty attractive because I still don't see the case for hikes right now. I think the bar is pretty high. I'm worried about what the negative consequences are if this conflict continues to go on. So far, the markets have really been focusing on inflation, but there are negative consequences, knowing that the economy was, I think, pretty strong going into this, but there were cracks forming. Obviously, the labor market stabilizing, but not necessarily strong. And obviously, a rise in gas prices and energy prices, that's going to hit the lower income parts of the market. What does that do for growth going forward? And how does the Fed balance that?
Colin, it's good to see you. Thank you, sir. Colin Martin there of Schwab, trying to figure this out. What we're hearing from Iran and the reporting out of Iran right now is that there have been no talks and there are no talks.
And another one from an Iranian state media, Tasnim, saying there have been no talks, are no talks, citing a senior security official. They say they will continue to respond and defend the country. So right now, not the off-ramp maybe the president was looking for.
Equity futures on the S&P positive by 1.3%, just off session highs. We'll keep breaking this down. Mike Kontopoulos of Bernstein joins us in just a moment. Andrew Holmhorst of Citi and Fed Governor Stephen Myron in the next hour. Look out for that conversation in just a bit.
The moves that we're seeing in the front end of the curve, absolutely nothing shy of spectacular.
The central banks aren't taking any chances.
It is now leaning towards hikes more than cuts.
We still think the next move is a cut.
What's going to happen? And the answer is, we don't know.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and it already feels like Friday. A week-long market session already this morning. Equity futures look like this, positive by about 1% on the S&P. Somewhere in between the high and the low of the session so far. The Russell up by 2%. Wild moves in this market. In the bond market, 2s, 10s and 30s. 2s were through 4% only a few hours ago. Then down to the 380s, right now 392, and yields are higher again by 2 basis points. In the oil market, energy shaping up as follows. WTI overnight, triple digits, right now 92.90, and down by 5% on the session. Wild swings there too. Off the back of this, a statement for the president about an hour ago that read as follows. I'm pleased to report that the United States of America and the country of Iran have had over the last 2 days very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East. Based on the tenor and tone of these in-depth, detailed and constructive conversations, which will continue throughout the week, I've instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions. Okay, that's the president's position. The first reaction we had to that post: what do the Iranians have to say about this? Are those talks even happening? State media responding just moments ago.
State media says those talks are not happening and there's been no contact with the United States. An additional report now coming from Tasnim news agency, also semi-official news agency, saying not just that there are no talks, and they're citing a senior security official, but they're saying the president's comment is psychological warfare, going on to say the Strait of Hormuz, something we know that this administration and Western allies and Asian allies want to see reopen, says the Strait of Hormuz will not return to pre-war state through PSYOPs. So right now, what the Iranians are saying is not only there are no talks, they are saying that the president actually retreated. For domestic consumption, this is important. They're saying the United States is backing down and retreated after hearing the regime was saying that they're going to target all power plants in West Asia.
This market is almost untradeable right now. A lot of positioning would have got cleared out in the last hour or so. People caught offside on the wrong side of the trade. Then they have to reset again this morning. We've seen this a number of times over the last week. I'm deeply uncomfortable in moments like this. Difficult to trust Iran on any given day. Hard when you can't trust the President of the United States, and that's the tone I'm getting from financial market participants. Not my opinion. Bloomberg Terminal subscribers writing in with their doubts about the content and substance of that post by the President even before we had that response from Iran.
Absolutely. Everyone on here was basically saying, how authentic is it? Who are they actually talking to? That is a great question. I do think it's interesting when you look at the Iranian response. It's coming from semi-official state media. Not a single person is putting their name on it. So I think that is interesting because it really has been unclear who really has the power, the center of power right now in that country. Also, Jonathan, where do we go from here? The president has an event in Memphis, Tennessee this afternoon at 1 p.m. Eastern. Will he talk to reporters on the way to that event? Will he talk about Iran at that event? Potentially, that is going to be the next key point for this market this morning.
It's not the first time that the president has said communications are happening with another country and they haven't been verified by the other country. We saw that with China. I mentioned that before the commercial break. We saw that with China in the trade talks before the pandemic, I believe in the summer of 2019. But what mattered to markets then is not really whether it happened or not. What mattered was the signal that the president wanted to de-escalate and move away from the tension with China. The market traded on that. That was what was important to financial market participants. For market participants this morning, it takes two. It's not just about the US. Iran needs to come along for the dance and de-escalate as well. And you're not getting that signal from the other side.
Or potentially the president is just trying to buy time, to be ambiguous, because actually there is an amphibious assault ship, another one, that is headed to the region. And maybe he's just waiting for all his ducks to be in a row before he decides whether or not he is going to do what reporting over the whole weekend was, potentially taking over Karg Island.
Big 60 minutes coming up to try and figure out all these things. Coming up shortly, we'll catch up with Mike Kontopoulos of Bernstein, with stocks jumping on comments from the president, Andrew Honhorst of Citi breaking down the economic impact of the war, and Fed Governor Stephen Myron, the lone Fed official pushing for an interest rate cut, joins us later this hour. We begin this hour with our top story. The president posting that the US is delaying any and all strikes on Iranian energy sites following productive talks. Iran with something different to say. Bloomberg's Jumana Basechi joins us from Dubai for more. Jumana, a very different tone coming from the Iranian side.
Yes, that's true. But let's just for a moment unpack half of that statement, which is the fact that President Trump has pushed back the decision or the potential to strike power plants in the region or in Iran over the next 5 days. That is welcome, of course, for many of the participants in the region. And I think many people here in the Gulf, where I am, are breathing a sigh of relief that there isn't going to be that type of action happening in the next 24 hours. Now, the second part of the statement, which is where he talks about discussions taking place with Iranian officials, there hasn't been anything from the Iranian side to signal that that indeed is the case. And if anything, we've had a denial from Iranian affiliated media saying that no direct or indirect discussions have been taking place. We haven't heard from individuals themselves, so key figures like the foreign minister, Abbas Araghchi, or the speaker of the parliament, who have tended to be very active on social media over the last couple of days with these various threats of retaliation. So yes, an attempt to de-escalate, and certainly the market is interpreting that way. But I think, again, here you have to distinguish between what is signal and what is noise. And what we know is, number one, we have to hear from the Israeli side as well. They are also engaged in these military operations in Iran, and so far there's not been an official statement from them, so you would think they would be privy also to what the US are doing. Number two, the strait is still effectively closed, which means that effectively you have 10 million barrels a day of oil that's being taken away from the market, still effectively being policed by Iran. Number three, energy infrastructure is still damaged. And earlier today, we heard from the IEA, they estimate that 40 sites in the region have been damaged or severely damaged. It might take months, even years, for that to get back online again. And then finally, as we found out on Friday, the US are still planning on sending thousands of Marines to the region, and they should arrive in the next couple of weeks. So I think you have to distinguish between the short-term signaling versus long-term, more medium-term, what is happening on the ground. And we haven't heard from some key players yet.
Jumana, well framed, as always. Good to catch up. Jumana Basechi there out of Dubai, leading our coverage of this war as it enters week 4. Mike Kontopoulos of Bernstein joins us now for more. Mike, good morning.
Good morning.
Jumana did a great job of talking about the removal of near-term escalation risk. That's one thing. The hope of pricing in the end of this war, though, is quite another. And when the president says we've had these great conversations about a complete and total resolution of our hostilities in the Middle East, that's been essentially denied by the Iranian side. So that's the setup for this morning. Help me with this. How on earth do you trade this market in an environment like the one we're in right now?
Well, I think it's very difficult, Jonathan. You know, you've got to be an investor, I think. You've got to look past just the daily news and the headlines and think more about what's to come over the next 6, 12, 18 months. And that's clearly really hard to do. But there's certainly a direction being set that I think investors, you know, need to sort of navigate. That direction is higher inflation, probably higher rates. Those two things are certainties. They were certainties in our view before the Iran war. There's certainly certainties after the Iranian war. So for me, you've got to be an investor, not a trader. In a time like this, you've got to navigate the noise and you got to fall back on what you know, not what you think.
So inflation's higher, rates are higher than people thought. Is growth lower? Is the growth profile weaker from here on out?
I think that's still to be determined. The one advantage the entire world had was going into this, you had pretty strong economic growth. In the U.S., for Q4, you're probably running pretty close to 17% year-on-year earnings growth. And I think in the first 2 months of this year, things were actually looking pretty good as well. So you came into the Iranian war, I think, pretty healthy. Clearly in the U.S., jobless claims remain very, very low. Even internationally, both within Europe and emerging markets, I think, you know, the economic situation, the earnings situation for stocks, which is what you care about, was actually quite healthy. Now, obviously, if oil were to stay, you know, well into the 115, 120 or above range for a long period of time, that can change. But I think we'll see that through a lot of the economic signals, whether it's industrial production, whether it's PMIs, whether it's jobless claims, et cetera. You're going to start to see that filter through if that weakness is going to persist.
When do you think we will see potentially when you start to think, actually, this is a growth hit? Because already United is talking about how they're going to have to spend so much more money on jet fuel.
Yeah, I mean, I think one of the things that we have to think about is how much of that strong growth was really due to low oil prices, you know, in the 60s for a very long period of time. You know, I think there's certainly part of that. That's true. You're seeing the K-shaped economy. Of course, we've all talked about that so many times. You've seen that lead to stress in pockets of the credit market. So there is certainly stress out there. I think you probably are going to get a lot of information over the next coming, you know, month or so. You know, I'm not sure that you want to be too reactionary to the data. We saw what happened during tariffs where you got a few bad prints and all of a sudden things took off again. But certainly the longer this goes, the harder it will become. I mean, it is a tax on consumption, higher oil prices, that is.
Steve Myron is coming up at the end of the hour. What do you think this means for the Federal Reserve as the market is starting to price in hikes?
Yeah, I wish Steve and I were on at the same time. I'm sure it'd be a lively discussion.
Well, you could wait around for him.
Listen, I don't think there's any, certainly, reason for cutting at this juncture. I mean, never in the history of markets have you had a Fed cut in these sort of situations where you have, you know, above target inflation, the dollar's doing what it's doing, the volatility in the markets, et cetera, et cetera. I think there's a very good chance the Fed hikes later this year.
Wow.
You know, the only problem is this, obviously this is a supply disruption. And so that does change the calculus a little bit.
But if this becomes a growth disruption, how does the Fed hike into that? Wouldn't that do a tremendous amount of damage?
Well, so far, again, coming in, like I said, with quite a strong economy, I think gives them a lot of leeway on the growth component. So if you have unemployment go up, you know, 0.5%, you know, 0.75%, but inflation's at 4 or 5, I think inflation becomes the bigger part of the mandate. You have to, you know, basically dent demand in order to bring down inflation in that case. And, you know, you end up with a little bit of a catch-22 for the Fed. But you saw in the 1970s what happens when you let inflation get under control, and that's much worse for the economy and for employment later.
Can I rephrase what you just said, and you tell me if it's an accurate description? Kevin Walsh hikes interest rates later this year.
I think that's entirely possible.
That's what you think might happen?
I think it's entirely possible.
Wow. Can you imagine the tension between the White House and the Fed if that happens?
You know, the Fed's independent, right, Jonathan? So I believe in that independence. I think they do as well. I know, I'm sure, you know, you guys are chuckling over here.
I'm just thinking the next headline, as Jonathan says, that headline is a Truth Social from the president saying Kevin Walsh should be fired.
Anyone in the media is long drama and volatility. Okay? If anyone's smiling, that's why.
Well, listen, I mean, even the markets today are pricing in roughly a 50% chance of a hike or going into today in October. So it's not an outlandish statement, really, even when you consider the markets.
So it's interesting because a lot of people see that move and they want to step into it. I've heard it just repeatedly over the last week. The barter hike is so high. Yields above Fed funds here around 4%. There's value there. Let's get into the front end of the curve. Are you pushing back then?
Well, listen, I think 4% cash yields are probably okay. What we did at RBA is we actually bought floating rate about 2 months ago. And we continue to like really, really high quality floating rate debt. So not leveraged loans where I think there is some stress, but really high quality AAA type floating rate securities. I think that's sort of the safer place to be. But certainly, listen, if you're in T-bills or something of that nature, I think that's a fine place.
Where's that leave the outlook for stocks, if that's the outlook for bonds?
So again, it depends on how much growth really takes a hit here and how badly margins are compressed. You know, I certainly think that U.S. stocks, believe it or not, which I know have held up well relative to the rest of the year, remain vulnerable, particularly because of the growth component, the long duration nature of the U.S. stock market with, you know, the big mega cap tech names, a lot of the speculation being here in the U.S. We saw in 2022 when you had higher rates, what happened? Those sectors actually took the biggest hit. And so I think as long as you're out of excess in the markets, out of speculation, I think you're going to do okay over the longer run.
I've always wondered what a real cyclical test would look like for these tech names. There's a whole ecosystem built on what people believe are secular tailwinds. CapEx, tech CapEx, that's not going anywhere. How cyclical do you think some of that is?
Incredibly cyclical. I mean, I think time and time again, we've seen tech is a cyclical sector. The most recent example of that is the last 4 years or so. In 2022, when you had an earnings recession, tech took the biggest hit. And as you had earnings reaccelerate, tech did quite well. And that's the definition of cyclicality. And so I think if you were to hit a recessionary scenario, if you're going to hit a growth slowdown, particularly if it's accompanied with higher interest rates, and tech's incredibly vulnerable. Incredibly vulnerable.
Mike, it's good to see you breaking it down. Thank you, sir. Mike Kontopoulos there of Bernstein on the bond market, suggesting that maybe the Fed can hike by the end of the year. And on the equity market, those tech names, it's not just a secular growth story. There is a cyclical component to some of that as well that you need to think about. The headlines keep crossing, so this is where we are. The president had an ultimatum on Iran that if they didn't reopen the Strait of Hormuz, he would bomb their power plants by this evening, essentially. That was the deadline. Got a new deadline. It's 5 days because apparently talks are going so well. What we're hearing from the Iranian side through media operations, state-backed media organizations, is that those talks aren't ongoing. They're not even happening.
And there's multiple now. We just got a third from another semi-official news agency saying no talks between the U.S. and Iran. And another headline from this particular news organization saying requests to reduce tension should be put to the U.S. It is an interesting moment for this regime that is an existential threat that is trying to survive. They could have taken this phantom phone call, potentially phantom, because the president's saying it's happened and they're saying it didn't. But they could have taken this off-ramp the president was offering them and say, yeah, there are talks. We want to come to the table. We want to meet you in Muscat this weekend. And they're not. They're doubling down. They're saying the United States is retreating.
Two different things to think about for market participants, signal and substance, and the difference between pricing out escalation risk, near-term escalation risk, and pricing in long-term peace. Jemima Basetti, who leads our coverage out of Dubai, I think did a wonderful job of really giving us that framework for thinking about things. We've removed near-term escalation risk. And the near-term escalation risk was that if the Strait of Hormuz didn't reopen, the president, the US, was going to bomb energy infrastructure, power plant assets that are key for civilians across Iran, and Iran would no doubt respond in kind. That's the escalation risk that's been removed, at least for the short term. Now we're talking 5 days, not 12 hours. Pricing in long-term peace is a completely different effort. And when the other side says they're not even having talks with you right now, it's difficult to price that in this morning.
And I am struggling to understand the signal from the president. Is he just looking for an off-ramp? You have another Iranian news agency saying that Trump's comments are an attempt to cut energy prices. So now the regime is potentially saying, we know what your pressure points are. Higher bond yields and much higher energy prices, especially in a midterm election year. And we're going to make it as painful as possible for you. Or is the president trying to buy time? Because he does has an amphibious assault ship heading to the region. Is that what this is all about? We don't know.
We remove that near-term escalatory risk. Equities are still just about positive. Even as Iran denies those talks are even happening, the signal matters here. Up by 1.5% on the S&P. With an update on news worldwide with your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump posting a potential major de-escalation with Iran, as you all were just discussing, instructing the Pentagon to postpone any and all military strikes against energy sites in Iran for 5 days after what he calls productive talks. However, Iranian state media denying the talks occurred, saying there is no direct or indirect communication with President Trump. Meanwhile, Israel saying it's still pressing ahead with the strikes on Iran despite the updates on the situation. Israeli officials have not yet released a statement responding to the potential breakthrough. IDF officials saying the country is currently conducting strikes against regime targets in the heart of Tehran. And here in New York, LaGuardia Airport is closed until at least 2 p.m. Eastern following a deadly accident. An Air Canada Express plane with 76 people on board collided with a fire truck shortly after landing last night. The pilot and co-pilot died in the crash, and 41 people were hospitalized. The NTSB is launching an investigation into the accident. That's your Bloomberg Brief. John?
Yeah, hi, thank you. More updates on that throughout this morning. An important story here in New York and, of course, beyond. Coming up on the program, Andrew Honhorst of Citi with the global economy whipsawed by rapid developments in the Middle East and one social media post in particular. That conversation up next from New York City this morning. Good morning.
The president is clearly de-escalating here. We know the president watches markets closely, but not just equity markets, also bond markets. I think this is more about market reaction. I think he's concerned about the economy. He's concerned about affordability. That's what's really his focus here, is addressing the affordability issue.
That was Mark Shaw, the former chief of staff to the former Vice President Mike Pence, joining us following a bombshell announcement from the President of the United States indicating there were talks between the US and Iran. Ultimately, those talks are going well, and for that reason, the ultimatum, the deadline for later this evening, if they don't reopen the Strait of Hormuz, the US will bomb power plants. That's taken away. That deadline goes away, and now it's a 5-day period for talks. Talks that Iran is denying are even happening right now. Equity futures on the S&P positive by 1.7% in the bond market. Yields all over the place this morning. 2's very close to 4 earlier on, now back down to 3.87.
It's a very confusing morning, Jonathan, when you have whipsawing in the financial markets because you have different takes in terms of what is going on when the president and Tehran are saying talks are happening versus not happening.
Andrew Honhorst of Citi joins us around the table. Andrew, it's not Friday, it's not Thursday, it's still Monday morning, believe it or not. We've had about a week's worth of price action in 12 hours so far. What's your outlook for the economy, and what's changed off the back of the moves in energy and the moves in bonds?
Yeah, I mean, I think this move this morning just shows us how much markets are not trading economic fundamentals right now and just responding to every headline. And I think that's just, we have to acknowledge that's where we are with markets. In terms of the economic fundamentals, I think your prior guest said this, and I agree. This is a supply shock. This is a classic supply shock. It's going to mean higher prices, but it's also going to mean damp demand. So that's going to be a difficult spot for the Fed.
Sequencing matters for the Federal Reserve. Communication first and foremost to anchor inflation expectations. What are you reading into that? Do you think the market might be reading too much into that at the moment?
I think what we heard from Powell last week, and Powell was perceived as hawkish, I think really the message he was trying to send, and he said this, was we don't know what's going to happen with the geopolitics. We don't know what's going to happen with the oil price. And even if we knew all of that, we would still have questions about what that means for the U.S. economy. So I think this is a Fed that's trying not to give too much guidance. But we have seen an interesting response from global central banks. I think there's an impression from global central banks, from the Fed as well, that maybe the reaction to this supply side shock is going to be more hawkish than what we would typically think. Usually the textbook supply side shock, you look through it, you kind of hope and pray that it's relatively temporary and you don't have to raise rates in response. Because of the context, because we came from an experience where inflation has been overshooting, the Federal Reserve and global central banks under-responded to that overshoot of inflation, I think now there is a nervousness among central bankers about sending that message very clearly that yes, they do take inflation seriously. And that means, and I think unfortunately that means, we're getting interest rates that are now moving higher and are tightening. Whether central banks raise policy rates or not, the market is tightening policy. The market is tightening financial conditions. That's going to slow the U.S. economy.
So they're scarred from the transitory error.
That's right.
But isn't this so much different in terms of the economic setup than 2022?
I think it's completely different. And I think the biggest difference in the U.S. is the demand backdrop and the labor market backdrop. I mean, looking back in those days, we had high inflation, but we also were generating some months 500,000 new jobs per month. You look at the U.S. economy now, we can argue about where the break-even is for job creation, but we're running essentially zero job growth. And that's not just looking at that 92,000 jobs that we lost in the last jobs report. You take a moving average, 3-month moving average, 6-month moving average, it's a zero job growth economy.
GDP wasn't horrendous in 22. It was a market shock.
Yep.
Keep going back to that. It wasn't an economic shock. The recipe we have in front of us now has the real potential to be an economic shock, to be a big hit to growth.
Yeah.
Difficult to hike into an environment like that one compared to 22.
Yeah, very, very hard to hike, I think. And that's why I think what you're going to see, and again, I think that's what the Fed was trying to guide to, maybe the market didn't take it that way, is just on hold right now. And, you know, we're getting these headlines. We don't know where the price of oil is going to end up. Where are we going to be at the April FOMC meeting? Where are we going to be at the June FOMC meeting? It could be a very, very different world than what we
Never mind April FOMC. Where are we going to be by the end of this week? I've got no idea. Andrew, good to see you. Andrew Holdenhorst there of Citi. Lots of reaction to the headlines we've seen in the last hour. This from Peter Cheer of Academy. 5 days gives more time for the Marines to get in place and for the US to attack sites the Iranians can use to attack ships in the Strait. It also gets us to the weekend.
Yep, potentially the president is just buying time. He needs that amphibious assault ship in place.
Up next, Neil Dutta of Renmac with the global economy whipsawed by rapid developments in the Middle East. Live from New York City this morning, you're watching Bloomberg TV. A market whipsawed by headlines over the last 90 minutes or so. This from the President of the United States just 90 minutes ago, posting, "I'm pleased to report that the United States of America and the country of Iran have had over the last 2 days very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East. Based on the tenor and tone of these in-depth, detailed and constructive conversations, which will continue throughout the week, I've instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions." The President, about 90 minutes ago. First question we had, what talks? News to us. What does Iran have to say about this? And Iran, through state media, is pushing back.
Yep, they threw cold water absolutely all over this. A number of semi-official news agencies. Now remember, at some point, we have in the past, these news agencies are definitely propaganda for the regime, but they're all lining up to say that there have been no talks when it comes to Tehran and Washington. One of them now, Jonathan, just saying that the statement of the U.S. president are part of efforts to reduce energy prices and buy time for the implementation of his military plan. So potentially saying that we know what the president's pressure point is, and that's financial markets, and that's energy prices in a midterm election year. And the Iranians still think that maybe they will be more attacks. The president just needs his ducks in a row.
I keep returning to what Jumana said earlier on this morning. Jumana said she added to buy about 30 minutes ago. The difference between removing near-term escalation risk and pricing in long-term peace. What's just happened in the last 90 minutes or so? Regardless of what Iran's got to say about this, what does the president actually have control over? Why does the signal matter here? He's removed near-term escalation risk. There was a fear coming in this morning that in 12 hours' time, the US would be bombing power plants in Iran, and Iran would be doing the same back and hitting energy targets, infrastructure all around the Middle East. That's the escalation this market was worried about. The near-term escalation risk has been removed. Now we're talking 5 days out. The war continues. So to price in long-term peace, really, really difficult. So you're not seeing massive moves in crude relative to the run-up you've seen over the last month. You're seeing some relief maybe in the equity market. I'd also say you're probably seeing a flush out of positioning, given how one-sided this market had become a little bit earlier this morning.
It's actually impossible to price in what happens in terms of this conflict in the long term. To your point and Jumana's point about the near-term escalation risk, what I did find interesting is that the White House has retweeted the president's truth, but they highlighted only one part. I have instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, and they lead the tweet with, Trump calls for a pause on all military strikes against Iranian power. Trump calls for a pause. That is how the White House is interpreting the president's truth.
So our Bloomberg terminals are lighting up. Lots of subscribers writing in. A lack of trust right now in some of the communication coming from either side. Who to trust, what to trust. This from Marko Kolanovic of JP Morgan, formerly of JP Morgan, now independent, writing this out on social media. This is a net negative for markets. Manipulation will cause liquidity to disappear and real problems will stay. Now, manipulation is quite an allegation. He can have his own opinion on all of that, but the perception of manipulation is very, very important. And if that's a widely held view right now, that is a problem for liquidity in financial markets. Who wants to put trades on in an environment like that?
Not saying there has been manipulation, but the financial community has been talking about for weeks now 3 things that have gone on during the course of this conflict, this being the third. The first, that tweet that was posted by the energy secretary saying they had a successful U.S. Navy vessel come through alongside another vessel through the Strait of Hormuz. And the other, of course, is there's been a tremendous amount of speculation within the financial community and the market about a very large individual selling oil futures. The Treasury Department, individuals were speculating, stepped into the paper market. Now, that didn't happen, according to what sources are telling me, and also just saying that this was under discussion, but that's why you get statements like this.
Wrestling with all of those headlines this morning, futures still higher by 1.5% on the S&P, with an update on some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John. Good luck to anyone long or short this market this morning. I want to show you what some of the exposed industries are doing. We've seen fertilizer stocks rally hard as fertilizer gets hard to produce as products like urea don't make it out of the Strait of Hormuz. Again, these are stocks that have rallied double digits since the war in Iran broke out. You are seeing the fall, at least in CF industry sticks. That's down 5.3%. This NTR, this one is only down by about 1%. So not all stocks are reversing all of their moves. But again, for the most part, it is sticking. The airlines and energy stocks are an example of this too. If we look at what some of the travel ones have done, these were up as much as 5%. Now we're up about 4.5%. So again, still big moves, not as extreme as before we had that denial from Iran Carnival. The worst faring of all of these, down 17% since the war broke up. That's up 4.6% this morning. United up 4.5%, and Delta up 4.1%. Finally, I mentioned the energy stocks. Again, a reversal taking place after the gains. Occidental, those shares down 3.7% this morning, closely tracking the price of oil. So yes, John, they're not as extreme as you first saw, but for the most part, the moves, at least directional wise, are sticking.
Danny, appreciate the update. Looking forward to the show as well. Danny Berger alongside Matt Miller in about 30 minutes time, guiding you into the opening bow. Joining us now to discuss, Neil Dutta of Renmac. Neil, welcome to the program, buddy. Let's take a beat together. Wow, what a 90 minutes in financial markets. Neil, what on earth do you tell clients when they pick up the phone and ask you what's going on?
I say, let's talk about the data from February.
And they respond, Neil, no thank you. Why is that relevant in an environment like this one?
My clients aren't calling me for war strategy, John. I think just, point everyone to what Rory Johnston said. We had him on our own podcast a couple of weeks ago. And, basically this is about the cumulative deficit of energy flowing in the world. And that hasn't changed. I mean, the Strait of Hormuz is closed, the cumulative deficit builds. And that ultimately pressures energy markets, particularly in those countries that, rely on the, free flow of energy through the Strait. And that's really the Asian economies. And I think that's worth noting because a lot of those economies have been, and those markets have been responsible for the broader boom in global equity markets over the last year, particularly, when I think about Korea, Taiwan, what's going on with tech and semiconductor stocks, those are sort of the epicenter of that. And, at some point, people are going to start to begin thinking about not just oil prices, but what the oil is used for. And so that's sort of where my head is at. I have no useful opinions on the he said, she said, what this means.
Do you think, though, Neil, that this Truth Social post was about what is going on in financial markets, higher bond yields, and concern about energy prices spiking, and the president want to get out in front?
I mean, it's possible. Maybe he wants to buy himself time. I don't know. I mean, that's within his remit. But, ultimately, it's difficult to win a war if you're constantly looking over your shoulder at financial markets and public opinion.
Friday night, just after 5 p.m., the president said they're getting very close to meeting objectives and they're going to wind down. Then, of course, Saturday, 7:44 p.m., he came out with that threat and ultimatum about 48 hours. Then this morning, he said there's a 5-day détente. So what do you do with all of this? Wouldn't you have been better off leaving on whatever you thought the rest of the week was going to look like Friday night and ignored everything else the president said?
Well, look, I mean, I don't think you should be executing trading strategies based on what the president's saying on a day-to-day basis. I think you have to sort of go back to first principles. Is the Strait of Hormuz open? No. Is there energy flowing throughout the world? No. Is the economy sluggish going into all this? Yes. And everything that we're seeing, frankly, still reinforces the notion that the Fed is on hold. So to the extent that people had been anticipating rate cuts later this year, we're not at a point where the markets are going to be really betting on rate cuts again. So that reinforces the downside to the economy that we've seen. And so if you're a U.S. macro economist like I am, I mean, you kind of have to think about what that means for the domestic economy. And when I look at that, I see that's not good for housing. Obviously, mortgage rates have been climbing. And it's not good for consumer spending because, even if oil's coming in a little bit today, that's not really going to translate into what people pay at the pump. And so I think that represents a significant hit to disposable income. And it continues to kind of keep people talking about from a lot of the enthusiastic things they were talking about earlier in the year, like tax refunds. I mean, we've effectively neutralized all that. So an economy that had been very sluggish going in remains sluggish still.
Neil, how symmetrical do you think the Fed's reaction function is?
Well, I mean, I think the hawkishness will work provided that the unemployment... I mean, I do think that the Gulf War I analog is very, very useful. I mean, it's kind of... if you go back to that period about a year before, the Fed had been easing. Then I think in the summer of 1990, saw a big spike. Oil prices doubled. And guess what? The Fed stopped cutting, and they only resumed the cuts once oil prices began to decline in earnest. In the interim period, the unemployment rate was generally going up. So I do think the Fed will probably talk hawkishly. You can't ignore what's happening in energy markets and what that might mean for inflation and inflation expectations. But I think they'll ultimately stop short of actually hiking.
Neil, Governor Myron, up next on the programme. Any questions you want answered, happy to present them to him in a few moments' time.
I don't think you need my help.
Neil Dutta of Renmat. Neil, thank you. Thank you very much. Governor Myron joining us in about 5 minutes' time. We'll get his views on this economy and whether this energy shock changes things at all.
I think for him, he's just going to say you want to look through the energy shock and potentially he's going to talk about what has happened in the past. Interesting, Neil doesn't have any questions because last time Governor Myron was on, you were actually off. Neil was in the studio and they both stayed on because Neil was like,
I was picking questions out.
Yeah, Neil was like, I actually have some questions for the governor, so maybe he'll write in.
I have no doubt he will. Futures higher by 1.6% on the S&P with an update on news worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump posting a potential major de-escalation with Iran, instructing the Pentagon to postpone any and all military strikes against energy sites in Iran for 5 days after what he calls productive talks. However, Iranian state media denying the talks even occurred, saying there is no direct or indirect communication with President Trump. Meanwhile, we are seeing crude prices rolling over after President Trump's statement on de-escalation. Brent and WTI falling by double digits before paring some of those losses. The International Energy Agency describing the current crisis as the largest oil supply disruption in history prior to this morning's developments. And Newark Liberty International Airport temporarily halting all departures after evacuating all staff from its control tower. That decision following a deadly accident at another New York City hub, LaGuardia Airport, late Sunday that killed 2 pilots on board on an Air Canada flight. Officials at Newark lifting the ground stop for departing flights in just the last few minutes. That's your Bloomberg brief. John.
Yahara, thank you. It's so difficult to keep up with this. You've got official sources, state-backed media. This is coming from Xauusd, that Turkey, Egypt and Pakistan have been passing messages between the US and Iran over the past 2 days in an effort to de-escalate according to a US source.
Yeah, I imagine you're going to have some countries that want to say they can come in immediate. We also heard that from the Omani foreign minister this morning on Twitter. Also, Jonathan, the president, fresh to Fox News, deal with Iran could be 5 days or sooner. He's saying this to Fox News, even though the Iranians say there is no talks.
Equity futures on the S&P pushing higher once again, up by about 1.9%. Up next, we'll talk about Fed policy with Governor Stephen Miron from New York City. You're watching Bloomberg TV. So this is where we are this morning. The president says there are talks with Iran. Iran says there are no talks. They say that through state-backed media. This came from Xauusd just moments ago, that Turkey, Egypt and Pakistan have been passing messages between the US and Iran over the past 2 days in an effort to de-escalate, according to a US source. Of course, escalation risk was sky high coming into this morning, with a deadline for later on this evening, an ultimatum, if you will, that if Iran didn't reopen the Strait of Hormuz, the president would ban energy assets, or rather bomb power plants in Iran. Iran, of course, would then respond in kind across the Middle East and strike Gulf nations. This could have got really messy. Have we addressed some of that risk so far this morning?
I think we've addressed some of it in terms of the United States going after power plants, and the president is de-escalating from that threat he had, that 48 hours in terms of 7:44 p.m. this evening, that was supposed to come to fruition. Of course, the question is, what happens, Jonathan, come Friday?
So in the market right now, equities near session highs, up 2% on the S&P. This bond market, some wild moves earlier on this morning. Yields through 4% at the front end of the curve. Highest yield we've seen since last summer, 385 now, because we've pulled back following those headlines. We're down 5 basis points on the session. We've priced out the easing. At one point, we were talking about pricing in rate hikes at the Federal Reserve. Let's have that conversation right now with the Federal Reserve Governor Stephen Miron, the lone voice dissenting at last week's FOMC meeting, continuing his push for interest rate cuts. Governor Miron joins us now for more. Steve, good to see you.
Good morning. Thanks for having me back.
Governor, where do we begin with these headlines right here? As a policymaker, as an official, when things are moving this fast, what do you do?
Well, look, we've already had some whiplash this morning, and I think that underlines that we shouldn't be making policy based on short-term headlines, right? We should wait for all the information to come in before really changing our outlook. And I think it's just still premature to have a clear view about what this is going to look like as you look 12 months out. And because of monetary policy lags, we really need to be looking a year to a year and a half out. And there's just not enough information yet about what that looks like.
Communication in the near term, of course, matters. The chairman in the news conference last week really vowing to anchor inflation expectations. Do you think that's a worthwhile pursuit at this point?
I do. Look, traditional central banking, Federal Reserve wisdom is that oil shocks hit headline inflation, but they don't really pass that much into core by as much as they do into headline. And the two ways that you would want to respond to it, and so therefore you typically look through an oil shock. Now, the two exceptions would be if inflation expectations beyond the first year start to move higher. That hasn't happened thus far. Inflation expectations for the first year out have moved higher, of course, but as I look at the CPI swap market beyond the first year, there hasn't been that much movement. Medium term, longer term, five-year forward expectations have actually been coming down lately, right? So there's no evidence of that. And the other reason why you would want to respond to an oil shock is if you saw a wage price spiral, if you saw wages responding to oil price increases, gas price increases, that could result in the type of reinforcing inflation dynamics that you want to forestall. Now, again, thus far, there's little evidence of that. In fact, wage pressures have been declining for the last few years on a steady basis. So that's also something that I don't really see right now.
So the labor market's just not strong enough to worry about it?
I think the labor market still could use additional support from monetary policy, and that's why I dissented last meeting, as I have continued to dissent for all previous meetings.
How lonely were you at that committee meeting just last week, voting for a 25 basis point reduction in the face of an energy shock? How robust was the conversation around the table?
Look, I think a lot of people around the table, like me, were hesitant to draw conclusions from the oil news thus far because, as I said before, we have to look 12 to 18 months out, not what happened to the oil price yesterday, right? And so looking 12 to 18 months out, there's still not enough clarity to think that monetary policy itself should adjust in response to what's happened.
Well, check out the oil futures curve. That has changed. I've just had one eye on December over the last 3 weeks or so.
Yeah.
That's gone from the 60s and threatening to break out into the 90s at one point earlier on this morning. That's a change. That's a real step up, no?
It has, and I boosted my, in the summary of economic projections, I boosted my inflation dot for the end of the year to 2.7%, reflecting that in part, right? So there is some expectation of higher headline inflation. However, as I said before, I think it's way too early to draw conclusions that it's bleeding beyond headline inflation in a way that matters for monetary policy. Don't forget, higher oil prices also depress demand, right? They take money out of the pockets of consumers that we spending on other goods and services and redirects it towards gas and other energy costs, and that depresses demand and causes unemployment to move a little bit higher. That offsets some of the increase in inflation.
One of your colleagues this morning, Austin Goolsbee at the Chicago Fed, speaking to the press, saying we could see a circumstance where we'd need to raise interest rates. How high is the bar to raise interest rates? What kind of circumstances would you personally need to see?
Yeah, so I just laid out a couple of them before, right? If it looks like the oil shock is bleeding into inflation expectations beyond the first year, then you get really concerned about second round effects. Or it looks like you're starting to cause a wage price spiral, then you get really concerned about second round effects. First round effects are not something you traditionally respond to as a central bank. Now, I'll say one thing beyond that, which is that these oil shocks have been things that the Fed has looked through for a long time, right? It would be highly unusual for the Fed to start looking through them now. And when you think about what happened in 2021 and 2022, we did have negative supply shocks, like the oil shock from the Russia-Ukraine invasion. But in my view, part of the reason why it was able to reverberate through the economy the way it did was because policy settings at the time were very different. Monetary policy and fiscal policy were at all-time historical accommodative levels. We were doing $120 billion a month of QE. We were doing $2 trillion fiscal packages at a time. That's not the case right now. We're not hitting the gas on demand that would interact with the higher oil price in a way that would reverberate these prices through the economy now. That's not the case at all.
But right now we're just seeing price spike on paper market. But what's happening in the physical market is actually a void. We are seeing not just shut-ins, but some of these installations going to take years to rebuild. At what point does that start to potentially de-anchor inflation expectations?
Yes, so you'd want to see the oil price shock start to reverberate through supply chains and pushing up prices more broadly.
We are, though, in terms of airlines, diesel. That means that it's going to be more expensive in terms of some goods and services that are delivered by truck.
Yeah, there's been a few instances, but you want to see that in a broad-based way that starts to bleed into core inflation and boost it in a way that's sort of not just a one-off time, but you start to see really second-round effects that are concerning for the longer term. And if that starts to happen, then you start to get concerned about inflation. And I think that is what you did see happen in 21-22, and thus far I don't see it happening on a broad basis. Now, it could happen, right? But thus far, it hasn't happened on a broad basis. You get some idiosyncratic stories like airline prices that are more directly tied to jet fuel, but beyond that, you haven't really seen it. And I think part of the reason why is because we're not hitting on the gas. We're not hitting the gas on demand. We're not boosting demand with all-time record accommodative policy in a way that would allow pricing to accommodate a supply shock like that.
It's fair to say that I think a lot of Fed watchers watching this right now, and I'm getting some reaction from them in real time, agree with you that this isn't the environment to hike rates. The opposite, though, is a difficult argument to make. Is it the right time to cut interest rates this quickly, this soon?
Yeah, so, as I said before, traditionally you would look through an oil price shock like this, which means that my policy outlook from before is unchanged. And my policy outlook from before would be gradual cuts of interest rates. I had about 6 cuts for the year at the last step in December. I reduced that to 4 cuts for the year in response to the inflation data, right, that we received between the two projection periods. So I'm maintaining my outlook that I had.
It's not just that the outlook doesn't change, Governor. Forgive me for jumping in, but the balance of risks around the outlook should change. That should change off the back of an energy shock. Isn't that a fair summary of where we should be?
Well, the balance of risk does change, but I think it's actually changed on both sides equally. The inflation risks have got a little more concerning, but the unemployment risks have gotten more concerning too, because the negative supply shock that is the oil price is also a negative demand shock. You're taking money out of goods and services that are not energy that would have been spent on those goods and services anyway. And I view the labor market as continuing its gradual softening trend of the last 3 years. That trend has been in place for 3 years. I've seen nothing that would convince me the trend has stopped, right? That's a very, very powerful medium-term trend that's been in place for several years now. And taking money out of goods and services that's not energy to devote to higher energy prices is exactly the type of thing that worries me that trend might accelerate. So the balance of risk changed, but I think it got worse on both sides. I don't think it changed asymmetrically.
Governor, it's good to see you. Thanks for making time for us, as always. We appreciate it, sir. Governor Stephen Moran there of the Federal Reserve on the argument for lower interest rates following a major energy shock.
Major energy shock, and the headlines continue, Jonathan. The president is basically saying that negotiations took place last night. Iran says they didn't. to be continued.
Coming up tomorrow, Cameron Dawson of New Edge Wealth, Kay Herr of JP Morgan Asset Management, Emily Rowland of Manulife, and the Cisco President and Chief Product Officer, Jitu Patel from New York City. What a week already. This was Bloomberg Surveillance.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the U.S. and Iran continue to trade threats with the conflict now in its fourth week. Under pressure to bring down surging oil prices, President Trump issued Iran with a two-day ultimatum to reopen the Strait of Hormuz, which ends at 7:45 p.m. New York time today. So let's get more from Bloomberg's Abir Abu Omar. Hi, Abir.
Good morning, Francine. So the clock is now actually ticking down on President Trump's 48-hour deadline for Iran to reopen the Strait of Hormuz or have its power plants bombed. Iran has countered that if its power facilities are attacked or if it would close the Strait of Hormuz completely. Now, in a Truth Social post, President Trump said that Iran must, quote, fully open without threat the waterway. Meanwhile, Treasury Secretary Scott Bessent said U.S.-Israeli attacks on Iran are aimed at destroying its fortifications along the Strait of Hormuz. Now, the strait, of course, which carries a fifth of the world's oil and LNG supplies normally, has been effectively shut, as we've been saying, since the U.S. and Israel began attacking Iran late February. Now, this has pushed Brent prices up by more than 50% since then. Iran's strikes in the region have been continuing across the Arab Gulf, but also in Israel. The U.S. has also ramped up pressure and deployed additional troops and suggested that it may strike the oil-exporting Kharg Island. The Iranian military also said that it will target energy, IT, and desalination infrastructure that is linked to U.S. and Israel across the wider region, with a senior Iranian official adding that the headquarters and assets of financial entities that buy U.S. Treasury bonds are, quote, legitimate targets. The escalation in this rhetoric, Francine, by both the U.S. and Iran has driven a global market sell-off. We've seen this morning with Europe's stock 600 set to enter into correction territory and gold that is now slipping to around $4,200 an ounce. Francine, back to you.
Okay, Abir, thanks so much. Bloomberg's Abir Amar there with the very latest on what happened at the weekend. Markets definitely risk-off today as a sell-off in stocks, gold and bonds deepen. Let's discuss all of this with Seema Shah, Chief Global Strategist at Principal Asset Management, and Paul Wallace, our Middle East and Africa Managing Editor. So thank you both for joining us. Seema, first of all, I mean, the market is oscillating between risk-off, panic, and actually things will be okay. Is this, I mean, where are we today?
Well, look, I think once the European close happened on Friday, I think there was hopes that we could have hit the peak worst point, and that over the weekend there may be better news, the markets would have seen some light, and then today would be a better story. Unfortunately, I'm sure anyone looking at the market this morning will have been quite dismayed to see that even after such a significant sell-off on Friday, we've seen that continuing into Monday. Now, it's not as severe as what it was on Friday, at least so far. But the fact that it's continuing just tells you that the market is very concerned about when is this going to end, how far oil price is going to move, and what's next. I think that's really the key question.
I mean, how do markets find a floor?
So I think we have to get to peak, the peak point where markets fully confronted what the risks are, fully confronting the idea that this is going to be a very prolonged conflict, very likely, and even in terms of once the strait is open, the fact that actually oil and energy, other commodities which are reliant on that, is going to take several months to get back to normal. So I think we did see some last week with central bank expectations moving to hikes, but there's probably a bit more to go.
I mean, Paul, I mean, this, I guess, is a concern, is that there was an understanding in the markets that there could be some kind of off-ramp. And when you hear Donald Trump, one time out of two, he says, look, we're nearly the end of the conflict, but it's unclear how this gets de-escalated.
Exactly, and the other time out of two, he's talking about hitting Iran harder or whatever the case is, and that's the situation where we're in right now. On Saturday night, Trump gave Iran a 48-hour deadline to reopen the Strait of Hormuz on his terms completely, as he put it, or face the obliteration of its power plants. If Trump follows through with that threat, that is a major escalation. Iranian officials have come out and pretty much all said that if the U.S. does that, then water and power infrastructure in Israel and in Arab Gulf states are going to be targeted, and we know that Iran can cause significant damage. We've seen this already with strikes on the likes of Ras Laffan, the LNG terminal or production site in Qatar, and energy sites across the region. So it's a real threat, and that would mark escalation if Trump decides to go through with that, because in all honesty, Iran is not going to reopen Hormuz by tonight as Trump wants it.
I mean, what does Iran want? Right.
This is a good thing. We've reported that one of the things it wants is some kind of guarantee or pledge from the U.S. and Israel that they won't attack the country again in the event of a ceasefire or this current war ending. It also wants reparations. I mean, these things are pretty much non-starters as far as the U.S. and Israel are concerned. It's going to be, they're not going to give reparations to Iran. They may be able to unfreeze some assets and allow Iran to classify that as reparations, but it's very difficult to see Trump and or Benjamin Netanyahu saying to Iran, we are not going to attack you in the future or give any kind of pledge that strikes in the future on Iran are off the table.
Seema, I mean, we also heard from the IEA that more than 40 energy assets across the Middle East have been damaged since the conflict. I mean, is there, again, can oil go to 200? It's unclear at the moment. There's a lot of stockpiles that are being released, but then we don't fully understand the scale of the damage that's been done to a lot of this infrastructure.
Right, and I remember, just a few days after the conflict started, we did see a couple of estimates suggesting that $150 to $200 a barrel would be possible if you get a multi-quarter stoppage of the strait. Certainly that is, we are moving close to that point, but again, at the same time, Brent has, it hasn't had a very significant move up in the last few days. It's been fairly stable in the 110 to 115 or so range. But I think it's really about the vulnerability beyond just what happens to oil. I think that's the next stage is, thinking about fertilizer, thinking about sulfur. What is the impact which goes beyond just the standard energy and oil price effects that we can see?
Paul, I mean, if you're the U.S. right now, what do you need? I mean, you're going into the midterm in 6 months, so you definitely don't need oil at 110, certainly not at 200. So is there not an incentive to really de-escalate and definitely go for a ceasefire?
There certainly is that incentive, and you talk about oil prices. I think even more so for Trump, he'll be looking at gasoline pump prices in the U.S., and we're close to $4 a gallon as a U.S. average. That's a bit of a psychological marker and something that Donald Trump certainly won't want. We're seeing fertilizer prices go up, and we're seeing farmers in places like Iowa complaining about that. So it is a really big problem for Donald Trump. So he has that incentive to de-escalate. The problem is he needs to claim victory, and I think if he stopped right now, that would be difficult, or a lot of people, his critics in the U.S. especially, would turn around and say, what was the point of this war? We aren't, yes, you've degraded Iran's ability to produce ballistic missiles, and you've pretty much destroyed its navy and large parts of its military, but is this really a victory? So I think he needs to get to that point where he's satisfied that he really can make this look like a win, and obviously he has to reopen Hormuz and make sure that the strait is fully opened to commercial vessels.
I mean, it's also a game of numbers, I guess, because the anti-ballistic missiles cost so much more money than the drones. Do we know or understand the capabilities, and how are the Gulf states reacting to all of this?
Yeah, that's certainly the case. There are huge asymmetries in warfare like this, where the interceptor missiles you're using cost multiples of what the offensive projectiles cost. Iran's ballistic missile firings, let's say, on the Gulf and on Israel have dropped overall since the first few days of the war, although those are still happening. We've seen ballistic missile attacks, bad ones that injured more than 100 people in Israel over the weekend. But it's these Shahed drones which give or take, cost $20,000 that are a big problem at the moment. Iran is probably still able to produce those even during warfare because they're pretty rudimentary. They're difficult to detect. They don't cause as much damage as ballistic missiles, luckily, but they are able to cause fatalities and quite a bit of damage. That's a big worry for the Arab Gulf states and Israel.
And see, I mean, this has led to a massive repricing of what central banks will do, right? So there's almost no cuts on the table at the moment for either central bank, but it does seem that the Bank of England and UK gilts are taking the brunt of this because of the inflation situation.
Yeah, exactly. I mean, if we're looking across the central banks, we have to think about what are their mandates, and I think that gives us a good idea of which ones are most likely to shift. And then, of course, what is their starting point in terms of inflation for the US being above target for 5 years, but also for we know that the Bank of England has been very concerned about inflation stickiness. Now, the big turnaround, of course, is that whereas for the Fed, cuts were expected, most people are expecting just a pause for this year. For the bank, we've shifted from cuts right over to hikes. Of course, that's going to see the brunt. And that's really been at the front end. The next stage is obviously to see what happens at their 10-year point and beyond, if there's going to be any moves on the fiscal side. So there are still, I think, some stages to go through before the market can really say we have fully absorbed what the shock is and we're being a little bit more realistic about what's to come.
I mean, is it almost impossible at this point for them to look through this? Again, it's a supply shock, so it's not evident, how they deal with this.
This is the worst nightmare for central banks in terms of that dilemma. Certainly from our perspective, what we think is going to happen is that there's likely to be hikes across the ECB and the Bank of England. And then you get into 2027, all that demand destruction really starts to play out. And then we could see some cuts coming through. But certainly for 2026, this looks like a really challenging year and a big turnaround from what investors were expecting this year to be. So that I think is a big hit.
Seema, I mean, do you have any concerns also about the consumer? I mean, the U.S. consumer, which we talk about on a daily basis, is really propping up this economy. I mean, with the headlines, with inflation, with gasoline prices, is there a worry that they really take a turn for the worse?
Well, so consumer spending was expected to be a very important part of the growth story for the U.S. this year, and that was going to be helped along by the OBBA fiscal stimulus. Now, with oil prices, gas prices where they are, you do get to a point that it almost cancels out the benefit from the OBBA. But overall, comparing the US over to Europe is a little bit different because we have got that fiscal stimulus in play in the US. But it's worth remembering that in 2008, it's when gasoline prices hit about $4 a barrel. That's what really accelerated recession fears. So certainly there's many numbers that we need to keep an eye on.
Paul, when you look at some of the mediators, so again, European nations have been very reluctant to enter this conflict. I don't know whether they'll have to be drawn in, significantly at some point. But do we know if China's getting involved or at least trying to mediate things and take the temperature down?
To some extent, a lot of countries are trying to mediate, but it seems like it's at a low level at the moment and it's not getting very far. Certainly, China's been talking to Iranian officials. European countries have been talking to Iranian officials too. And the likes of Turkey have, and Gulf Arab states, Oman has. We've reported that Saudi Arabia has. It's not making much headway, though. And all sides, let's say all three sides, Israel, the US, and Iran, are sounding very belligerent still. And for all Trump's, as you said, 1 in every 2 times talking of de-escalation, on the whole, it's still very much that this war will continue. That's the message from all sides. There's no backing down from Iran, and there's very little backing down or sense of backing down from the US and Israel at the moment. So all the warring sides seem to think that they can and should continue going for a while, for at least a while longer.
I mean, could it be months or could it be even longer than that?
This is a big question. I mean, for Iran, this is an existential question. They see this war as something that is trying, an attempt by the US and Israel to topple the Islamic Republic. So I suppose you could say that time is on Iran's hands. You could almost say it's a bit like Ukraine when they're facing the invasion from Russia. It's existential. So they will keep going indefinitely. Trump is the big question. This market's chaos is something that, as we've mentioned, hurts him a lot. It hurts him far more than it hurts Netanyahu back in Israel. So Trump could be the key to this. It's, in some senses, it could be the point at which the pain becomes too much for him and his administration, and he says, "Okay, we've got to end this thing and take the off ramps."
Seema, what's the likelihood? Because we talk also a lot about the Asian economies really suffering with this price of oil. What's the likelihood that we could see a global recession because of this?
Well, so when we've been putting together scenarios, our worst case scenarios, you get that multi-quarter stoppage in the Strait. You see oil prices above the $125 a barrel to the top point, we don't really know where it can go to, and that's when you start to think about global recession. Now, through this, the US is still the most contained, the least vulnerable, and Asia is looking like the most vulnerable, China with it being the exception. So there are just, I think from a global picture, the Asia story is probably key to deciding whether or not we are approaching a global very negative situation or not.
Okay, thank you both for joining us. A terrific way to get us started this Monday morning. Seema Shah, Chief Global Strategist at Principal Asset Management, and Paul Wallace, our Middle East and Africa Managing Editor. Coming up, we'll talk to the President of the European Bank for Reconstruction and Development about the impact of the Iranian conflicts. That's coming up next, and this is Bloomberg. The chief executive of UBS says energy prices are likely to stay elevated as investors digest the impact of the war in Iran. Well, Sergio Armati was speaking exclusively with Bloomberg at the China Development Forum in Beijing.
This is basically the biggest topic we have been discussing lately. Of course, the good developments of China are somehow on the side for the second. But, when I go back to that, I do believe that China will continue to have a pretty good growth driven by innovation and the desire really to address also the topics of climate through innovations. And so, but in a sense, that kind of growth may be derailed by what's going on right now in Iran. Energy prices are likely to stay high for the foreseeable future, putting some inflation pressure and also some pressure on the delivery chain or on the supply chain, and in that sense the situation is a little bit unstable.
We're into the fourth week of this war with no end in sight, really. There's ultimatums out there. There are surely mitigation plans being put in place by businesses. What do you see as the direct cost to your business and your clients right now? And with no end in sight, how does that translate to mitigation advice?
But we saw clients already diversifying their portfolios early on this year. You saw much more dispersion in the way they were looking at maybe shifting away from more the AI technology to a more diversified portfolio. That was a good move considering what we see in the last few weeks. At this stage, clients are still broadly speaking, calm. We don't see any major shift in asset allocation, but of course, this pressure that I mentioned before on the economy will start to wade into the market.
Well, that was the UBS CEO, Sergio Armati, speaking exclusively with Bloomberg's Stephen Engel. Now, surging energy prices from the Middle East conflict, of course, are threatening to cripple developing economies. In response, the European Bank for Reconstruction and Development says it's in talks with nations across the region and Africa to provide additional support as trade and remittance flows face major disruptions. Well, I'm delighted to be joined now by Odile Renaud-Bassot, the president of the EBRD. Thank you so much for joining us, as always.
Thank you.
I mean, when you look at what's happening in the Middle East, how are you monitoring developments, and what kind of impact do you think it will have on countries where you operate?
So, of course, we are monitoring very closely the development. There is a high level of uncertainty, so we need to work on the basis of scenarios and so forth. But we already see quite a significant impact on some countries. And of course, I mean, the impact is quite different from countries in the very close neighborhood. And I'm thinking, for example, particularly in Lebanon, which is the country now really in the middle of the war, with a huge displacement of population, a huge economic shock. So really a very difficult situation. Countries very close by, I mean, in like Jordan, Egypt, West Bank, for example, are also very directly, impacted by the cost of energy, but also the possible impact on tourism, remittances. These are countries which are very highly dependent on Gulf remittances from the Gulf, and so they may be directly impacted by this channel of contagion. But also, more broadly, all countries dependent on oil and gas will suffer from the impact of the increase of prices. Our assessment is that if oil prices remain above or at
$100 barrel for a long period, extended period of time, this has an impact on inflation of plus 1% and a reduction of growth of minus 0.4%. And this is what we expect on average on our countries of operation.
Odile, I mean, how do you see, again, what's the way forward for Lebanon? I mean, it's heartbreaking, really, what's happening with the displacement of the population. This is, again, a country that was really slammed economically for things that have happened in the past. How do you see that, you know, can we talk about reconstruction yet?
It's very early. I think what we are trying to do is to continue to support private sector businesses which have, because people need to, for example, we still have some projects on the country for small businesses, private sector and so forth, but it's very challenging. And of course, this needs a political situation and a political solution with, because it's, part of the country now is really under heavy bombing, pressure, military pressure and so forth. So it's really challenging and there is a huge need for humanitarian support.
So what kind of support or actually, discussions are you having with your partners on the ground?
So what we are thinking about how we can support our clients in the most affected countries, providing emergency support, liquidity support, working capital, sometimes where our clients need some restructuring, this could be considered also. So really working on a toolbox that can help addressing the situation from private sector businesses and possibly also state-owned enterprise in the countries affected. And it's, country directly impacted, but also a country like Moldova, for example, which is far away from the conflict, but it's very dependent on oil and gas from outside, will be impacted by the increase of prices.
So what have you learned? I know you've been very involved also in the war in Ukraine. What have you learned from, I guess, COVID and the war in Ukraine that could help some of your clients, if not weather the storm, better prepared? Because we also have, there's a huge amount of debt. And so a lot of the governments across the board just don't have the money to maybe be able to support the population like they have in the past.
Yes, exactly. So I think what is important is to react quickly, to use, a multilateral development bank like us can play a counter-cyclical role. So we are there for the long term. We are not going to withdraw and we are going to continue to provide support. And for government, when you're talking about how to support and to weather the impact of this energy price shock, you need to have very targeted measures because a lot of governments do not have a lot of margin of maneuver, and you need to find and to reflect about targeted measures so as to limit the impact as much as possible, the impact of the shock.
If energy prices, persist at these levels or go even higher, is there a figure or a timeline where we should really do the alarm bells? Like if the price of oil goes to 150 or 160, or the price of fuel and gasoline?
That would have a huge, that would be, I think, beyond the alarm bells. As I was saying, with a price staying at $100 a barrel, the impact on the growth is quite significant. Yeah. So if it goes much beyond, this will have, and the issue is an issue of price, but also a shortage of energy. So you see a situation in Asia where already there is some restriction on the use of oil and gas in order to limit shortages, the risk of shortages.
And we're also talking about fertilizer. There are second-round effects that maybe we'll find out in the next couple of weeks and months of how deep the crisis could be.
Yes, the impact on fertilizers is already quite significant because 35% of fertilizer, product for fertilizers production were coming through the Strait of Hormuz, and this has a huge impact. And countries like Kenya, for example, depend 30% of their fertilizers coming from Gulf production. So the impact can go quite quickly, having in mind also that we are in spring. It's a season for agriculture where you need fertilizers, so this may have an impact. Also, accentuated by this fact.
Odile Renaud-Basso, thank you so much for joining us. That is, of course, the president of the European Bank for Reconstruction and Development. Coming up, Iran doubles down in the face of threats from President Trump, so we'll discuss how the Iranian people are reacting as well. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The global sell-off deepens. Stocks, bonds, and gold all falling as the U.S. and Iran step up their rhetoric. President Trump threatens to attack Iran's power plants unless the Strait of Hormuz is reopened by tonight. Iran doubles down with fresh strikes across the Persian Gulf. Plus, Italy's Poste makes a €10 billion bid to delist Telecom Italia, turning from its biggest shareholder into its owner. So the U.S. and Iran are trading threats as the conflict enters its fourth week, showing no signs of de-escalating. Now, the U.S. Treasury Secretary told NBC that the U.S. is trying to destroy Iran's fortifications along the Strait of Hormuz.
Every day, we are taking out their missiles, their missile systems, and the factories that build those missiles. And now the General Kane, Secretary Hegseth, are leading a campaign to destroy all the fortifications along the Straits of Hormuz. Again, they're not mutually exclusive. Sometimes you have to escalate to de-escalate, Chris.
Well, with us now is Roxanne Farmayan, a lecturer at the University of Cambridge. Thank you so much for joining us. Professor, so first of all, I mean, where are we in this war? It seems that, I don't know whether, the U.S. thought this was going to end much quicker, and to me it's unclear what the U.S. are trying to do now.
Well, I think there are several problems with bringing this war to an end. One is, I think it's very clear that Israel and the U.S. have different goals, and that is one of the issues I think we're seeing over and over again. The U.S. is looking for an off-ramp. They're anxious to declare victory, I think, and de-escalate. And that is not what Israel wants. Israel wants to destroy as much as possible in Iran and reduce its power so that it's no longer a threat to the plans of Prime Minister Netanyahu.
But Professor, I mean, listening to Donald Trump speak, it seems that, I don't know whether he changes his mind, but it's 1 hour we want to de-escalate, and 2, you will incur the wrath of the U.S. if this continues. So is there really de-escalation progress, or at least, diplomatic talks to try and bring it down?
Well, I think it's one of those situations which we've seen over and over again. The United States goes into the Middle East and then it can't seem to find a way to withdraw. And it's something that makes certainly President Trump extremely angry that he cannot seem to locate that sweet spot in order to leave. So no, there are no negotiations going on. And as far as I understand, there are demands that are being put forth by Iran at this point, saying various things, that war has to be off the table, that all of the American bases have to be withdrawn. There are very specific elements that are saying no ceasefire. The end of the war is what we're asking for, and I don't see that happening very quickly.
How likely is it that we see regime change in Iran?
I think very unlikely, at least for the moment. The government is very, very strong. It is multi-layered, and it has made contingency plans so that if its top people get taken away, it has others in line to take their places. And I think we can say that regime change would be possible if the pressure on the outside reduced and the Iranian people themselves could get an economic situation that they could start flourishing in, and that would lead to them then saying, we really don't like this government very much, we're going to change it. But as long as there are enormous sanctions on the country, which pressures every level of the population, there simply isn't going to be regime change.
Yeah, I mean, there's also, a huge problem with who has the weapons, because we saw big protests and uprising at the beginning of the year, and they were quashed without impunity from the government.
Yes, I think that is, this is a brutal regime. I mean, it is certainly willing to impose enormous cost on the population. And we've seen this not just in this most recent protest. The Green Movement was an extremely good example of that back in 2008. So I think that part is definitely in the hands of the government. On the other hand, I think certainly it has weakened in this process, and I think the feeling of the population itself is more and more that they've got to rid themselves of this economic malaise, more than even the structure of the government. I think their view is more, We do not want to have civil war. We do not want to have chaos. We want to improve our economic situation, and that will lead to political improvements.
But Professor, I mean, if this is a fight for survival for the Iranian regime, how are the Gulf states also thinking of this? They have their economies squashed so far because of the drones. Can they live with a kind of, diplomatic agreement?
Well, this next part of, we're all waiting for what happens this evening. And if Trump does go ahead and attack the electrical grid in Iran, it has said it will attack the electrical and water desalinization grid in the Gulf. That would be a whole game changer. These are deserts. They're places that people completely depend on electricity and water that is not there. So that would actually change the whole profile of the Gulf. I think they're very worried about that. I imagine the pressure they're putting on Washington at this point is high. But I think it's one of those things that he feels, I think, that he cannot let Iran have an upper hand in this. And so we see this tit for tat, and it goes on.
I mean, Oman played a very important role, and now a little bit less because they didn't really get anywhere. Could China play a bigger role to mediate, or at least, again, just try and take the temperature down?
Well, I think that's a really good point, and also Russia. I think both of them are gaining quite a bit from this war, particularly Russia, as it's able to amass enormous amounts of income with its oil now off the sanctions list. And I think both have weight they can push with Trump and are considered honest brokers with Iran. So I would say this is going to have to become a much different kind of negotiation and moderation, if you will.
Why do you think the U.S. entered this war?
I don't know. In many ways, I don't even think of it as America's war. I think of it as Israel's war. And I think that the deal that was on the table during the negotiations, this last negotiations in Geneva, was actually a fantastic deal, better than Obama had received with the nuclear deal of 2015, the JCPOA, and really would have possibly delivered Trump the prize he's always wanted, the Nobel. But I think there was an element of wanting to work with Netanyahu on this, and Netanyahu has been pushing this war. And so I think, unfortunately, there was I would describe it as a real misstep going in.
Yeah. I mean, there is, some people, there's a line of thought that's saying, look, with gasoline prices hit $5, that's when the U.S. says, look, we've done our job, let's get out. I mean, is that a possibility, and would that really make a difference?
I think not only the gasoline price, I think the drop in the stock market. I think we're seeing gilts going through the roof. I mean, I think there's several elements that really are close to Trump's heart and that he watches very carefully. And one of those is going to, I think, finally tip the balance. He cannot possibly imagine resuscitating his party for the midterms if the economic situation is like this. And it's going to have knock-on effects with the food and fertilizer, as you were speaking about.
Thank you so much for joining us.
My pleasure.
Faramaryan, the lecturer at University of Cambridge. Now, the head of the International Energy Agency has also described the energy market disruption as equivalent to two major oil crises of the 1970s and 2022 gas crisis all put together. Joining us now is Will Kennedy, Bloomberg's EMEA news director. So, Will, thank you for joining us. What happens now in the oil market?
Well, a lot will depend on what happens when this self-imposed deadline from President Trump passes at the end of our day today. I think it's fair to say that the eyes of oil traders will be firmly on what happens next. And I'm not sure there's a good oil market scenario in either case. If Trump decides to follow through on his threat and strike at energy targets inside Iran, we've heard from your previous guest that Iran is likely to retaliate against energy infrastructure across the Gulf. It's done that already, but it's threatened to step up those attacks, and that will be very bullish for the oil price. Even if he doesn't, there's no indication that Iran is going to concede to his demands and open up the Strait of Hormuz. And as we've discussed several times, Francine, the longer the strait stays closed, the more bullish it is for oil, the more stress we put on the energy system globally, and the more we'll see energy prices, not just in oil, but in oil products, continue to rise.
Well, how high could oil go as the disruption looks set to continue?
Well, I'm not going to give you a forecast, but we've seen some pretty hair-raising figures out there. I think that there was a story that said that Saudi Aramco, the big Saudi Arabian oil monopoly, had done its analysis and said that it was worried that oil could go as high as $180 a barrel. We've definitely seen those sort of figures in the 150 to 200 range bandied about, and while those are extreme figures, higher than crude has ever been, I think a lot of people in the market would say that if this continues for any length of time and strikes on energy infrastructure continue, that's inside the realms of possibility.
Well, what about gas?
Well, obviously this is the other big story from the war so far. Last week we saw the world's biggest LNG plant in Qatar hit by missiles from Iran. There was a pledge to step back from those kind of attacks, but that seems to be back on the table after the president's statement over the weekend. If we see any more attacks on Ras Laffan, on other gas infrastructure in the region, we could continue to see those prices go higher. And the important thing there is the length of time it takes to rebuild that gas infrastructure means the impacts will last months, years, and there's no quick unwind for this situation.
Well, thanks so much. Will Kennedy there, Bloomberg's EMEA News Director. Now, Italy's Poste has said, of course, it will launch something, well, Italy's, let me get this right, because it's one of the biggest stories that we're doing today. Poste is bidding 10.8 billion euros for full control of Telecom Italia. We'll have a full roundup of that. Of course, the move would fold Telecom Italia's operation into Poste's retail network, creating possibly this combined entity with about 26.9 billion euros in annual revenue. So we'll have plenty more of that after the break. Also coming up, New York's LaGuardia Airport has closed to incoming flights after a fatal crash on the runway. We'll also have details on that next. And this is Bloomberg. Conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Italy's Poste has said it will launch a voluntary public offer worth 10.8 billion euros for the former Italian phone monopoly Telecom Italia. Well, joining us for more on this is Daniele Lepido, Bloomberg's senior reporter. Daniele, thank you for joining us. So what does Poste Italiana's bid mean for the future control of Telecom Italia?
Yeah, good morning from Milan. Yeah, it's another day with Telecom Italia, and this saga is never over. Yes, basically it's a kind of full back to the state control of one of Italy's largest company, and the Meloni government is tightening its grip on Telecom Italia. I would like to remember that the Poste was already the company's largest shareholder, and now with this takeover means that Telecom Italia will become the digital pillar of Poste Italiane, which is one of the country's largest conglomerates.
So why is the government backing this kind of consolidation now?
Yeah, basically they need to have a big platform, a big digital platform to compete with other European and US players, and especially with the merging of nationalism, having, Telecom Italia fully integrated in Poste Italiane could be a big, something pretty important, very important for the company, or in order also to offer more services for EI, for example, and other digital services for enterprises, not just for consumer. Don't think just about consumers and customers, but also for enterprises and data centers, for example.
But Daniele, what changes for consumers and competition in Italy's telecom market?
Yeah, let me say that this move by Poste Italiane could in some way kick off a new wave of mergers because you know that Italy's telecommunication industry is one of the world's most competitive, and so that means that and other mergers could happen. We have 4 carriers in Italy, 4 big carriers, and the aim of the industry is having just 3.
Daniele, thank you so much. Bloomberg's Daniele Lepido. Now, German conservatives, led by the Chancellor, Friedrich Merz, have secured an election win in a socialist haven as he struggles to gain traction amongst voters nationwide. Meanwhile, in France, the far right fell short of taking control of some major cities during yesterday's municipal election. So let's bring in Oliver Crook, Bloomberg's chief Europe correspondent, to take us through some of the results. Ollie, good morning. So first in Germany, the victory seemed to soften the blow for the CDU after a stinging defeat in a neighboring state.
Yeah, I think that rather than sort of saying this is a massive victory for Friedrich Merz, the way you've put it is quite accurate. It's softened the blow of some of the defeats that he has suffered since he became chancellor about 10 months ago. And we should say this is a candidate, this is a chancellor that is very unpopular, relatively speaking, in Germany. He didn't even get all the votes of his lawmakers in his own coalition on his first day when he was supposed to be appointed chancellor. And that has sort of been the kind of flavor going throughout his premiership. So 2 weeks ago in Baden-Württemberg, that was a much more significant election because it's a much bigger territory. The CDU managed to lose by a couple of points to the Greens, but now we see a little bit of redemption here for Friedrich Merz in Rhineland-Pfalz, where he managed to edge out the Social Democrats that held the seat for 35 years. We should also say, because we watch this with very close interest, Francine, at every state election, the AfD did manage about 20% of the vote, which is notable despite the fact that they came in third, because this is not really, generally speaking, a haven for them that is a stronghold for the AfD. So again, significant in sort of appraising the state elections. There are 5 of these this year in Germany, and really the ones we're going to be focusing on is a little bit later in the year, Francine, particularly in Sachsen-Anhalt, when we'll expect an election there where the AfD may not only win, but may get an outright majority, and that would be yet another blow to the Chancellor of Germany.
Ollie, Marine Le Pen's national rally also missed out on some of their biggest targets. So what does this mean ahead of next year's presidential election?
Yeah, so just getting to the sort of the cities that we care most about, obviously Paris is the sort of crown jewel within France, and that was held by the socialist Emmanuel Grégoire, managed to win that seat, really taking another sort of term for socialists after 2 terms from Anne Hidalgo. So that was sort of the main sort of municipal election that we were watching out of 35 or so thousand that there were across France. But I think the trend across France, what we did see was a rise for the far right, for the Rassemblement National, Marine Le Pen's party, headed now by Jordan Bardella. We did see their popularity increase, but in the second round vote, we did not see them get all the way to the goalposts on many of the key elections in the key cities within France. So it's a bit of the theme we've seen historically within France, where you do see a move to the right, you do see some rising popularity of the RN, and at the same time not really getting that escape velocity in all of these jurisdictions. That being said, they did win a number of different cities, and it will give them an opportunity, which they have not had since the 1970s when this party was founded, to begin governing and get that track record sort of on display ahead of the 2027 election next year, which is really anybody's game, as you know, Francine.
And Ollie, Denmark goes to the polls on Thursday as Prime Minister Mette Frederiksen seeks a 3rd term. What can we expect there?
Yeah, that's right. So they're going to go to the polls tomorrow to vote in the national election within Denmark. She called the snap election in the wake of what we saw with the sort of disagreement over Greenland. This was really sort of a boost for her nationally. Her polls have been dwindling in the last couple of years, but really this would be her 3rd term. So this would be Mette Frederiksen stepping up to the plate to try to get a 3rd term. They have it pretty much on lock. It is very likely that she will win. The question will be what the coalition will be composed of. The main issue domestically has been a reform on taxes, a wealth tax that puts a 0.5% tax on people that have effectively more than $4 million. That has been pretty controversial within the private sector. But from the EU perspective and the national stage, Mette Frederiksen is a sort of known quantity for the Europeans. She's somebody that's been very hawkish, very defending of Ukraine, but also is a sort of interesting model of a socialist who is a very strong socialist and at the same time very sort of strong on immigration policy. And that's a sort of playbook we're starting to see develop across Europe. But likely she's going to win another term when they go to the polls. The question will be in what kind of coalition she'll assemble the government.
Ollie, thanks so much. Ollie Crook there with the very latest, of course, on some of these elections that have been or that will be. Just the Danish election is actually tomorrow, not Thursday, so I stand corrected. Now, New York's LaGuardia Airport will remain closed until at least 2 p.m. local time. That's 6 p.m. London. That's after an Air Canada Express plane collided with a vehicle shortly after landing, killing the pilot and co-pilot. Let's get more from Danny Lee, Bloomberg Aviation and Transport reporter. Danny, thank you for joining us. What more do we know about the incident?
Hey, Frank, good morning. So we know that there was a fire truck that was crossing the runway at LaGuardia Airport late night on Sunday and crashed into a Air Canada regional jet that was landing, and unfortunately, as said, 2 pilots have now died. We don't know any more about the extent of injuries on board. We had 76 passengers on board the aircraft overall, but yeah, this is yet another fatal commercial aviation accident in the US at a time when authorities are trying to modernize and boost safety.
Yeah, and Danny, as you're saying, this is just, it feels like it's just the latest accident hit the U.S. aviation industry in the last 15 months.
Yeah, that's right. I mean, the string of accidents that have taken place, obviously we have to go back to the most notable case, the American Airlines jet that crashed, collided into a U.S. military helicopter back earlier last year, and then also the UPS crash. So clearly there will be a focus on authorities to try and quickly understand what went wrong in this latest incident. We do have National Transportation Safety Board officials being dispatched to the scene. But already when you try to look and understand what has happened, there is some audio on the internet relating to the air traffic controllers being remorseful for what has happened. But it's going to be a key thing to try and get a handle on what has happened, because for now, one of the US's busiest airports will be closed until 2 p.m. That's going to affect many hundreds of flights in the meantime.
Danny, thanks so much. Danny Lee there, Bloomberg's Asia Aviation and Transport reporter. Now, Bloomberg understands that the chief executive of the world's largest oil-producing company has withdrawn from a major energy conference in Houston as he deals with the situation in the Middle East. The Aramco CEO, Amin Nasser, had been due to appear on stage at CERAWeek, but sources say he will no longer take part. Aramco has had to reroute much of its oil because of the effective closure of the Strait of Hormuz. And European Commission President Ursula von der Leyen is visiting Australia this week after she said a trade deal between the two sides is in the final stretch. Well, von der Leyen will travel to Canberra to meet with Prime Minister Anthony Albanese, although it has been confirmed if a deal will be signed. Well, Australia and the EU have been negotiating over a free trade agreement for more than 8 years. And the Volkswagen CEO has told the German newspaper that the restructuring process at Europe's largest automaker will continue even as its order backlog rises. In an interview with Bild, Oliver Bloom has said that to avoid costly overcapacity, the company is applying clear manufacturing cost targets to all of its plants, while Bloom adding that Germany can learn a lot from China, hailing the country's systemic approach with so-called 5-year plan. And finally, Lionel Jospin, the former Prime Minister of France, has died age 88. That's according to the French news agency AFP. Now, during his 5 years in office, which ran from 1997 to 2002, France recorded its fastest economic growth rates in a quarter century, outperforming the UK and Germany. Jospin was also known for introducing a 35-hour work week. While AFP reports that Jospin died on Sunday, it did not immediately provide a cause of death. So, of course, there's quite a lot going on in today's market session. If you look at gold, for example, it's fallen for a 9th day, again, as the war in the Middle East spurred a broad sell-off across markets. Gold actually plunging as much as 8.8% to just shy of $4,100 an ounce. Now, the metal, in fact, has shed more than 20% since the war in Iran began, with part of the losses explaining by a dash of cash for investors ditching their relatively liquid assets. Now, expectations of higher interest rates, but also expectations of a stronger dollar have added to headwinds for gold, with non-yielding bullion looking less appealing when rates remain high. Amongst the other things we're watching, of course, there's also Brent. It was above 110, also WTI in the U.S. Overall, look, it's, fears of this possible escalation in the war in the Middle East are driving sharp declines in bonds and stocks after the U.S. and Iran seem to be toughening their rhetoric. Tomorrow on The Pulse, we'll have an exclusive conversation with the Telecom Italia chief executive following that takeover bid by Poste Italiane. That's at 9:30 a.m. London time. Coming up, Sheryl Sandberg, the former Meta COO, is on Bloomberg ETF IQ at 4 p.m. London time. Up next, it's Bloomberg Surveillance, and this is Bloomberg.
Chair will be next Tuesday, April 21, according to multiple sources with knowledge of the plans. The Senate Banking Committee is planning to notice the hearing later on today, with just a month or so left on Jay Powell's term. So things are moving forward, slowly, but moving forward.
Yeah, so he has this hearing. The question is, does the Jay Powell probe get dropped so then Senator Tom Tillis can then vote for Kevin Warsh to get through the hearing and then have a full vote, not in the committee, but actually on the Senate floor? That is going to be the key question, because Kevin Warsh getting a hearing, okay, great, that moves it forward slightly, but unless Tom Tillis decides he's going to vote for it, he could just be stuck in this committee. And we don't know if Tom Tillis is going to vote for it until we know what goes on with the DOJ probe on Jay Powell.
In addition to that, we don't know what Chairman Powell himself will do with regards to his future.
Yeah, whether he'll stay on as a governor even after his term as Fed chair is up. He said he will make that determination at a later point. Unclear what the characters are going into that. Nonetheless, it's even less clear to know what exactly the Fed is going to do with the panoply of potential data as well as events that are coming down the pike. Kevin Warsh might want to hang tight before he has to make the argument to cut rates, given the fact that there's a lot of dissent on the committee and some real pressure coming from the White House.
So we've got two things to do here. We need to talk about the future of the Federal Reserve. We need to start on the economic data. PPI softer than expected. Push that through the bond market. No big moves here. The US 10-year yield is unchanged so far. In the equity market, still positive by about a third, call it a quarter of 1% higher on the S&P 500. With us around the table, Stephanie Roth of Wolfe Research. Stephanie, good morning. Good to see you.
Good to see you.
Your reaction to that data for the month of March?
Yeah, so the details that matter for core PCE is really what we're looking at for. Airlines were up similar to CPI, 2.8. Physician services were kind of light. Finance wasn't too strong. So our tracking for core PCE for March should look, in the 0.2% range. So when we're thinking ahead, the question though is, are airline fares going to start increasing more materially in the upcoming months? And that's when it's going to become a bigger question. And I think that's what the market kind of told you after CPI is, yeah, okay, we get that the March data were okay, but what happens in the months after that? And that kind of fits with our move that we made somewhat recently, pushing out our Fed cuts from previously 2 cuts this year to now 1, and then we added 1 cut into 27.
What's your base case for inflation? What's the trajectory of things through the summer and into the fall?
Base case is that you'll stay around 3%. We think you'll actually end the year at 3.1, but that, of course, compares to the Fed's 2.7. Our expectation is the Fed's ultimately going to have to revise that up, which then makes it a little bit more difficult for the Fed to be cutting in the next couple months.
That said, doesn't the fact that you're getting less inflationary pressure heading into this period a positive with respect to the Fed's ability to cut rates? I mean, doesn't it sort of take off the table the idea that inflation was heating up in a dramatic way that would force a lot of these producers to raise prices for consumers?
It's certainly a positive sign, but then again, your February core PCE was 0.37, so you're kind of starting at an okay place, not amazing, and core inflation year over year is still around 3%. So I would say it's an okay spot. It's not as if you were starting from a very low inflationary backdrop, and now you're going to have just a little bit of upward pressure in the next couple of months.
What data actually makes sense to look at right now? Because it seems like the market kind of looked past this, is looking past other factors that have come down the pike. It seems like old data, not relevant, not necessarily going to track. What are you waiting for that will give you a sign of whether we really are in an inflationary kind of upswing or not?
It's going to be the realized inflation data. Today is another indication, but we probably need to see April and May to get a sense of whether you're really seeing the pass-through in terms of airfares. I think that's probably the cleanest component that feeds into core inflation that is directly tied to the energy shock. So if we don't see stronger airline fares in the next couple of months, I think might feel better about the pass-through. Of course, then that tells you maybe there's a problem for airlines to be able to pass through those costs. But that tells you the inflationary backdrop certainly looks different than 2022.
We need to talk about the future of the Federal Reserve as well. Kevin Walsh making an appearance on the JP Morgan call with Jamie Dimon, not literally, but his name was mentioned. Danny Berger was tracking that. Danny joins us now. Hey, Danny.
Hey, John. I have to say it was extremely brief, Jamie Dimon's comments around this. Basically, a journalist asked, Mr. Dimon, how do you feel about delays to the nomination of Kevin Warsh? And I have to say this question was asked right before Punch Bowl reporting the impending maybe process coming forward. And Jamie Dimon said simply, Kevin, I guess they're on a first-name basis, Kevin is a great candidate. The sooner, the better. And then he ended it there. He also goes on to talk a lot about economic confidence he has despite the war and despite some of the uncertainty going forward, but a very confident Jamie Dimon on the economy and basically just saying, yep, Kevin Warsh, he'd be great, and the sooner the better.
Danny Berger with the latest. Danny, thank you. Looking forward to the programme alongside Matt Miller, kicking off in about 20 minutes' time. It makes the question around Chairman Powell's future, I think, all the more important. I've raised this question over the last month or so since the last meeting with the chairman, when he refused to say that he would leave even if the investigations went away, and even if we had a new chair appointed, he wouldn't rule out staying on as a governor of the board. He seems to be worried about central bank independence, which is curious because so many establishment figures back Kevin Warsh to lead this Federal Reserve.
There's some speculation that Fed Chair Jay Powell was trying to take back a little bit of control or at least push back from what the White House is doing. Whether he will come clear with respect to what he's going to do if Kevin Warsh is nominated remains to be seen. Right now, markets have been incredibly sanguine about the future of the Fed. It's sort of a parlor game for us and for analysts to talk about what this could look like in the lack of certainty. But the conviction in markets that this Fed will anchor inflation, I can't get over that. The fact that that has persisted, even with all of this drama, even with the questions of the politicization of the Federal Reserve, is what I keep coming back to. So I agree with you. I think that there are some real questions here. The market implications, though, I'm not seeing it, which I think is interesting.
What was so interesting about when Jay Powell did that at the podium was that he wasn't actually even asked about that question specifically. It was third on his list. He didn't even need to go there, but felt the need to say that as almost to the White House, I still hold this card. Remember, he is still being investigated in the Federal Reserve by the DOJ. And I think that was a reminder to the White House, I could still make this complicated.
An update from Punch Bowl News. I mentioned it earlier. If you're just joining us, this on Kevin Warsh's confirmation hearing for Federal Reserve Chair will be next Tuesday, April 21. That according to sources with knowledge of the plans. That's according to their reporting. The Senate Banking Committee is planning to notice the hearing later on today with just a month or so left of Chairman Powell's term. Stephanie, inflation expectations. Bank of America had this note this morning, and I thought the headline was catchy. that tankers are anchored and inflation expectations are too. It's a curious moment, isn't it, that inflation expectations have been so well anchored. What's behind that?
Yeah, I mean, I think it's a combination of an expectation that it's not just about one person on the FOMC, and they have proven that they are focused on keeping inflation anchored. And it's been an FOMC over the past couple of years that has been very willing to hike rates in the face of the elevated inflation. And it's not just up to one person's view. And what we've seen so far is an energy shock that ultimately could hurt demand. It's different from where we were in 2022 when inflation expectations started to show signs of potentially becoming unanchored, because today the economy is not the same as it was. Back then, payrolls were running at 600,000. Today, they're, call it 50, 60. Unemployment rate was low and headed lower. Now it's up with, some upward pressure from AI. It's just a very different economic environment. And I genuinely believe if we were to see an oil shock that's more significant than this, we would start to see demand destruction, and the Fed will ultimately be easing as opposed to having to hike.
Based on this reporting, this hearing will take place a week today. What is the argument that Kevin Warsh can make for lowering interest rates at the Federal Reserve? Given everything you've just said, what do you think the argument will be that he'll present?
I think it's going to be all about productivity and AI, and a backdrop where AI is disinflationary, and ultimately that will mean neutral rates are lower in the medium term. And that was the view that the market had held before the Iran shock really hit. And it's his sort of best argument, especially in the face of where inflation is today, where the economy is, and the sort of the potential direction of travel. If you do really have a strong productivity cycle, you don't usually have inflation problems at the same time.
It's incredible how little expectations for earnings in this economy have changed over the last 6 weeks, given this major shock we've seen in the Middle East.
Even from some of the most exposed sectors. And what you're hearing is maintaining, even on the margins, upgrading. Again, how much does this go back to how much momentum there actually was in the U.S. economy ahead of this war in Iran, and how the upside was the potential surprise? Now we're sort of getting back to the expectations maybe at the start of the year.
Stephanie, good to see you. Thanks for being here. Stephanie Roth there of Wolfe Research. Equity still positive by 0.3% on the S&P, with an update on stories worldwide. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Recapping the data we just got, producer prices rising 5% in March. It's less than the 1.1% that was estimated, but follows a 0.7% rise in February. Companies are navigating a surge in energy costs tied to the Iran war. Stripping out food and energy, producer prices rising just 0.1% in the month. Iran is considering pausing shipments through the Strait of Hormuz to avoid testing a U.S. blockade. Sources telling us here at Bloomberg that Iran could be aiming to avoid an immediate escalation and derailing peace talks. The U.S. and Iran are reportedly sorting out logistics for a second face-to-face meeting. And Kevin Warsh's confirmation hearing to be the next Fed chair is reportedly scheduled for next Tuesday. Warsh clearing a key hurdle, Senator Tim Scott saying Senator Tom Tillis is now planning to support Warsh. That's your Bloomberg brief. John.
Yahara, thank you. Thank you for the update. Up next on the program, we'll catch up with Eric Friedman of Northern Trust Wealth Management, with stocks trading very close to record highs. Plus, Yahara's back with your morning movers. Amazon shares rising in the pre-market on its latest acquisition. That story up next.
80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, but when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
For every 1 day of service disruption, it takes about 3 days to catch up. Now we're looking at about 4.5 months with respect to the Strait of Hormuz to get all these ships, container, tanker, bulk, back into normal rotations. Once the strait is open, there is a lot of work to do in this supply chain.
Real physical disruption, this market's looking through it. That was the Port of Los Angeles Executive Director, Gene Soroka. This market, the gains continue. Up 0.25% on the S&P 500. The run continues on the NASDAQ. 9-day winning streak on the NASDAQ 100, the longest since September 25. You make it day 10, the longest since November 2021. The NASDAQ this morning up by 0.5%. Let's get you some morning movers. Yahira has more. Hey, Yahira.
Hi, John. One of the biggest airline deals ever could be on the table. We're reporting that United CEO Scott Kirby has floated the idea of a potential merger with American, that he's talked to senior government officials about this. So you are seeing American up 8.5% in the pre-market, even though any deal would, of course, face intense antitrust scrutiny. And it's official, Amazon agreeing to buy the satellite firm Globalstar in an $11.6 billion deal as it tries to compete with SpaceX and its massive Starlink network. So you are seeing shares of Globalstar up 11% in the pre-market. The deal is expected to close next year. And we end on Lucid Motors. Those shares up nearly 5% in the pre-market as the struggling EV maker tries to reset, naming a new CEO and locking in $750 million from its biggest backers, Uber and Saudi Arabia's public investment fund. John?
Yahira, thank you. Great work this morning. As always, appreciate it. As we count you down to the up and about, some things to look out for the next 24, 48 hours or so. Coming up tomorrow, results from Bank of America and Morgan Stanley, plus the Fed's Beige Book, another read on how they're thinking about the situation in the global economy. On Thursday, another round of jobless claims and more earnings for you. Netflix results just around the corner. The run we've seen in some of these tech names, phenomenal. 9-day winning streak on the NASDAQ. We're looking at day 10. Eric Friedman of Northern Trust writing the following: we do not expect the Iran conflict to severely impact the corporate profit cycle or credit markets. We remain overweight risk assets relative to bonds. Eric joins us now for more. Eric, welcome to the program. I have lost count of how many times I've asked this question of an equity market bull. What is anchoring that view, given the turbulence we're seeing play out in the Middle East?
I think the biggest things, Jonathan, are twofold. Number one, we still think consumers will remain resilient, not necessarily lower income consumers, but middle income as well as upper income consumers. Those have really been resilient. We think that continues. Also think that CapEx is still a variable that will be durable as well. So those are the two variables that we're probably domestically most bullish about. But I would say part of our opinion has changed with respect to the non-U.S. equity picture. We came into the year a little more excited about things like Japanese reflation, European deficit spending. Those may get somewhat crowded out by how challenged those regions in particular will be to the energy issue. So I think if anything, Jonathan, we're still bullish. Maybe a little more of a relative value opportunity set we're seeing right now. But again, we think CapEx as well as consumer durability in the U.S. likely remains the case.
Eric, can you just stay on that? The vulnerability of what's happening internationally, because the key trades for many at the start of the year, Japan took off, that continued. South Korea just exploded higher. Are those stories under threat, even though they have some connection, particularly the Kospi in South Korea, with the developments in tech in the U.S.?
Yeah, I think that's well put, Jonathan. If you look particularly at the issues with, for example, helium and the various parts of the hydrocarbon cycle that play into technology, those aren't going away. In fact, those have gotten worse. And so, part of the issue is will there be some sort of redirection of both trade as well as will there be some new winners within the technology space that are maybe not as affected within some of those shortages. So again, we have to respect that the direction of travel is a bit different with respect to both technology as well as what may be playing out across some parts of the consumer cycle, in particularly in Europe. That's a significant issue that may be different.
Eric, from February 27th till today, what's changed in your portfolio?
Yeah, the biggest things, Lisa, one is that we've shrunk tracking error, which is a long-winded way of saying that, hey, when the world changes quite a bit, we shrink our exposures, meaning we had a somewhat outsized view in terms of an overweight for our tactical clients within non-U.S. equities. We've actually shrunk that. We've retained our bias within real assets. So the biggest thing that we've done is really shrunk that exposure with respect to the non-U.S. equity portion of our portfolio, and we've been more emphasizing the real asset side. That's been something that's been consistent, and we'll probably keep that on for some time.
And now the fun starts where we actually get earnings. We get to hear from different companies. The banks have been first, and JP Morgan came out earlier this morning on the call with analysts. The CFO said consumer spending growth is outpacing last year, talking about how engagement and pipelines remain healthy looking forward, talking about mergers and acquisitions, IPOs, the like. How much do you take a read from some of these earnings in terms of the forward look, if you can put aside the conflict in the Middle East, to get optimistic heading into the rest of 2026?
Lisa, it's critical in terms of what we're seeing with respect to consumer activity, particularly do we see credit change? And when I say credit change, are we seeing an extension of, again, we saw personal savings dip a bit, we saw personal income remain somewhat flattish, but are people extending credit in terms of financial services providers? And also, are we seeing consumers get a bit over their skis, if you will, with respect to putting too much on credit? Now, the data's been somewhat noisy, but in general stable, but that's somewhat backward dated. Again, most of the data we get from the Fed is about 2 or 3 months old. This is a great real-time indicator. When Jeremy Barnum and others talk about what they're seeing across their portfolios and their loan books, that's really important for our work. So making sure that we are seeing some stability with respect to consumer activity. Again, decent spending, but that spending can't just all go on credit because that credit, of course, has to be performing, as you and the team have done a great job of reporting for the last couple of months.
Eric, we spend so much time talking about the Federal Reserve. Just how relevant is the Federal Reserve to your outlook?
I think the biggest shock, if you will, Jonathan, to our glass half full perspective would be an outsized move higher in interest rates. That doesn't seem to be something, at least the front of the curve, we're not as concerned about that. We're more concerned about what some of your other guests have talked about in terms of what happens with budget deficits, what happens with the back end of the curve. We're in year 19 of the 10-year Treasury yield being below 5%. We've become accustomed, if anything, we've become incredibly desensitized to interest rate volatility. So the Fed, with respect to front of the curve, not really a big concern for us. We're more concerned about was there upside risk, if you will, if for example, the administration decides to get very aggressive with pro-growth policies that the bond market rejects. That would be more concerning to us than what the Fed may have to offer on a next couple of meetings basis.
Eric, it's good to see you. It's always good to catch up, sir. Thank you. Eric Friedman there of Northern Trust Wealth Management on the Federal Reserve. The front end of the curve there, you can see it on the screen, 380, anchored around where Fed funds is right now at about 377, 380. This is a Fed that's not going to do anything anytime soon, as the market is well priced for it at the moment, at least on a 2-year yield. Looking at the situation in the Middle East, just how is the blockade holding up? Is it being tested? We were tracking one particular ship. What's the latest?
Yeah, this was a U.S. sanctioned tanker linked to China, and it seems that it has made a U-turn. So everyone was talking about the fact that this is going to be a huge test for the blockade. Does the blockade allow this sanctioned Chinese vessel through? And it looks like it's a no, and it U-turned, so not being able to make that journey out of the strait.
The potential for escalation avoided, at least for now. On top of what we've seen over the last week, Bramo, the market rally continues. You talked about it earlier. This market's moved on very quickly over the last week. The prospect of more talks encouraging this market to move on even quicker.
The fact that we had a blockade announced on Sunday or Saturday, and that Sunday night people came in, and I thought, wow, it's going to be a bloodbath. No, not at all. Actually, we ended the day higher yesterday. We're really close to where we were. We actually surpassed. We took out all the losses since the war began. Gives you a sense of where people's minds are at. This morning, just adding to that, the fact that there are reports that Iran doesn't want to escalate things. They're going to avoid trying to even have any ships U-turn to just avoid the conflict. And the fact, okay, U-turning, but at least there's nothing violent that's happening as a result of it. So people are looking at this and saying, next, earnings, let's hear it.
Minds are firmly on the future, on the summer, a touch of summer in the air in New York City into the 80s. Later, spring with a splash of summer, right? You know?
I'm actually very angry about this. I would like spring to be spring. I don't want it to be 85 and humid, but you're right. People are just looking to...
I'll take the 85 and humid.
I know.
Yeah, and you're complaining about the aircon. Interesting. Okay. Let's see how comfortable you are. Let's make it 85 and humid in the studio, and we'll see if you're happy with that.
No, but there's a happy medium. It doesn't need to be 64.
Okay, we can continue having this back and forth. Just a moment. I look forward to it. All right. Coming up tomorrow, I really don't. Noel Dixon of State Street joins us, David George of Baird, Phil Camporelli of JP Morgan, and Pooja Sriram of Barclays from New York City this morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
What some of these generative AI models look like they're going to do is they're going to reduce the cost of producing content to basically zero. So that will be a multiplier effect on the things that we're already seeing, which is that there's more people producing more content and reaching more people. And there's a lot of good and bad that comes downstream from that.
I don't know if you can break down what the average person is seeing right now in terms of stuff that's AI generated versus, maybe more traditional human generated, but what's that going to look like in a year or in 5 years?
There's actually a lot of hybrid content, and too often we talk about synthetic content and organic content and never the two shall meet. But there's a lot of content where AI is part of the workflow, right? Like you might not even know it. It might be whatever app you're using to do color correction might be using models to do so. Stamp tool in Photoshop in the old days to get rid of a pimple, those types of things. But that line is going to be more and more blurred. So it's going to be a little bit less like what is organic content and what is AI synthetic content and what the percentages are. I think there's going to be actually more in the middle than pure synthetic content for a while. But you will also see experiences that are purely AI, right? You see this in the last 2 weeks with Vibes in the Meta AI app and with Sora 2 from OpenAI. So I think you're going to see both.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We're getting closer and closer to another record high on stocks. 30 minutes till the start of the cash trade. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, Iran may pause shipments through the Strait of Hormuz in an effort to avoid escalation and keep peace talks on the table.
And a mixed bag, bank results. JP Morgan CEO Jamie Dimon sounds off on geopolitics, the Fed, and AI.
Plus, United explores a blockbuster deal with American that could shake up the industry and spark a regulatory fight.
That would be incredible.
It would be bonkers.
Truly, truly bonkers. That's the appropriate adjective for this situation. I'm looking at the bank stocks this morning. You can see a very mixed performance for them. JP Morgan, I have to say, across the board, really strong numbers, except for the fact that it guided lower for its trading revenue for the year. Citi, really strong numbers, some records when it comes to varieties of their trading figures, including equity trading. Wells Fargo, it was a miss across the board. At interest income, they reported also, for the first time ever, very granularly broke out their exposure to private credit. $36 billion is what they see. We also heard from the asset management giant BlackRock, $130 billion in client cash in the first quarter as ETF inflows surged. Catherine Doherty will break that all down for us later in the show, Matt.
That's very cool. Wells Fargo breaking out those numbers because I think shareholders demanded.
Yeah, to be clear, they've broken it out on other filings, but this is the first time ever on an earnings report where they said, here's our exposure to private credit.
Well, we're going to talk about that. Also, we're going to talk about a Bloomberg scoop. United CEO Scott Kirby pitched a possible tie-up with American Airlines to senior government officials. That would create the world's largest airline. In normal circumstances, it would be a regulatory nightmare, probably a non-starter. But maybe it could happen now. You see United Airlines rising 2%, American up almost 9%. So the U.S. could get fewer and fewer major airlines. There's only 4 right now.
And if this is something that could happen, like what else in the world could happen? What other kinds of mergers of different industries, of giants that could we get? Let's get back to those bank earnings, though, with Bloomberg finance reporter Catherine Doherty. I know we got a lot. Maybe let's just start with the behemoth that was JP Morgan. What were the takeaways there?
So trading strong across the board. This is continuing what we saw from Goldman yesterday. Citi as well reporting today with strong trading results. Wells Fargo as too, but they're on a much smaller scale than those 3 other banks. And I think that the other kind of strong point across the board was investment banking, specifically advisory. So for JP Morgan, they're also reporting one of their strongest quarters for advisory on a year-over-year basis. It is up. This is consistent with what they were signaling last quarter, which was that a lot of the deals that they saw towards the end of the year held off. You're seeing that come through in the first 3 months of 2026. And the other kind of numbers that we're watching, the disclosures from both Citi and Wells today, you mentioned the private credit exposure. So they're giving a lot more detail today. We had Citi put forth their $22 billion in the first quarter. But they're noting 0 losses. So while they're giving more disclosure, they're also giving some comfort to investors and across Wall Street, saying this is our specific exposure and this is these specific losses that we have seen, giving some comfort there.
So JP Morgan does very well on trading, pulls back on the forecast a little bit. Wells misses a couple metrics, including revenue. Citi's the only one with a clean beat, right? I mean, a very impressive move from...
Except for their banking division. I think there was a slight miss there.
Yes, so their banking division was a slight miss. That's a good point, Danny. But I think across the board, this is consistent with what Jane Fraser has been signaling to the street, has worked really hard to bring the company forward from their completing the back office and regulatory reporting problems that the bank has seen. So those have been the target of penalties imposed by banking regulators in the past. We're really moving forward with that is what you're seeing in these results. And from the commentary that you heard from Jane today, talking about their diversified business model, which is continuing to drive the revenue growth, is what she's noting. And then you hear some skepticism. She says that we remain a source of financial strength and trust for our clients during uncertain times. This is very consistent across what you've seen, the statements coming out from the CEOs of these banks. They're noting their own strength and what they're seeing as resilient consumer spending and savings across the board, but they are making note of this uncertain economic environment.
All right, Catherine, thanks very much. We're going to continue to talk to you about these bank results. Bloomberg finance reporter Catherine Doherty. On the data front, U.S. wholesale prices rose by less than expected in March, despite a surge in energy costs tied to the war in Iran. Let's discuss with Bloomberg macro strategist Michael Ball. So I guess the PPI numbers not as concerning as they could have been.
Again, everyone's wondering when the shoe's finally going to drop. When are we going to see the effects of the higher energy crisis that's occurring right now? So far, it's not necessarily moving beyond just the energy data that we're getting in these official prints, which is a positive because then again, as we know, risk sentiment is improving. We are building on this kind of positive vibes that the negotiations are still on track. And as a result, we can see kind of continual appetite to take on greater exposure as funds start to net up, the retail starts to re-engage again.
Just on that point, I mean, the S&P 500 is now back to pre-strike levels. We're up 8.5%, more than that from the low we hit on March 30th. It's the second best run over 9 sessions in the past 4 years, only surpassed by the bounce back from Liberation Day. So is this a market where there is anywhere we are still pricing in a war premium, or is it back to business as usual?
Starting to look like it's back to business as usual because the option backdrop is something I always like to lean into. Has become far less negative. We're seeing actually call buying now as it's become quite lucrative now, given how cheap calls were, given where put call skew was. But basically what that means is everyone had downside protection. Now everyone has sort of had to be taking that off. It's become very expensive to hold. You've lost money on all that. And as a result now, the chase is sort of occurring as people are falling behind the benchmark. To your point, it's been kind of an astronomical shift so quickly.
In terms of what we see in markets, I mean, we're almost back to record highs on stocks. We closed yesterday at a higher level than we did on February 27th, so before the president started a war in the Middle East. Why all this optimism? Is it just that higher oil prices can't hurt our earnings?
There's a little bit of that. There's still this hope that there's a window of where this kind of higher oil price hits the real economic activity is available, meaning that this can all kind of end and we can still salvage from a global recession. And when you look at some of the surveys, we saw a Bank of America survey recently, there's still a very large belief that's going to be a soft landing scenario from this whole scenario. But to your point, a lot of people were just caught low exposure, low net exposure, and now they're having to chase. So what started as a short squeeze last week was really concentrated more in the mega cap tech, has now widened. And yesterday's breadth in the market was much better, showing that people were actually participating in cyclicals again, and small caps, as we know, are also outperforming.
All right. Michael, thanks so much for joining us. Bloomberg macro strategist Michael Ball. Now, Treasury Secretary Scott Bessent is speaking at the Institute of International Finance in Washington. Let's listen in.
Impact. They're more vulnerable to disease, to hunger, to bad education, to corruption. The World Bank and the IMF need to get back to making rational priorities. For instance, using cost-benefit analysis, as Tim also just mentioned. These organizations used to lead the world in cost-benefit analysis. As I've argued for a long time, and the reason I think we're having this conversation now, is that we need to scrap these climate targets and get the World Bank and IMF back to their core missions. In your speech here last year at the IIF, you made this exact point, and you called on the World Bank and the IMF to refocus on their core missions. In your view, how has the bank and the fund responded, and what more do they need to do?
Good. Well, Bjorn, thank you. And good to be back here a year later to talk a little about a report card for the multilateral banks, and to also the U.S. leads the G20 this year, and I can tell you that our agenda is growth. We believe in the U.S. that the biggest risk to financial stability is a lack of growth. When I look at the choices, say, that Europe has made, that they unable to follow the Draghi report from Mario Draghi on how to increase growth. The EU was originally the European Economic Union, and it was meant to facilitate trade among the members, make it more seamless, create more prosperity, and it turns out that it's probably been a hindrance. In terms of the IMF and World Bank, I'm informed by the Grace Hopper, who was the first female admiral in the U.S., who I was a big fan of. She has some great sayings. Two of them, one is the most dangerous words in the English language are because we've always done it that way. And the second is the way to get things done is to get things done. And I think we need to step back and look at the IMF and World Bank, their core missions. The IMF, I believe, is global financial stability and stabilizing on the countries that are in bad equilibriums and getting them back to a sustainable path, an economically sustainable path. World Bank is to pull people out of poverty. And we cannot have, as Bjorn said, these kind of elite beliefs get in the way. And if we think about, I go back and I think a lot about this Nature magazine article that came out in April 2024 that became the guiding principle for so much of the climate beliefs that GDP was going to be 60% lower by the turn of the century. And then, so it was the gospel for 18 months, and then it was refuted. So everything was based on that. So, I don't think that we can have this kind of short-termism. I think we have to stick with core principles. And I do think we are starting to see at the World Bank, they are starting to take more for energy abundance and all of the above tact. They have now gotten on board with nuclear energy. I'm not sure why it ever went away. And then the IMF, I think, needs to lead by example, probably get rid of their golf course out in Maryland, and which I said last year, and focus on global imbalances. Because I can tell you, like this slow motion buildup of global imbalances after a lack of sustainable growth is the biggest risk. The world cannot take a China with $1 trillion trade surplus.
And I think you're absolutely right. And one of those points that we believe somehow that climate is so important that we need to do everything. That the nature study that you mentioned that suggests that we could lose 60% of global GDP if we didn't fix climate change, which later turned out to be wrong. But of course, the point is, if that was really true, it should have been rich countries spending rich country money on dealing with climate change. But that's not what's happening. It's mostly rich countries deciding to spend poor people's money through the World Bank and the IMF badly. And this is not what the world's poor are telling us that they want. So I had the fortune to work together with Nobel laureate Tom Schelling, and he often asked the very simple question, how do you best help poor people? Through development policy or through climate policy? Remember, climate policy costs hundreds of trillions of dollars, and it shaves off a tiny fraction of a degree in a century's time. Development policy, like avoiding death, costs just billions or maybe even just millions of dollars and save lives right now. And that, of course, is why development policy often is much, much better if you actually want to help poor people. And of course, it also builds much more resilience. Look, a hurricane that hits poor Haiti kills hundreds of people. The same hurricane hitting rich Florida kills virtually no one, because prosperity protects people. And so we need to get this conversation back, and I think this is exactly where the IMF and the World Bank needs to get back to their core missions.
I think it has to be resiliency, supply chains. Again, I think both the IMF and the World Bank have an important role in understanding this debt loop and downward spiral that many countries are in. several countries, one in particular, have done the equivalent of a loan-to-own program with a lot of these countries, and there's a lot of undisclosed debt. There are a lot of tolling arrangements that are unfortunate, and I think only these multilateral banks can effectuate that. But again, I do want to congratulate them. The IMF was willing to say this time is different with Argentina, and Argentina's been a fantastic success. They're accumulating reserves every day as we speak. The tens of millions of people there that are being brought out of poverty. The government of Javier Milei, I'm very interested to see, it was the poorest elements of Argentine society who voted for him this time around, and the young people. So there's optimism there. And then the IMF is working on bringing Venezuela back into making it look more like a normal economy, and I think will play a very, very important role there. And the World Bank leadership in terms of energy and unlocking resources and stability for the very poorest countries, I think is back on a good trajectory.
Yeah. If you don't mind, I'll pick you up on that energy point, because last October, you withdrew the United States from the Green Climate Fund because, in your words, their goals run contrary to the fact that affordable, reliable energy is fundamental to economic growth and poverty reduction. And I think that sort of shows the general point of, we often forget how energy really powers modern life. It warms us in the winter, it cools us in the summer, it transports us. I mean, I look around this room and I think pretty much everyone is from somewhere else, and this is what energy does. Energy allows us to live better than kings of the past. Energy really is prosperity. Yet, the climate fixation that we've been talking about means that both the World Bank and the IMF has pushed for a rapid shift away from fossil fuels and towards renewables, and for total ban on fossil fuel investment. And I think they need a reality check. There's no transition that's taking place. Globally, we use more renewables, yes, but we also use much more fossil fuels. The world still gets more than 80% of its total energy from fossil fuels, and the decline is so slow that on current trends, we will only get to 0% in 4 to 10 centuries. Germany has spent famously 700 billion euros on its energy shift since 2002. Electricity prices more than doubled, and yet Germany's energy is still 79% fossil fuels. China produces most of the world's solar panels, wind turbines, and electric cars, but much of this, of course, is produced with coal. China's energy is still 87% fossil fuels.
I would say a Chinese EV is a coal-powered vehicle.
A lot of it is in China, and of course, especially some places which are driven enormously on coal, for instance, India. They emit more. But the real point, I think, is that poor countries want to get rich like China did. They want to use more energy, and much of this will be fossil fuel. They don't want to copy Germany, and they don't have 700 billion euros to blow on climate policies. So forcing poor nations into renewables that even rich Germany or China aren't achieving is just simply hypocritical. In your IIF speech last year, you called on the World Bank to focus its efforts on expanding developing country access to reliable and affordable energy, and you criticized its climate targets. You noted that the IMF devotes disproportionate time and resources on climate, even though it's not part of the fund's mission. So what have you seen from the bank and the fund in these areas since your speech, and what more do you expect from them?
Again, as I said earlier, I think the World Bank has made a good pivot. They are now pushing, or they are a proponent of nuclear energy. I'm not sure how that wasn't considered a renewable for so many years. I mean, if you look now, France is powering the European energy grid, and their reactors are running the full blast.
And they're also one of the cleanest.
And it's one of the cleanest, but when you think, we were the Europeans got into this terrible recursive loop because they decided to turn off their nuclear energy. The Germans became more dependent on Russian crude, and then the Russians were selling them the crude to finance the war against them. So, but I do think that the World Bank is moving to an all-of-the-above energy process and program, and again is getting back to the core mission of lifting people out of poverty. And I would just say too, I always find it's very good to follow not only what people say but what they do. And Bill Gates, who for a long time had pushed this climate agenda, again has also changed tack. And if you read his recent speeches, he believes we're going to innovate our way out of this. And if you look, I think the Gates Foundation has something like $13 billion of investments in energy innovation. And look, no one's expecting Deus ex machina one day and everything will be fixed. But in the U.S., we were going to run out of
everything.
Well, we're going to run out of everything, but we were going to run out of the crude derivatives, and then fracking was invented, and now the U.S. has the larger reserves than Saudi and Venezuela. On the other side, the IMF, I think, getting back to this message of stability, of monitoring global imbalances, of stepping in early, and I didn't always agree with Ben Bernanke's monetary policy, but what I always admired with Federal Reserve Chairman Bernanke was he had a framework, and you could almost see if you ask him a question, he ran it through his framework, and everything was always consistent with Chair Bernanke. And I think with the IMF and the World Bank, the framework needs to always be consistent.
Yeah. I think, and on the Bill Gates point, I think really two things stand out. First of all, the innovation point that you just made. I mean, this is what has always solved the problem. Tim mentioned the green revolution that we had in the 1970s when we worried about running out of food. Remember, we didn't fix the problem of the world not having enough food by telling everyone, I'm sorry, do you mind not eating as much, and then we'll send it down to whoever it is that we worry about. The point was that we innovated a way to generate much more food. And of course, we'll do the same thing with climate. We are going to solve big problems through innovation. That's how we've always done it. But I think another point that Bill Gates made, which I think is incredibly powerful and useful when you talk about climate change, is he said, we've for so long been talking about climate as if the point is to cut carbon emissions or to reach a certain temperature limit. No, the point is to make the world better for humans. And there, the question is, do we make the world better for humans by cutting carbon emissions by whatever tons? Or do we make it better by, for instance, making sure small children don't die? Or that children get better educated in school? There's so many other ways that we can also do this. And this, of course, reflects back on the IMF and especially the World Bank on what can be done. And there are just so many incredible things that we can do first.
Yeah, again, I think keeping the main thing, and not getting distracted because it feels good, it's convenient, it's kind of part of the Davos consensus, which much of the Davos consensus seems to have been shattered.
Yes. So I want to just take us to our third and last point and talk about trade-offs. Because all international financial institutions need to get back to the core point of trade-offs. Look, the money that the World Bank spends on a solar panel can't be invested in healthcare or education. And the world's poor tell us very clearly not to focus on climate first. When Africans are asked in the Afrobarometer on what worries them the most, climate change came almost at the bottom. A vast survey of more than 50,000 Africans across 39 countries found that climate change ranked 31 of 34. The top concerns are not surprising. There's unemployment, the economy, health, education, poverty, roads, electricity, hunger, and corruption. Then it goes on for a long time until you get to 31, which is climate change. When your child might die tonight from a preventable disease, no family cares about shaving a fraction of a degree off global temperatures in a century from now. Elected leaders of poor countries tell us the same thing. In a large survey of low and middle-income countries, they show climate ranks 12 of 16 issues. Even the World Bank's own client surveys show climate ranks low. So international financial institutions should get back to focus on their strengths. As you've said, the World Bank should focus on poverty reduction and the IMF on macroeconomic stability. But the world's poor are very clearly saying, don't focus on climate first. So from your perspective as Treasury Secretary, how do you view the international financial institutions and their effectiveness in general, and the bank and the fund specifically?
Again, I would also highlight that it's not a unique survey item among the world's poorest. Germany instituted very, very strict remodeling and rebuild requirements for German households. So you had to spend, I can't remember, it was 30, 40, 50,000 euros to upgrade to a more green house, and they're all getting voted out. Yeah. So privation is not a good motivator. But again, I do think that we are determined, as I said last year, with the multilateral institutions, the banks, the U.S. wants to be in it to win it. We want to be good partners. America first does not mean America alone. And we want to go back to basics. And these banks were invented around Bretton Woods, which was post World War II. Europe was, and Asia was a unique time in America, and it led to incredible prosperity across the world. So why can't we do that again? And why can't we focus on growth? Like, what are the tools? What is hindering growth of these economies? Is it the unsustainable debt, which is the IMF? Is it the poor infrastructure, health and hygiene, which is the World Bank? Because I think for a time we kind of skipped the foundational elements and tried to jump to something else, kind of luxury beliefs, in terms of if a government was not able to fund itself, or if people are not able to feed themselves. And I think we've just got to get back to that. I think Ajay and Kristalina have gotten the message and are moving forward in a very, very constructive way, and I want to congratulate them.
Yeah, no, that's great. And again, when you have to decide what to do, obviously, I'm an advocate for cost-benefit analysis, so I'm going to be sitting and saying they should be looking at it. But really, if you think about it, the World Bank and IMF used to be world leaders in cost-benefit analysis. And it makes sense. If you only have limited money, if you have to think about trade-offs all the time, you have to ask yourself, where can we spend scarce resources and do the most good in the world? And this is exactly what cost-benefit analysis does for you. It allows you to pick out the really, really good policies and make it just much more likely that we can actually achieve all these goals that we're talking about.
Well, yes, and I think projecting anything that if you look, economists have trouble projecting 3, 6, 12 months, whether it's my economist at Treasury, whether it's the IMF or World Bank economist, and try to project something so far into the future. If you think about a y-axis and an x-axis, what we're really thinking about is the z-axis in terms of the trajectory. And why does the trajectory matter? Yes, the climate does change. As we all know, the natural habitat for the Earth is actually water. Ice was probably I mean, it's a very long cycle, but ice was an unusual cycle. And we are going through cycles, and I believe that it is very difficult to deconstruct the reasons around why anything changes. But I think we've got to step back. What do we know? We know it's changing, and how do you increase resiliency?
Yeah, exactly. And resilience really comes from more prosperity. And at the end of the day, of course, yes, climate change is a real problem. But if you're poor, if you have all these other problems that you struggle with, and you're vulnerable to disease and corruption and bad education and so on, these are the things that we can really help people with first. And so this is where both the world's poor is telling us we should focus, and this is where we can do the most good. And the cost-benefit analysis very clearly says this is where we should be spending our money.
Look, I couldn't agree more. U.S. foreign policy got off course. At a point in Afghanistan, that it became a social mission, and the mission was, okay, we have to do this in the schools, and we have to have these goals. And now, like, Afghanistan's fallen back into ruin, and what we should have done was try to make a sustainable government rather than try to, from the top down, overlay our values on a completely different system. I think we could have gotten a very different outcome.
So I noticed that we've run out of time, but I wanted to stop you when you said, I couldn't agree more.
Right. So
thank you.
Well, thank you. And again, my message is I think that both of the institutions...
All right, that was a half hour of your life that you're never going to get back. Treasury Secretary Scott Bessent speaking at the Institute of International Finance in Washington, and I don't know what to tell you about that. Let's focus back on markets, please, because we want to see what's going on with the most important equity benchmark in the world. It continues to rise, now more than 6,900. Stocks are higher now than they were on February 27th when we started a war in the Middle East. And since then, we've seen oil almost double in price. It's coming back a little bit today, but still more than $90 a barrel on Brent and NYMEX. And yet, we continue to see risk assets soar. The NASDAQ back at over 25,500, Danny.
It is incredible for us to watch stocks price out any sort of risk premium around war. In the meantime, we are looking at some individual stocks. JP Morgan, all the banks basically reporting today, not all of them, but the majority of them. JP Morgan, they had a really strong set of results. The issue for them was, though, that they lowered their net interest income guidance, but trading was huge, as it was at Citi too, and it had its highest quarterly revenue in a decade. Shares up 3.25%. Wells Fargo, it missed on basically everything, so shares down 4%. And then there was BlackRock, notably not a bank, an asset manager. It had $130 billion in client cash in the first quarter. ETF inflows surged. As we know, retail has been trading heavily in the first quarter on the market volatility.
All right, so we are focused on the banks right now, less than Bjorn Lomborg, I'm sure. But we're seeing real movement in these shares, and also what would be one of the biggest mergers that we've seen and what would make the biggest airline in the entire United States and the entire world, in fact. If United and American got together, which is the Bloomberg scoop, that the CEO of United, Scott Kirby, has pitched this to government officials, normally the kind of thing that wouldn't be allowed on a competition basis, on an antitrust basis, but it looks like they might try and get this done under the Trump administration. As a result, United shares are up about 0.5% in the cash trade, American up more than 5%. So some real news out today. Joining us as earnings season ramps up is State Street Global Chief Investment Officer Lori Heinel. Lori, I'll get to the banks first because we've seen, again, kind of a mixed picture as we did yesterday with Goldman Sachs, from JP Morgan, from Wells Fargo, from Citi. What's your take on how the biggest banks in the world are operating here?
Well, look, I think this is part of a broader view around where do we see the economic recovery going from here. There was a lot of concern that we were going to have pressure here in the U.S., particularly because of inflation. Certainly, we're worried about that as this conflict continues. But I think on balance, banks have lots of different ways that they can capitalize on this environment, including a lot of the market-making activity, which has driven some of the results.
Lori, I was listening into the media call with Jamie Dimon, and he was saying to reporters, he got asked the question, at what level do you see stress for this consumer, especially when it comes to gasoline prices? He basically said that there's no level. There's no level of gasoline that would worry him as long as jobs remain plentiful and the labor market remains strong. Would you agree with that, too, that things like consumer-related companies or really this American economy can be held up regardless of what gasoline prices are as long as this labor market doesn't crack?
Well, there certainly are stresses, and particularly if you disaggregate the American consumer into those that are in a better position and those that aren't. So I would agree completely with the assessment that jobs matter, and we've been watching labor markets quite closely for many, many months now, both as signals of the U.S. economy, but also as signals of what the Fed might do. But increasingly, you have a lot of concentration of wealth. You've had markets that have rebounded radically, as we've just talked about. And then you also have a situation where a lot of these consumers already own their homes. They're seeing price appreciation in the aggregate over the last several years. So they're feeling pretty flush. I wouldn't, however, say that none of the consumers are impacted by higher energy prices. Certainly at the lower end of the spectrum, that is a concern.
What do you make of the Fed here as we see, the price of gasoline, the price of oil rise? It's not too dramatic at the pump. I'll remind our viewers that it was $5 and change across the national average in 2022, and it's only about $4.11 today. But it still is something that the Fed is going to have to contend with. As the labor market looks fairly strong. I mean, still 4.3% is a fantastic unemployment number, and we added almost 200,000 jobs last month.
Yeah, I think there are a couple of things there just to pick up on. I mean, certainly the amount of paycheck that goes towards energy is just nothing like what it once was. So in addition to the fact that we're not at that $5 threshold, coupled with efficiency gains and gasoline consumption and things of that nature, all in all, it's not as big of an impact. But I think that there is some concern that inflationary pressures may not be as short-lived as we think. And if you look at just some of the underlying dynamics of what was driving the latest CPI number, there were some disinflationary things around things like used vehicles that probably are going to roll off. So I think we're in this window that for the next few months, the Fed's going to be on hold because the inflationary pressures will feel a little bit more immediate. But we still hold true to our call that by the end of the year, the Fed is cutting again.
I guess, Lori, and that makes sense, and you do see two-year yields remain elevated because of that concern. But that gets to this odd cross-asset picture, where as we've been talking, stocks are back at the levels they were before this conflict. You look at what oil has done before the conflict. It was hovering in the mid-60s. Now it's in the high 90s. And two-year yields, they were about 3.4%, are now near 3.8%. Does it make sense, even if you expect some things to dissipate, that you have yields and oil still under pressure while stocks show none of it?
I think there are a couple of things that are happening here. First of all, and you've talked about this at the top of the program, is that earnings are actually looking pretty good. So if you actually look at the re-rating that we had when markets pulled back earlier this year at the start of the conflict, coupled with actually improvement in earnings outlooks, you've actually seen stocks look relatively attractive. And then when you layer in some of the other themes around artificial intelligence and other ways that productivity gains can happen, that paints a relatively good picture. But as you also note, this conflict's far from over. And so there is still risk that we have another shoe to drop, if you will, and that the energy constraints become a real problem globally, not just here in the U.S.
We talk so much about the broadening out, Lori, but I'm looking at the index here since February 27th and seeing that even though we're up, we only have 175 stocks that have gained in that time, and the rest are down. Obviously, energy has been a big beneficiary of this war, and the AI trade is something that benefits the economy greatly, but not necessarily all of the people in it. What do you think about the idea that we're still seeing a broadening out trend in terms of earnings growth?
So So we are fans of that broadening out trend, and we do think if you look at just the gyrations in market, it has been a little bit hard to parse that out. But if you look at some of the underlying factors, things like quality have done better. Value year to date, even though it's had a little bit of a lag in the last week or so when we had the sharp rally again, value stocks have done a little better. Now, that doesn't mean that the tide lifts all the boats, but I think that there is this kind of growing broader input, whether it's, an economic recovery that we thought was going to have more legs, but now is threatened by the Iran conflict. But that kind of broader sentiment, we think, is something that investors should still focus on for the longer term.
Lori, we're going to have to end it there. Thank you so much for joining us, State Street Global Investment Officer Lori Heinel. Let's get a check on your equity market about 10 minutes into your trading day. And we are looking at gains 0.4%. We are less than 1.5% away from all-time highs. A remarkable turnaround for this market, as we've been discussing, that is now back above the levels of where we were pre-war. The best 9-day streak, it has been up for 8 of those past 9 days, but the best 9-day run since Liberation Day. Microsoft, Amazon, Nvidia all having good days. Amazon with a new deal to buy a satellite operator. Oracle is in the top pick too. They are now going to be buying energy from Bloom to power its AI data center, so that gets a big boost of more than 7.5%. BlackRock's also up, as is Citi, both reporting strong earnings. On the downside, as oil prices fall, so too do the oil majors, Exxon and Chevron, in their Wells Fargo disappointment for their earnings. Shares down 5.33%. Walmart is also down. Intel is down after a big run for Intel, where they added a huge amount to their market cap, about $100 billion. Let's look at some of the sectors. Consumer discretionary having a very nice day too, maybe as oil prices come down. Infotech, a good day for them. I point out some of the big caps, but I should also note that software, IGV, the ETF, is up nearly 3% today. To the downside, it is energy. Staples are down. I point out Walmart down. Energy down 2.7%. Again, Matt, for an overall index, which is looking for another day of gains.
Yeah, I mean, 60 points away from an all-time closing high. 69.68 is what I see. There back in January. So coming up, Jamie Dimon says the U.S. economy remains resilient, but there's an increasingly complex set of risks. We'll discuss today's bank results with Baird analyst David George. This is Bloomberg Open Interest.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3. Then, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is the 1 to 6.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment. 3 revolutions in 1.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Bring
bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
15 minutes into your trading day, let's see what the sell side has to say with your top calls this morning. First up, UBS. They upgrade Tesla. They say the stock looks more fairly priced after a stretch of worries about weaker EV demand, higher costs, slow progress on projects like robotaxis and Optimus. The firm, though, still expects that those bets will improve over time, and they see Tesla as a long-term AI leader. A nice little share pop for them today, up 1.7%. Next up, Morgan Stanley says that U.S. steel stocks are looking stronger thanks to higher prices and tariffs. The firm is raising its price target on Nucor, Steel Dynamics, and Reliance. Shares up as much as 1% this morning. Finally, Wall Street is weighing in on BlackRock's strong quarter that sees their shares up nearly 4%. TD Cowen points to lower taxes and solid inflows. KBW highlights higher fees and lower costs. Evercore says that better management fees and leaner expenses show that the business is performing well. Matt.
All right, JP Morgan trading revenue beat, and traders posted their highest ever quarterly haul. The bank, though, cut its net interest income guidance back down to where it had been before it last raised its net income guidance. Let's take a deeper dive into the bank earnings. Joining us now is Baird senior research analyst David George. He has a neutral rating on JP Morgan with a price target of $290. And David, let me just start with the net interest income. What is it? Competition? Is that the holdback here?
Yeah, good morning, Matt. A couple things. Loan growth is maybe a little bit slower. Deposit costs maybe a little bit higher. I think markets revenue and the tightening of spreads is also having an impact. I would caution market participants or viewers of the show this morning to not get too worked up about $1 billion NII swing. I mean, the bottom line is this is over a $2 trillion balance sheet. They could print any net interest income number they want. I think they're just trying to be conservative and thoughtful as it relates to kind of capital allocation going forward. But overall, Matt, the quarter was pretty good.
And I mean, huge trading numbers across the board, David, for all of the banks. In the media call, we heard from the CFO of JP Morgan saying, I wouldn't extrapolate these out. We don't know what the environment is going to be like. How are you viewing the trading desk and these trading revenues? Obviously, there was huge volatility in the first quarter. Given the macro stresses we're still expecting, how does your outlook appear?
Well, we feel pretty good, Danny, about the capital markets outlook. There's a lot of M&A that's been announced in very large scale and very diverse from a sector perspective. And with the markets coming back, equity capital markets should also be relatively robust. The trading numbers, to your point, probably aren't sustainable, but nonetheless, they were very good in the first quarter. It seems like many, many moons ago, but we had significant volatility in gold, silver, oil, rates, equity markets, vol, and the money center banks, JP Morgan specifically, really benefited from that this quarter.
In terms of the war and the warnings on geopolitics, I mean, does that really provide any headwinds to JP Morgan? Is it only the weakening of the consumer for slightly higher prices at the pump?
Yeah, I think you just nailed it. From my perspective, at least, I think the major kind of lingering issue and I'm clearly not a geopolitical expert, but to me, the biggest concern that I would have in terms of the macro from a credit perspective is how long do oil prices stay here? and the related impact on the consumer, but also supply chains and just kind of how, as you both know, higher oil prices kind of manifest themselves in a number of different inputs. And to the extent we stay elevated, to what degree does that have an impact on inflation broadly and corporate profit margins as well?
David, just a minute here, but some of the other headline risks that we've been watching for the banking sector, and a reason that shares had been weighed down earlier was private credit exposure. We had some details from banks, Citi out, saying that they have $22 billion worth of exposure to private credit. Wells Fargo goes even into more granular detail, $36 billion. They say only 17% is software. Is there any reason to be concerned around private credit exposure?
We're always concerned about credit, Danny, but from my perspective, the private credit, and I'm not trying to be dismissive, but the private credit fears that market participants have, I think are, we say overblown, particularly given the size of these exposures and really the nature of these exposures. A lot of these are among the lowest risk loans on these balance sheets. These could be to large insurance companies. These could be capital call lines to private equity companies, which are extremely, if not zero risk. So it's not something that we spend a lot of time worrying about. Again, oil and the related impact on the consumer and corporate profit margins is really where we're a little more focused at the moment.
David, thank you so much for joining us. That's Baird Senior Research Analyst David George off the back of earnings from the big banks. Later today, catch the CFO of Wells Fargo. He'll be on the close at 3 p.m. New York time. Coming up, more corporate news. United CEO Scott Kirby pitching a possible combination with American, something we would not have even dreamt of in past administrations. We're going to get the details next, right here on Bloomberg Open Interest.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Bloomberg has learned that United CEO Scott Kirby pitched a possible merger with American Airlines to senior government officials. That would be a regulatory long shot and would by far create the world's largest airline. Let's get more with Bloomberg Aviation editor Benedict Campbell. Benny, I don't even know where to start with this. I mean, this would be huge, monumental. Would regulators even allow this? And what does it say that Scott Kirby is even asking?
Well, I think Scott Kirby is trying to sort of push his luck here, and he pitched this, as you said, to circles in Washington, and not to anyone. He pitched it directly to President Donald Trump. That's what our reporting shows. There was a meeting in late February where he brought up this idea, interestingly, a couple of days before the war in Iran started, which really has put the aviation industry into a sense of crisis, given what it's done to fuel prices. So, if anything, that has only sort of intensified the need for something, at least in the minds of a lot of executives. Since then, we've had Kirby come out and say, this is an opportunity for us, the current state of the industry. We've had Ed Bastian at Delta say we might see more consolidation. You have to remember that consolidation in the industry, and the industry as we know it now in the US, was built around consolidation. That always happens and it accelerates during a time of crisis. And anyone you speak to in the industry right now will tell you that this is the moment. But to your point, this is obviously a massive, audacious endeavor. And whether this is just Kirby sort of dreaming big and seeing how far he can push it, or whether it's something that's real, that's something we need to find out.
Benny, do me a favor. Compare and contrast the U.S. Airline market with what we have in Europe. Because I spent 10 glorious years living over there and taking like 30 euro flights to Ibiza. Whereas here, even on Spirit to Austin, I'm paying like $400 or $500. Why is that?
Well, I mean, in the US, you have the big four. You have Delta, you have United, American, and Southwest, and then you have sort of second division and third division type companies. And then you have some that are really struggling. Spirit, for instance, and the ultra low cost market in the US, in particular, is in dire straits. There's no doubt about that. That is different over here in Europe. You also have sort of three big groups. You have Lufthansa, Air France, and the IAG group that includes British Airways. But then you have very solid companies like Ryanair, who have really sort of mopped up a lot of the regional market in Europe. So to your point, those cheap flights that you were taking to the Mediterranean, you probably boarded a plane on Ryanair or on EasyJet. Yes. That is a market that is sort of solidified in the way that you don't have in the US. And that's where some of the opportunity lies. What's different in this case is that this is two of the biggest that would combine, and that's where a lot of the headaches come from.
Benny, thank you so much. Pleasure having you on today. Bloomberg's Benedict Campbell has been covering airlines for us globally for many years. I never went, by the way, to Ibiza.
It just made it sound like you did.
I sometimes flew to Barcelona and to Jerez, but never to Ibiza.
Let's please move on.
Coming up in the next hour, an exclusive conversation with ECB President Christine Lagarde. She sits down with Bloomberg's Francine Lacroix, of course, in Washington, D.C. Plus, the CEO of Rolls-Royce joins us later, Chris Brownridge, to show off his new $5 million car, and the CFO of Johnson & Johnson.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time
We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlet Fu, who's taking a closer look at drone companies.
With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
How much of a drag does it have on GDP forecasts? Again, oil prices fluctuate so much.
You know, the direct impact on GDP is going to be measured by the IMF, the World Bank, the OECD to a lesser extent because it doesn't have the whole constituency, but all of them are revisiting downward their projection. I think it's, minus 0.3 compared with what they had expected. We are revisiting as well our growth forecast and our inflation forecast. We have published that, as you know, and we have revised inflation to 2.6%, growth to 0.9, and then the evolution is going to be a factor of how long, how deep, how propagated the crisis is. And we central bankers are left with defining the baseline, which is, based on the most accurate information we have, what we think will happen. And because this information that we have is constantly changing and we have a high degree of unpredictability and uncertainty, we have to work on scenarios, factoring in how high oil and gas and all 6-NA and derivatives of those products will be, how long it will last, and how fast the situation will be recovered. And we keep looking at current data as they come in. And thanks to Bloomberg, for instance, this comes in on a very regular basis. And we try to figure out where we are relative to the baseline and where we are relative to the various scenarios that we have laid out.
Yeah, and I think you laid it out as three scenarios: baseline, adverse, and severe.
Yeah, I would call the baseline and the other two the scenarios.
The scenarios. So where are we now?
We are in between the baseline and the adverse. So we have baseline, adverse, severe. So currently, but when I say currently, you have to look at the price of the barrel, the price of the various categories of fuel, the price of futures, and all of that applied to gas as well, to determine where we are exactly relative to these two. But we are somewhere, I think, in between the baseline and the adverse scenario.
So how quickly can that change from baseline to scenarios?
It changes every day. So the difficulty of us central bankers is that we need to take a medium-term view. This is how we define our target. This price stability that defines our mandate is done by reference to the medium-term results. And at the same time, facts, data, number of ships blocked here, volume of oil extracted varies almost on a daily basis. So we need to do this somehow schizophrenic exercise of keeping our eyes on the medium term and making sure that we deliver on our mandate, but at the same time checking the data almost daily.
So what does it mean for monetary policy? Does the baseline already warrant a hike?
What it means for monetary policy is that we have to be, it means two things. We have to be completely agile and ready to move in the direction that is required. And second, we have to be data dependent, as we have repeatedly said. But it does not predicate, as we speak today, Francine, that we will go in one direction or the other. And it certainly doesn't, determine a rate path that I can confirm today. And any of the colleagues who are confident that it's going to be one way or the other, or don't know, honestly.
Does the ECB have a tight...
But don't forget one thing. The baseline and all our scenarios are designed and formulated with the incorporation of what the market assumes. And no other monetary policy or fiscal policy decision affecting baseline or either of the two scenarios.
Do you think there's a tightening bias?
At the ECB? No, I think we have a compass which indicates price stability, predicated on financial stability. Those are the two, I wouldn't call them bias.
No. How different is it from the shock in 2022? And how different will your response be?
Well, it's different from 2022 in many ways. If you look back, inflation was completely different. Interest rates were completely different. The shock was a combination of supply and demand. It was a vastly different situation. And I think Europe is affected in a much more significant way than it is at the moment. Because we had this sudden stop that came out of the war in the unjustifiable war of Russia against Ukraine, which brought to a halt the delivery of gas. That was very sudden.
I mean, at the time, central banks were blamed for acting too slow. Is there a danger? I mean, how does that impact, again, your thinking this time?
Look, I think we've said very clearly that we would need data to act, but that we would not hesitate to act. I think it really captures well the position that we have. We need the data in order to analyze whether it's see-through, it's going to be short-lived, we will get back to back to the past, if you will, although I don't think that's actually possible. And we need all that. So it's either the see-through, which doesn't require that we take any particular decision, or it's going to be long-lasting, it will peak higher, and it will require action on our part, or it will be somewhere in between, which will then require judgment on the part of the Governing Council to decide whether or not the indirect effect and the risk of secondary effect might de-anchor expectations, which then would require action as well.
So I was at a dinner yesterday with the Treasury Secretary who was saying that actually he thinks this will be short-lived.
But he's a political leader, as well as being a terribly competent person, but he's a political leader. I'm not a political leader anymore. And our job as central banker is to stay in our line, to observe our framework. We have one, thank you very much, and to identify whether or not we are in a situation of short-lived, look-through, or long-lasting act, and possibly decisively, or in between, which requires a very subtle identification of how much, when, in order to make sure that inflation expectations are anchored and we do not get the secondary effect. So that's the job. It's the difficulty of what we have to do at the moment, while at the same time very seriously looking at the medium term and being attentive to the short term.
And so your gut feeling for what we're living through now, you'll act quicker than in 2022?
I don't have a gut feeling. When I'm... I hear the music of, this is short-lived, we will go through that, you can see through. First of all, we decide what we have to do. Point number one. Point number two, to explain to the fisherman who cannot go at sea because he cannot pay for his petrol, or when I think of, the household that doesn't know whether they'll be able to pay for the refilling of the fuel tank, or whether I think of the guys who have to drive to work and who see the price of oil at the pump going up and up and up. I take the see-through story into account, but this is not something that you can actually explain, which requires, from our perspective, in order to align in the most effective way monetary and fiscal policies, it requires that we have a dialogue with the fiscal policy leaders and ask them to be targeted and temporary, transparent and tailored and all those TTTT when they design support packages or help for the people who are the fisherman, the housekeeper, the household, or the guy who is driving his car.
Given where we are now, what does worst-case scenario for growth and inflation look like?
The worst-case scenario is war in any event. As former head of the IMF, I have seen successful program being completely wiped out by war. So war is, in any circumstances, the worst outcome. If you talk in strict economic terms and the movement of goods and all that, it's the Strait of Hormuz not being open for shipping and transportation, because you have 20% of gas and oil going through that, as well as the like of ingredients necessary for fertilizers, ingredients necessary for microchips, and what have you, not going through the strait.
So what's the pain threshold for the euro area economy that the ECB would have to act on? Is it inflation at 3-4%, or is it?
Look, we have forecasts for inflation that vary between 2.6, which is the baseline that we have, and a little north of 4%. Based on what I told you earlier, which is see-through, strong, decisive reaction, or somewhere in between, depending on the factors that we see, we will adjust because we will be agile. But one thing for sure is that we will keep our 2%.
Madame Lagarde, how worried are you about the discrepancy between spot and future oil prices, and so potentially tighter markets that we're pricing in?
I think it's the whole dilemma that we have about short-term and medium-term. And the more anxious and worried economic actors are about the resolution of this crisis, the more pressure there will be on the spot market.
How much do you blame the U.S. administration for what's happening to the European economy?
It's not my job to do, blame, to point finger or to associate this or that with blame. I'm more in the hope section myself. And I very much hope that people can sit at the table, can come to their sense, and understand that it will be in the best interest of the global economy, of the people, that a war settlement is reached, and that not just a ceasefire, and that we can navigate through the straits of the world.
How long?
It has a ramification with international law, but let's not go there. I'm a reformed lawyer, as you know.
We can go there if you want. I mean, is it something, when you look at the economic fallout, actually, in general, even if there's a truce or if there's lasting peace, how long does that play out for?
I think there are two dimensions to that. One is for shipping to resume under regular, normal conditions. It will take, I don't know whether it's 2 or 3 months. I listen to the experts, and I try to understand how long it takes to fill in the ships again, to move the tankers around and to deliver. I think most of them are saying that it's a 2 or 3 months job for the shipping and the distribution. Production, refinery, that seems to be another matter. And when you look at the Raf Al Hassan refinery facility in Qatar, they say that it's not months, it's years that we're talking about. Some of the facilities in Saudi, whether it's pipeline, probably shorter, but some of the other facilities will require long-term fixing and adjusting and repairing and setting it up again.
I mean, given all of this, is there too much financial exuberance in markets?
You know what is a little strange is that there is a tendency by some to assume that it's business as usual. And I think there is a bit of a dichotomy between between those who regard business as usual and those, on the other hand, who are saying, watch out, it's a very significant shock. and we are not about to see the end of that process, because there will be ramifications. There will be impact on the price of processed and unprocessed food. There will be an impact on the supply chain if it lasts longer, and we're not going to see exactly the same disruption as during COVID, but something that will be in between normal and COVID disruption.
But do you worry about financial stability? I mean, there's also private markets.
I always do. I always worry about financial stability and price stability, because they are intrinsically interdependent. So, we in the supervision function of the ECB and all the supervisors around the world have to be very attentive to financial risks, whether sort of declared and disclosed risks, which hopefully have mitigating factors associated with it. At least that's what the regulation is doing, and the rampant risks, the various black swans that are there.
What worries you the most in all of this?
It's what worries me both in good and bad, and I hope we'll never have the ugly, is the impact of artificial intelligence on our economies and the outcome and the governance of artificial intelligence. And what I mean by that is, what impact will it have on not just on productivity, where our star will go, which obviously matters to us central bankers, but what impact will it have on our societies? How many people will be unemployed? How many people will require retraining, reskilling? Who will pay for that? The whole fiscal equilibrium that will result from the massive transformation that is expected in many corners. That keeps me not awake at night, because I try to get some sleep, but it's a big issue. It's a really big issue.
Are governments thinking about that, given they're also dealing with this massive energy crisis?
I've been in government a few years of my life. What is really difficult is to focus on the day-to-day, to mind the next election, to respect your program or the expectations that your voters have, and yet at the same time to anticipate what will be the effect of major breakthrough, innovations, significant developments. And I think that in that category, AI is something that we need to have at the front of our mind, because it is moving so fast, and because the impact of it can be so disruptive for good or for bad. I think the development we've seen with Anthropic and Mythos is a good example of a responsible company that is suddenly thinking, that could be really good, but if it falls in the wrong hand, it could be really bad. We need to do something about it. I don't think there is a framework. Everybody is keen to have a framework within which to operate. I don't think there is a governance framework that is there to actually mind those things. We need to work on that.
Do you think financial institutions are prepared for?
Well, I think they've been called to meetings in various corners of the world, and I know that we at the ECB are talking to financial institutions to alert them to those risks. Yes.
Madame Lagarde, we also had elections in Hungary over the weekend. What does Orbán's defeat mean for Europe and the world?
I think I'm looking at Peter Magyar victory, which was significant, landslide result. He has 2/3 majority. He can change. This new prime minister can change the constitution, remove, a number of obstacles to both growth and integrity in the governance of that country. And I think that is really to be welcomed. The second thing that it tells me is that Hungary is in the European family, and what I heard recently is that this new prime minister, Peter Magyar, is indicating that he would like to see Hungary join the euro area and the forint of Hungary be replaced by the euro, which I think is the natural path of all 26 actually, it excludes Denmark, but 26 member states are expected to be part of the family. And we have 21. If Hungary goes through the process of integration, the convergence and all of that, it would be a great achievement, and it would coincide with what was expected by the founders.
Do you think that the talks on adoption of the euro by Hungary will happen in your mandate?
Wow. you'd have to extend my mandate a little bit, which I think is not in the cards. I'm happy to stay, but no, because convergence requires a number of reforms, some of which I think Hungary is going to consider and hopefully implement. The judicial one is a point in case. And then it requires an adjustment period, which is usually anywhere between 2 and a few more years, depending on which country you look at in terms of other practices. But the convergence process takes a bit of time. You need to align a lot of parameters. You need to have the same legal basis on many aspects. But I'm delighted that he's looking at it with a very positive approach, and he's picking up on that basis, which has not been the case for a long time.
Talking about your mandate, will you see it out? Will you fully finish your mandate?
Look, when there is big clouds on the horizon, the captain does not leave the ship. And this captain is not going to leave the ship because I see clouds.
Biggest cloud?
Well, you know them.
What do you see?
We're all facing the same situation with asymmetry, as I indicated. But when you see, major disruption, the energy supply being reduced, when you see threats to growth, upside risk to inflation, these are serious matters that we have to be attentive to and to keep under control, so that our price stability, our 2% target, is not going to be varied from.
Madame Lagarde, Captain Lagarde, thank you so much for joining us. Thank you.
All right, that was European Central Bank President Christine Lagarde speaking with Bloomberg Television anchor Francine Lacroix on Europe's economic challenges. Let's get a reset here. Scarlett Fu and Paul Sweeney, this is the Bloomberg Intelligence Program. We're here with you for the next 2 hours. Lots of stimulating conversation as we deal with a market that is moving higher here, Scarlett. So we got that stock market moving higher. We got oil pulling back. That's kind of what the market likes to see typically.
Well, there's some renewed hopes that maybe the U.S. and Iran are ready for peace talks once again. That idea that diplomacy fell apart completely earlier this week. Market never seemed convinced that that was the case. And now there's some reporting that perhaps the two sides are willing to come together again.
Yep. Reuters was out with some reporting earlier, maybe as early as Thursday here. All right, let's get a reset of the markets out there. We can do that with the Bloomberg Business Flash.
Thank you very much, Paul and Scarlett. Let me quantify those moves because we got the VIX holding just above 18. You mentioned crude oil. Let's begin there because I'm looking right now at a 6% drop in West Texas Intermediate crude, 93.19 a barrel right now on WTI. Brent, the global benchmark, 95.74 barrel of Brent, down by 3.6%. But again, that move in WTI bears repeating, down 6% at 93.16. The Dow, the S&P, NASDAQ, they're all pushing higher right now. A 46-point gain to 69.33 on the S&P, up by about 0.7%. Optimism that the U.S. and Iran are considering another round of peace talks, pushing down oil prices. The Dow Industrials up 231 on the Dow, gain there of 0.5%, while NASDAQ up 257, now up by 1.1%. Again, the VIX just above 18 with a 10-year, 4.27%, that 2-year, 3.76%. Gold up $61 the ounce, 48.02, up by 1.3%. And again, crude, WTI down 5.9%, 93.23 a barrel. Earnings news, lots of banks this morning. Right now, JP Morgan Chase down 0.4, Citigroup up 1%, and Wells Fargo down 6.7%. Also, we heard from Johnson & Johnson after earnings. Those shares up by 0.4%. Paul and Scarlett, that is a Bloomberg Business Flash.
All right, Charlie Powell, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we are live here in our Bloomberg Interactive Broker studio in New York City. We are streaming live on YouTube, and we are streaming live at bloomberg.com/video, and that's where you'll find us here. I think coming into 2026, a lot of strategists were saying, after really strong returns in 24 and 25, 26 was going to be a kind of a bounce year, a little volatile year, maybe up and down kind of year, but I don't think anybody had the war with Iran on their bingo card.
Probably not. I mean, for the most part, they were looking at a fourth straight year of gains for the S&P 500, and the path to getting there was probably not riddled with all kinds of ups and downs like we've seen so far in this first quarter and start of the second quarter.
Absolutely. So let's go to somebody who does this stuff for a living. Matt Stuckey Chief Portfolio Manager for Northwestern Mutual Wealth Management. Matt, where are you, as you talk to your portfolio teams at Northwestern Mutual, what's kind of the call these days about kind of where you want to have some exposure, maybe where you want to trim some of your exposure? What's the conversation?
Yeah, I guess I can just walk through how we've been managing the last few months. There's a lot of volatility underneath the surface of the market. Even discounting the fact that the headline indices have been pretty choppy the first couple of months, but underneath the surface, there's been a lot of pronounced kind of single stock volatility, and I think that allows for a couple of things to happen. One is, there's risk management that you have to take into account in terms of managing the current portfolio, but also looking for opportunities. I think in terms of risk management, one of the areas where we looked in the month of March was discounting some of our, just huge moves higher in oil-related energy stocks. And the thinking there was pretty simple. The forward curve looking at crude oil didn't really discount this current state of events as being persistent well out past 6 months. Yet the stocks were up 40, 50%. And during the month of January, when we were talking as a team, we were talking about just this move higher in these exposures in the absence of a fundamental driver, and a lot of it, as we're finding out, in the months of February and into March, was just discounting increased geopolitical risk. I think you look through history in terms of how markets have behaved. They tend to look through geopolitical risks that don't translate into macroeconomic risks, and so far that's been the case. And so, doing some risk management there has been part of our exercise so far this year. But I think on the opportunity side, looking at some of more of the cyclical parts of the market that have been discounted, not only so far this year, but the last 3 years, things like small cap exposures, that are finally turning the corner in terms of earnings growth. And I think that's pretty exciting and leading into those parts of the market as we look forward here.
So I want to pick up on that point, liking the small caps and the mid cap space as we head into this earnings season. And to your point, right now, we do see the small caps outperforming the big caps today. The Russell 2000 up 1.1%, the S&P gaining 2/3 of 1%. Talk a little bit about how the earnings season is set up for these companies, which are very sensitive to higher interest rates and also very sensitive to expenses like rising oil prices.
That's a good point, Scarlett. A couple of things that I've just observed so far this year, just for the first month and a half of the year, you saw pretty significant outperformance in the small cap space. And I think that's just a reflection of finally seeing an inflection higher in earnings growth. And you go back to kind of mid-May when all this started to shift of 2025, small cap earnings growth was leading the market in terms of the indices, in terms of projected earnings growth. And that was a material change from what we've seen since the Fed raised rates in 2022. And that valuation for the small cap space is spread between that and U.S. large caps. It was as wide as we've seen since the late 1990s. And to us, we like that risk and return relationship. That was interrupted, as we all know, with the conflict in the Middle East. But even despite that, you typically see with cyclical areas of the market like small caps, you see underperformance in periods of geopolitical unrest or just volatility moving higher in the markets. We didn't see that. It certainly didn't move in terms of being unchanged, but it moved almost in lockstep in terms of the performance with U.S. large caps, which was really interesting to me. And here on the other side, as we're starting to see oil prices come down, that outperformance is starting to reassert itself. And so, to me, I think what we're seeing is an improved industrial economy so far this year, and improved cyclical parts of the economy, responding to this 175 basis points worth of Fed cuts that have now been with us for a couple of years and are working their way through the economy. And I think that all translates into pretty robust earnings growth for small caps, and maybe even leading earnings growth relative to U.S. large caps.
That kind of goes to the next question, Matt, because we're just starting this week to kick off earnings with some of the big banks, and some pretty solid results out of some of the big banks, although Wells Fargo stock's down 7% here on that net interest income miss there. I mean, do you think earnings growth expectations, are they good enough to support this market broadly defined?
I think so, and specific to the big banks, there is still going to be a penalty for missing guidance. And what you're seeing is, the reaction so far this earnings season as a result of how the forward kind of expectations potentially are being reset. Just this morning, J.P. Morgan's results were, their classic J.P. Morgan beating on the top line and on the bottoms line. But, the stock reaction is, down 1% or so. That's pretty typical for JP. But, they did trim guidance a little bit on the net interest income. You saw net interest income miss on Wells Fargo and the stock, like you mentioned, down 7% or so. But underneath the surface, very strong top line growth. Not only in terms of the consumer business, but also for the fee-based businesses, highlighted by what we saw in trading revenues and investment banking revenues for the big money centers so far this season.
All right, Matt, thank you so much. Matt Stuckey is Chief Portfolio Manager of Equities over at Northwestern Mutual Wealth Management, making some decisions here to shift a little bit away from the big caps towards the small caps and the mid caps here as this volatility continues to grip the markets. Let's talk a bit about the source of the volatility, which of course is all the events in the Middle East. Wendy Benjaminson is our Bloomberg Senior News Editor joining us from Washington right now. And Wendy, the volatility is just a constant here for the markets, for investors. And the source of today's volatility is some reporting that perhaps the U.S. and Iran are looking to once again hold peace talks. What does the latest reporting indicate?
It does indicate that. I mean, President Trump came out yesterday and said he'd gotten a call from, or the U.S. government had gotten some call from Iran ready to come back to the table. There has been some reporting out there that that the U.S.'s position on Iran's nuclear capability is never, if you listen to Trump. But the Iranians came back and said, we won't produce any nuclear weapons for 5 years. The U.S. came back and said, how about 20? The Iranians said, no deal. And that's where we are at the moment. But at least that suggests that there is some horse trading to do and some talks to be had. So now the question is where, when, and with whom. And another somewhat hopeful note, there is an Israeli and Lebanese delegation in Washington today to talk about the shelling that Israel is doing in Lebanon. The only trouble with that is that it is with the Lebanese government and not Hezbollah, which is the Iranian-backed terror proxy that Israel is actually fighting.
Wendy, this, like many things with this administration, this war and perhaps the ending of this war comes down to Donald Trump and what he wants at any particular point in time. Do we have any understanding of what the president really is looking for here and maybe a time frame?
We don't actually, because every day there's another message coming from the White House about what he wants. But I mean, as someone who watches politics, I can tell you he needs an off-ramp and he needs one soon, because the midterms are really right around the corner. I know November sounds like a long time away, but in political life, it's nothing. And he is, in fact, meeting with the Speaker of the House and the National Republican Congressional Committee, which is the group that raises money for and supports Republican congressional candidates. So he is at least aware of that, and yet at the same time, he will sort of, casually say, yeah, gas prices are going to go up before November, sort of get used to it as this war goes on. But I do think it's also important to him, as he is becoming less and less popular on the world stage, that he doesn't walk away from this empty-handed. Now, he may get some sort of fig leaf way out of this, like the Iranians saying that they, for example, have the right to enrich uranium, but really agree not to enrich uranium. Something like that might allow them to say, there you go, Iran's not going to enrich uranium.
Right. Something that looks like a W on the board.
Exactly. And he'll say while they're bombing, he's saying we've won. So he's going to say we've won no matter what.
So I got to ask you, Wendy, before we let you go, we, of course, know that Kevin Warsh is the nominee for the Federal Reserve Chair, President Trump's nominee, but nothing has moved forward with that because of the Justice Department's criminal investigation into this renovation project over at the Federal Reserve. Now we're hearing that the Senate Banking Committee will hold a confirmation hearing. What is the latest?
That's right. We do know that there will be a confirmation hearing for Kevin Warsh next week. We're not exactly sure of the day, but it is coming up next week. And that would suggest that perhaps the banking committee has gotten Tom Tillis, who had said he was the senator from North Carolina, sort of an anti-Trump Republican, who has said he will not talk about Kevin Warsh's nomination until this case is resolved. So it could be that because there really isn't any evidence of a crime that anyone has been able to uncover, that perhaps the Senate Banking Committee has gotten some word that the Justice Department is just going to quietly let this thing die. This investigation into the renovations at the Federal Reserve Building, I should say, it will just quietly go away and Warsh can move forward. Because I believe Powell's term as Fed chair is coming to an end and they need a replacement.
Wendy, thank you so much. We really appreciate getting a few minutes of your time. Wendy Benjaminson, she's the senior editor, Bloomberg News. She's down there in Washington, D.C. And again, the markets are moving. We got oil down about 5-6% for WTI crude oil and stocks trading higher on some reporting that there may be some movement on both or either side to restart negotiations.
Yeah, but it's only Tuesday.
Yes, exactly.
A lot can happen between now and Friday.
A lot can happen between now and Friday, so we'll keep that in mind. But that's kind of what's driving stocks here. We had some earnings from some of the big banks here today. The fixed income trading, the equity trading for these big has just been extraordinary. A little bit of a pressure on net interest income for Wells Fargo, and they're seeing that in their stock price down 6%.
You mentioned oil prices being lower with WTI at $93 a barrel. Energy stocks, the biggest decliners in the S&P 500 this morning.
Absolutely. We're going to have more coming up. The S&P 500, it's up 47 points. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. We do check markets all day long here at Bloomberg. The rally continues. The Dow, the S&P, NASDAQ, all advancing. S&P just off session highs, holding on to a gain now of 45 points at 69.31, up by about 0.7%. Dow Industrials up 161, now up by about 0.3%, while NASDAQ is up 270, a gain there of 1.2%. The advance for the NASDAQ 100 index keeps on going. That index up now by 0.9%. The VIX just above 18 with a 10-year at 4.27%. Gold up 1.3%, 48.03 the ounce, and West Texas Intermediate crude down 5.5%, now at 93.59 a barrel. Brent 95.92, barrel of Brent down 3.5%. ECB President Christine Lagarde says the Eurozone economy is somewhere between the European Central Bank's base case from the war in Iran and a less rosy outcome. Now, she made the comment in an interview with Bloomberg's Francine Lacqua at the IMF spring meetings. She also talked about the economic and societal impact of artificial intelligence.
What impact will it have on our societies? How many people will be unemployed? How many people will require retraining, reskilling? Who will pay for that? The whole fiscal equilibrium that will result from the massive transformation that is expected in many corners. That keeps me not awake at night because I try to get some sleep, but it's a big issue. It's a really big issue.
And you can hear the full conversation on Bloomberg's new video hub at bloomberg.com/video. Just getting word that FluidStack says it is in talks to raise about $1 billion at an $18 billion valuation. That headline right now on the Bloomberg Professional Service. Again, recapping here, the Dow, the S&P, NASDAQ, all higher. S&P up by about 0.7%. I'm Charlie Pellet. Paul Scarlett, that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. I'm not into the EV thing yet. I did get one hybrid for the number 4 Offspring, and that's
who's in California. So,
yes.
That's the context here.
Yeah, $6 gas. So, one of the EV companies I kind of forget about, that's just me, is Lucid Group. They make
because you're not a Timothée Chalamet fan.
Oh, is that it?
Yeah, he's the global brand ambassador.
All right, the stocks, got $2.9 billion valuation, down 16% this year, down 65% over the trailing 12 months. But they have some news out today. They're going to new CEO. And they announced $750 million of fresh investment from 2 big backers here. So let's see what's going on with Lucid. Ticker LCID is the Bloomberg ticker. Craig Trudell, Global Autos Editor for Bloomberg News. He joins from London. Craig, what's Lucid doing here to try to turn things around?
We knew it was going to be a busy morning for them. It was an even busier morning than we anticipated. We spoke with Silvio Napoli, the former head of Schindler Holding, of elevator and moving walkway fame. He's going to take over as CEO. The person who's been filling that seat for over a year now on an interim basis, Mark Winterhoff, he will return to the role of COO. He took over, from the CEO who actually kind of took this company public. I think, Lucid, in addition to, you mentioned that the, commitment as well from the Saudi Public Investment Fund and Uber. The other news here was as part of this capital raising, which they're doing some raising beyond just from the PIF and Uber, is releasing some preliminary earnings, which did not look great. So this is a company that has really been struggling to execute, make some really appealing and interesting electric vehicles, but has really struggled to make them in higher volumes and doing so in profitable or remotely profitable way. So, I think in short, Napoli has his work cut out for him.
I mean, is Lucid's goal to be a mass market EV company? From what I can find, it doesn't deliver a lot of cars. In 2024, for instance, it delivered more than 10,000 vehicles, but I mean, that's nothing compared to something like Tesla.
Yeah, it's a fraction. I do think it's been a case where the company has been sort of feeling around what exactly its play is. I think, for a time they were trying to go lower volume, higher prices and kind of casting themselves as a premium player. But later this year, they will start production of a mid-sized vehicle where they've flagged the rough pricing of that being around $50,000. So that would put them more, at least closer to the sort of mass market where you see, like a Model Y, you can get, price in that range. So, this is a company that has tried to compete with like the Mercedes and the Porsches of the world, found that really difficult, and they are doing a bit of pivoting. How much that has been a sort of like change in plan versus the plan all along is a little bit unclear, and is kind of dependent on who you ask. I think the CEO who was replaced about a year ago would have preferred they stayed premium, and I think they've changed tack a little bit under the new regime.
So right now, the Lucid's big thing, of course, is this partnership with Uber, and this was first announced in July, where Uber said it would buy at least 20,000 Lucid Gravity SUVs, that new vehicle you were talking about. Has this partnership with Uber amounted to anything just yet? I mean, is it getting its name out there?
Yeah, I think it's going to be really interesting to see if that is able to get off the ground. They have a third party that's involved in that partnership, a company called Nuro that itself was working on delivery robots and has pivoted to getting into autonomous vehicles and trying to compete with the likes of Waymo. This is still very much in the sort of prototyping and testing phase. And we've not seen them actually launch vehicles, but I'm endlessly fascinated by just how much money Uber is throwing at trying to kind of have its own fleet of self-driving vehicles and have some competition for Waymo, even as it partners with Waymo. There's a lot of experimenting and playing around with business models in this space. And we are still so early. For all the headlines we read about, new cities that Waymo is entering, they still have just a few thousand cars out on U.S. roads across the various cities where they have deployed. And so this is really, really early innings, even if people are increasingly having their first experiences with getting into a fully driverless car.
Craig, what's the latest with Tesla and it's bringing in a lower price model?
Yeah, there was an interesting report out of Reuters about maybe they're dipping their toe back into making a vehicle priced below the Model 3 and the Model Y. We saw Tesla China representatives deny that report. But what made that so fascinating is it's speaking of sort of changes in strategy by companies. I think Elon Musk has sort of minced no words about, in his words, it being stupid for Tesla to sort of bring cars to market that are lower price, because in his mind, every day is going to be the day that Tesla sort of flips a switch and is able to render its cars capable of driving themselves. I think regulators are extremely skeptical of that, in part because those days keep coming and going without that capability really being ready to where people behind the wheel can actually tune out and not pay attention to the system that Tesla sells as full self-driving, which just has not lived up to the name yet.
Yeah, I mean, there's two components to that, right? The fact that a switch could be flipped on that and whether regulators would allow it. Technologically, whether we're there yet and whether the regulators have given that the okay. Do consumers want that?
That's a great question too. I think some consumers absolutely, and you will see Tesla super fans, many of whom happen to be investors, sharing indications of progress where they are fond of taping their drives where things go well, and yet the questions that you sort of naturally raise are right. How sort of choosy are they being about what clips they show and don't show? And you still continue to see incidents where Teslas that aren't being supervised are getting into really troubling crashes.
All right, Craig, thanks so much. Appreciate it. Craig Trudell, Global Autos Editor for Bloomberg News, based in London. I did my first Waymo ride about a month ago, in Santa Clara, California.
How far did you go?
It was probably 10 miles each way.
Okay.
And, just kind of suburbia Santa Clara.
Were you like doing anything in the car? Were you singing to yourself?
In the back seat with my son, going to In-N-Out Burger. All went according swimmingly. It kind of did.
You
fine.
took the Waymo to In-N-Out Burger.
Yes.
Yeah.
How California is that?
Totally.
So, totally. S&P 500 up 51 points. That's 0.75%.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Earnings season here. We had luxury retailer LVMH report some numbers, disappointing, and they're calling out the war in the Middle East. Let's break down the numbers there. Deb Aiken joins us. She's a luxury goods analyst for Bloomberg Intelligence. She is based in London. LVMH, in a world of luxury, this is one of the bellwethers. Deb, talk to us about what we're hearing from the company.
It is, and one of the first to report. So overall, actually, yes, Middle East. So when the war broke out, we did some work where we looked at these companies and thought maybe around 5% of sales, 4 to 5% of sales exposure to Middle East. And what we've heard so far from the first two to report, Brunello Cucinelli and then LVMH, we actually are seeing around 50% sales loss through the month of March. Initially from store closure, which was very short-lived, and then not so many into the stores. That started to pick up. But overall, consensus was looking at a 2% growth on organic for LVMH for the first quarter, and they came in at 1% because 100 basis points were knocked off from Middle East alone. Now, that overshadows the very solid and robust performance coming from the US, and actually that Asia ex-Japan continues to pick up with China positive.
So talk to us about China here, because that's been obviously one of the key drivers for global luxury sales in general. What's LVMH saying about China?
Right, so actually the Chinese cluster are flattish versus last quarter where they were mid-single digit negative. And so that is the Chinese cluster traveling as well as domestically. Domestic is positive, up positively, and travel is still down slightly, so overall flattish. But it's a continual improvement, and we have been carrying out a survey from the second quarter, some analysis from the second quarter on China, and started to look quarter by quarter 2025 and into the first quarter 2026, what the top 10 luxury companies are doing. 6 out of the 8 or 9 who are really focused on China are reporting positive growth, and we're seeing that build momentum, albeit gradually quarter by quarter. It seems to be the same so far for 1Q from both Cucinelli and LVMH, and we'll have Kering report soon, and also this week Hermes.
So, Deb, very curious as to which brands within LVMH are doing well. Some are more high-end than others. I know that the wine and spirits part of the business has been struggling a bit, but within the actual brands themselves, what's on top?
So they called out solid performance actually from Louis Vuitton, which is very important because it's the biggest by far of its business. We would say 25% of sales are over 20 billion for the Louis Vuitton brand across different categories. They're saying that anything they're bringing out in terms of new product design campaigns that they're running are being very well met. So overall, that's positive. Dior with Jonathan Anderson as the new creative, the product that he is bringing out, positive also. And then aside from the brands, they're calling out positively beauty, jewelry, some watches as well. Wines and spirits actually both turned positive, again, albeit against very big negatives a year ago, but both plus 5%, yeah. And then the other one would be Sephora. So Sephora is actually doing very well, although the numbers came in within selective retailing plus 4% on that quarter, partly because Sephora is actually higher indexed in Middle East. So where where LVMH Group has 6% of its sales in the Middle East, they're higher than that for Sephora. So that took a hit from the Middle East, but very solid growth, Europe and the US.
Deb, how about just here in the U.S. market? We, as many know, we have a very pronounced K-shaped economy. But boy, we hear from a lot of brands on the upper part of that K that business is good. What is LVMH saying about the U.S. market?
Very robust. So we've got 3% growth in the quarter against a solid growth the year before. And when we're looking at the numbers, actually, despite what's happened with the Middle East, it's homogenous growth. So kind of stable throughout the month of January, February, March. The high end are performing well. As you say, it's not just for the LVMH group, it's across others too. We saw that also with Cucinelli. We expect to see it with Hermes. Yeah, they're withstanding the pressures. We're not seeing the consumer sentiment hit the high end US consumer so much, maybe on the back of stock markets and others. We wait month by month and quarter by quarter to see what happens. But so far, the story for 2026 seems to be about watching China and the US.
All right, Deb, thanks so much. Really appreciate it. Deb Aiken, she is luxury goods analyst for Bloomberg Intelligence. She is based in London. She is our go-to voice in all the things luxury and LVMH. Definitely calling out the war in the Middle East impacting their business, because you think about some of the high growth areas in the globe in terms of consumer spending, the Middle East broadly defined. You think about, the UAE and and Dubai and that part of the world. Money's flowing there, and that's great for the luxury market because they're following right there. But there's disruption there. That's a problem.
Right.